Hello everyone, this is Ravi Taori. Guys, for CFI Audit in simple English, yes, especially for South students, we have prepared two special things for revision. Number one, we have prepared around 16 hours of 250 plus important questions. It will be in two parts. And next is we have prepared important concepts from our FADU chart book. From the whole chart book, it will be around 12 hours, one video. Links are given in the description. You can get soft copy of the 250 plus important question, 350 plus important questions. You can see our marked copies also, marked PDF for the Param question bank and other resources. Everything is given in description. Make full use of these two things. Do these two things first properly, and then you can enhance your preparation by adding more questions to it if time permits. Okay. On the last day of 250 plus important question, I was not well, but still I have managed to take the session. Cover both the things. If you cover both the things, important questions and FADU chart book revision, if you do both the things, you will be doing extremely well.
Okay guys, we have seen now 3 chapters and I think they will account for 45 marks in exams because there is full of standards on auditing. Let's move to next chapter. You can expect a lot of cases on corporate governance. A lot of cases are expected here. If you go to Audit Guru Telegram channel, you will find a ABC analysis file. So in that you will find all the 18 chapters, what is the weightage, whether it is A category, B category, C category, you can get it there in the file section. Now, let's see. So, we'll focus on broadly two things. First, different types of committees. So, this chapter is about corporate governance. What is corporate governance? How should companies' decision should be taken? Corporate governance means governing a corporate, that means governing a company. How decision making should happen in a company, how they should be directed, how they should be governed, that is corporate governance. For good decision making, you need good board of directors and you need good committees. Then good decisions will be taken and they will be implemented. For good corporate governance, we have two things. We have Companies Act and we have LODR, Listing Obligation Disclosure Requirement. Both this Companies Act and LODR, they talk about board of directors, their roles and responsibilities, how often they should meet, what they should discuss, how they should take decisions, and they also talk about committees. In our course, we have specifically focus is on LODR, Listing Obligation and Disclosure Requirements. That too, see, LODR is huge. LODR is having 11 chapters. It is having 11 chapters and 110 regulations. We are not having all of them in our course. We only have limited regulations which deal with corporate governance, which deal with how decisions should be taken and how they should be implemented. Broadly, it focuses on 3 areas. FAT, fairness. That in decision making, take care of all the stakeholders, there should be fairness. A is for accountability. It will make people accountable and responsible. This is your responsibility. If you don't do it, you will be punished. And T, it focuses on transparency. Whatever decisions you take, whatever financial statements you prepare, they should be properly communicated to everyone. So it focuses on FAT, fairness, accountability and transparency. Now, let's go one by one. Let's first focus on different types of committees. Okay. Now listen. If you're having FADU chart book, listen guys. There are only 2 chapters where there are amendments. One is corporate governance and another is peer review. Whatever version you're having, you just need to take care of 2 chapters, corporate governance and peer review. Most updated PDF will be shared within few days on the Telegram channel. Updated fully amended corporate governance also, and updated fully amended peer review also. We have already shared amendment notes. We have already shared a video also on amendment. Now the portion which we are seeing, you can quickly, if you want, you can make the amendment on your own for the portion we are seeing. Come to the last portion. Come to the last part of corporate governance. Someone please tell me the page number. Not Param. FADU chart book. 56. If you see page number 56, we have prepared a table for all the committees. More you compare them, better will be the retention. So let's see. So we have different types of committees. The most powerful committee is audit committee. Most powerful with stringent requirement and very strict requirement is audit committee. Then after that, we have nomination and remuneration committee. Then after that, we have stakeholder committee. And then last we have risk management committee. So if you consider strictness and requirement wise, highest is audit committee, below that nomination remuneration committee, below that stakeholder committee, and below that risk management committee. Now what we have done, we have prepared a table. So first, to whom these committees are applicable, we discuss applicability. After that, who will be the chairperson of the committee. Then next, members, how many members are required, what should be the composition of the members, how many should be independent directors, and then other points. And then what is impact of superior right equity share. What do you mean by superior right? If shares are having differential rights, that means some shares are having higher voting powers or higher dividend rights, then those shares are called superior right shares. For example, Mark Zuckerberg, he is having voting power of 10. So if others having same share, they can vote 1, he can vote 10. That is how he is going to always have control over Facebook, Meta. Then after committees are formed, how many times they are supposed to meet? When the meetings are there, what should be the quorum and what will be the functions they are supposed to execute in the meetings? So this is, now if you compare and study, it will be easy for you. Let's see one by one. Let's see audit committee. So when it comes to audit committee, there are two things which will govern audit committee. One is section 177 and next is LODR. So let's first talk about applicability. We all know section 177 applicability. It is applicable to listed public companies. So it's applicable to all the listed public companies. Next, it is applicable to unlisted public companies. Paid up capital 10 crores or more. Then borrowings exceeding 50 crores. And then turnover 100 crores or more. This is most logical limits. Smallest is paid up capital. Higher than that, borrowings, and higher than that, turnover. What about LODR? LODR is applicable if specified, if designated securities are listed, they have given list of securities. Which we'll see. So if so and so securities of any entity are listed, LODR will get applicable to them. So they cover a lot of securities like equity shares, convertible shares and debentures, preference shares, debentures, mutual fund units, IDR, Indian depository receipts, security receipts. We know in securitization, everyone is aware what is securitization? A special purpose vehicle is formed, assets are transferred to special purpose vehicle, and then ownership is given to people by issuing shares or instrument, that is called security receipts. If any of these securities are listed on a stock exchange, that entity will be considered as a listed entity and LODR will get applicable. We'll see that. Now let's talk about, so first we know when 177 is applicable, LODR audit committee is there, or LODR is applicable, audit committee is there. Let's talk about who will be chairman. LODR is going to be always strict. As per LODR, chairman should be independent director. 177 is silent. Now after chairman, and now important thing, he should be present at AGM also. Let's see guys. First of all, we saw applicability. It is simple. Applicability is simple. 177 is applicable. It is applicable. LODR is applicable. Audit committee is applicable. Then we talk about chairman. LODR, he should be an independent director. There was a question on this. They are going to ask this in the form of case studies. So this table is extremely important because, and especially audit committee thing is extremely important. There will be straightforward cases on this. And in recent exam, they have been asking cases only. So independent director, and he should be present at AGM. Whole committee should not be present, only chairman should be present. 177 is silent on this. Next, see, it's in sequence. First applicability, then comes below that chairman, and below chairman comes members. How many members are required? As per LODR, minimum 3. As per 177, minimum 3. What should be the composition? Okay. What should be composition? As per LODR, 2/3 should be independent director. It's on stricter side. As per 177, majority should be independent director. Then next interesting thing is that it says that all the members should be financially literate. They should be able to read, understand financial statements, financial documents, and one expert should be there. At least one of them should be expert. But in 177, majority of them should be able to understand understand financial statements, including chairman. Chairman should be having financial. So 177 is always less strict as compared to LODR. So now we know applicability. Now we know who should be chairman, what he should do, number of members should be minimum 3, and what should be the composition, and that we also know about their features. One more thing in others, CS should be company secretary. As per LODR, company secretary of the company should act as secretary of that particular committee. That means he should do all the formalities. He should maintain the minutes. He should inform agenda. He should see that meeting is properly recorded into minutes. He is supposed to do secretarial work, record keeping basically. Then what if there are superior right equity share? If company is having superior right equity share, condition will drastically improve. Number one, most important, all the members should be independent. 177 is silent about it. There is nothing like this in 177. Now we know applicability, we know about chairman, we know about number of members, their composition, and we also know what is the impact of superior right equity shares. What about meetings? There are questions on this. They should meet at least minimum 4 times in a year. They should meet at least 4 times in a year, and gap should not be more than 120. Should not be more than 120. And what about quorum? This is common everywhere. Majority of time it is common. 1/3 or 2 members, whichever is higher. Of course, without 2 member things cannot function. 1/3 or 2 members, whichever is higher. But important thing, those two, at least 2 independent directors are required. Again, there will be case study on this. Minimum 2 independent directors should be there. As I said, audit committee requirement are strictest. Audit committee is one of the most strict committee. Requirement are highest in audit committee. Rest of the committees fall behind it. And then roles and responsibilities are given. That's a big thing. 177 also specifies what are roles and responsibilities. And LODR also specifies what are roles and responsibilities. As I said, if you're able to understand Hindi, I have covered full chapter concept to concept in 60 minutes. But then again, as I said, there is zero explanation to it. You can go with that. Otherwise, if you cover this much, that is sufficient. Now, corporate governance. Yeah. Quickly, now we know about these committees as per company, as per LODR also, and as per Companies Act also. Let's go to next committee, Nomination and Remuneration Committee. It is applicable to all listed public company. All listed public companies. Fine. Now, when it comes to chairman, what is the requirement? He should be independent director. Okay, so this is similar to audit committee. You need to compare. More you compare, more you will remember. It is again, it should be same like audit committee. He should be independent director. He should be present at AGM. Now this is different. This is something unique only in nomination and remuneration committee. So their main job is to nominate who are going to be next directors. Their main job is to decide what should be the remuneration. Chairman of the company cannot become chairman of this committee. Chairman of the company cannot become chairman of the committee, but he can become member. Chairman of the company cannot become chairman of nomination and remuneration committee, but he can become member of the committee. That is the most important thing. In fact, I will share this PDF also, share it in the evening only, about the corporate governance. This particular file is fully amended. I have made all the changes. And I will further share one more file in which the whole FADU chart book of corporate governance, wherever changes are there, amended thing. How many? Now we know about applicability, chairman, and we know the special condition about the chairman. Now let's talk about members. Minimum, how many members are required? 3. That is common. And the different condition. Generally, people talk about having independent director, but as I said, conditions are less here. So they are saying that all the members should be NED, non-executive directors. So how you remember this? You remember that conditions are little less in this committee. Audit committee needs 2/3 independent. Here they don't need independent. You need all non-executive directors. Okay, all non-executive. Sorry. Next is, and 2/3 should be independent. All non-executive, and amongst the non-executive, 2/3 should be independent. So there is an amendment out here. Earlier they used to write half of them should be independent. Now they write 2/3 should be independent. So all of them should be non-executive, that is special. Apart from that, 2/3 should be independent, and that's it. There is no effect of superior right equity shares. Earlier there was an effect. Now there is no effect of superior right equity share. Now we know about applicability. Now we know about chairman. Now we know about members. We know all of them should be NED. 2/3 should be independent. Now about their meeting at least once in a year. So there was a question in MTP or RTP, and there was a question in MTP and RTP, and they said that nomination remuneration committee meets biannually. Biannually. And how will you interpret it now? Once in 2 years, or once in 2 years, or 2 times in a year? Okay. Unfortunately, institute has interpreted it once in 2 years. It is debatable. It is controversial. Biannually, someone will say 2 times in a year. Institute has interpreted once in 2 years, and they have said it's a non-compliance of LODR. Now, when you know about this, you should write answer accordingly, and you should put a star mark, alternative answer. This can be the interpretation. They are meeting twice in a year and they are complying. So 2 answers should go. But then, because institute has said it once in 2 years, you should also try to match them. Okay. Then again, when they meet, see, all the requirements are on the linear side, lenient comparatively. 1/3 or 2, whichever is higher, at least 1 independent director. In audit committee, that was 2 independent director. Here they say 1 independent director. And then what are the functions? Their functions, again, functions are given. Okay. So what is different in nomination and remuneration committee? All members should be, and before that, chairman should not be chairman. That is little different. Then all members should be NED. Again, that is little different, special, different. And in audit committee, it is 4 times in a year. Here it is once in a year. Now, after that, we have stakeholder committee. What is the main job of stakeholder committee? It is simply take care of the stakeholders. Shareholders, debenture holders, are they receiving dividend properly, bonus properly, what are the complaints, resolve the complaints, and so on. Quickly, applicability. LODR is applicable, then it is applicable. Who should be chairman? Condition have further reduced. Earlier it used to be independent director. Now they say it should be simply NED, non-executive director. But then one condition remains same. He should be present at AGM. Now this is same in all the 3 committees. Chairman should be present at AGM. Now below chairman comes members. Again minimum 3 members. Now condition has reduced drastically. Only one independent director. In audit committee it was 2/3. Nomination remuneration 2/3. Now here it has reduced drastically. Only one. Only one, at least one independent director is required. No extra conditions. Then what is the effect of superior right share? Drastic effect. 2/3 should be become independent. In audit committee, all should become independent. If there are superior right, it has a huge impact, drastically changes. That is the only way to remember these committees. You need to compare them. And then your retention capacity will increase drastically. If you compare them, you will remember it for longer time. There will be more accuracy. You have to compare and remember. And again, at least once in a year. Okay, this thing matches. Nomination and remuneration also once in a year. The stakeholder committee also once in a year. No quorum requirements. Again, as I said, this is quite lenient. No quorum requirement, and then their roles and responsibilities. And then most, again, risk management committee, there is an amendment in this. Applicable to, it is not applicable to all listed companies. Top 1000. Earlier it was top 500. Top 1000. And to HVDs. HVDs, high value debt entities. We will study about this also. It's very simple. If as on last year, if as on last day of the previous year, if instruments outstanding of any entity is 500 crore or more, 500 crore more, it is called as HVD, high value debt entities. So risk management committee is applicable to few companies only, top 1000 and HVDs. It is not applicable to all listed companies, only HVD, only top 1000 and HVDs. Chairman should be, again requirement is less, he should be member of BOD. Member of BOD, okay fine, he should be one of the member of the BOD. Number of members 3. Now interesting thing, composition, there can be board members also and majority from the board. That means there can be people apart from board, senior executives. This is the only committee where there are people other than board members. Again, the requirement has reduced. Majority from BOD, at least one independent director, senior executives can become member. So in this committee, minimum 3 people, senior executives can become member, but then majority should be board and at least one should be independent director. At least one should be independent director. If superior right equity share are attracted, drastically increase to 2/3. So if you observe in this committee also, superior right it goes to 2/3. Are you getting this point? Not members. If company has issued superior right equity share, then the requirement changes, because then there are complications. Voting rights are different, dividend rights are different, things become complicated. So the requirement increases drastically. Meeting at least twice in a year. Okay. Till now, till last two committee was once in a year. So it is a lightweight committee, but they have to meet twice in a year. Gap not more than 180 days. 1/3 or 2 member, whichever is higher, at least one member should be present, BOD member. Now guys, again, now this is the chart you are mandatory to see it just before exams. Just before exams, you have to see this chart, then you will be comfortable. Now these are different types of committees. Listen, come to 422. 422, guys, you have to simply explain audit committee. See, in exam they will ask, either they will ask audit committee as per 177, explain one column as per section 177, or they will ask audit committee in general, then you have to explain as per LODR. So either I will ask as per 177 or they will ask as per LODR. Depending on that, you will decide which column should be explained. See, the question is like the main features of audit committee, classes of companies where audit committee is required, constitution of audit committee, or compare both. Rarely they will ask compare both. If they say compare both, you need to explain both the columns, you need to explain. Now 422.100, all-in-one limited is a large listed company. So they are talking about large listed company which focuses on so and so things. Okay, whatever there is work. The management wants to know whether they are required to constitute risk management committee. So they want applicability from us, and they also want composition from us. Just now we have seen nomination and it is risk management committee. Just now we discussed that last column will need to be explained. So that table gives you answer about audit committee also. That table gives you answer about risk management committee also. No need to remember regulation numbers. There are a lot of regulation number, they are not expected. Okay. Next is 425. Mandatory review. Total 110. It is not in course. Total number of regulations are not in course. So you are noting those also which will never be asked. So from this we come to know that we have to focus on 4 committees. Now, broad requirements of audit committees: focus on accounts and auditing. Whether accounting function is working properly, and then auditing function. This is a very broad thing. But over a period of time, they have increased responsibility of audit committee. You do this also, that also, and so on. A lot of responsibilities are there on the audit committee. Now, there's something very famous, mandatory review. Mandatory review. It is mandatory that audit committee should review, study, analyze, and give its opinion on certain matters. So what are those matters? That's called mandatory review. How to remember it? Listen, how to remember it? There are few things to be done. Start of the year. It is only for retention. Start of the year. Then there are few things to be done during the year. Then there are few things to be done at quarter end, year end. And then there are few things to be done at year end. So what should be done at the start of the year? Audit committee should mandatorily review, understand, and evaluate and give its opinion about internal auditor. Who should be internal auditor? What should be terms of the engagement? What should be its power? Who should be internal auditor? what should be the powers of internal auditor, and what should be the scope, how many things internal auditor should cover. It should be mandatorily reviewed and commented upon by audit committee, mandatory review. Then during the year, first point is deleted. In the recent amendment, first point is deleted. During the year, they should mandatorily read few things. Number one, all the management letters and letter of weakness given by statutory auditors. So whatever internal control deficiencies are reported by statutory auditors, they should mandatorily review it. They should mandatorily review it. Then all the weaknesses which are given by internal auditors report. So all internal control deficiencies reported by statutory auditor, informed by statutory auditor, and all internal control weakness reported by internal auditor. It should be reviewed. During the year, all the deficiencies should be reviewed. Then quarter end, company makes statement, what statement? Statement of deviation and statement of variation. Whenever company doesn't use money for the purpose for which it was raised, it needs to be reported in statement of deviation. And if internal allocation is not proper, so like it was 60% will go to capital expenditure, 40% will go to, so 30% will go to working capital and something else. There was an internal breakup 60, 30, 10. If internal allocation is not maintained, even that needs to be reported. That is called statement of variation. Every quarter end and every year end, they will make statement of deviation and statement of variation. It is responsibility of audit committee again to review it, analyze it, and comment on it. Apart from this, in annual report, a statement is given regarding fund utilization. Whether overall fund is properly utilized. Even that need to be reviewed by audit committee. Year end, in annual report, one section is there, management discussion and analysis. Even that should be mandatorily reviewed by audit committee. Quickly, start of the year, internal auditor things. During the year, weaknesses by statutory auditor, weaknesses by internal auditor. Then quarter end, statement of deviation, variation, annual statement of fund utilization. Then year end, management discussion and analysis. Now, interesting thing is, see, this question is not in the important list, but then I'm just saying how they sometimes, what they do, because it was asked in November 20 exams. Okay, so how they twisted and asked mandatory review thing is the best example. So they said that, again, this question you may not find in the important 250, but then as it came, I said, let's discuss. BK and Associate is a CA firm. They made a presentation for audit committee, and then they explained what are the difficulties faced during the audit, disagreements with management, management letter points, management representation letter, etc. Now, some of the audit committee members were not happy with the above presentation, and they say that why are you discussing all these things with us? They believe that audit committee is not the forum for discussing such problems and has to be sorted out between the auditor and the management. Please comment. So, please comment. So basically, auditor is making a presentation and he is discussing a lot of things with the committee, and committee members are saying it is not our responsibility to listen to all these things. You sort it out with management. And then the answer is, there is obligation. You need to explain again. It is audit committee's obligation to see some things. It is mandatory. Again, give the list. And all these issues, these are the problems. They should be discussed with the audit committee. So members of audit committee are not correct. auditor is absolutely correct in discussing things. He should discuss all the issues and problems he is facing with respect to audit with the audit committee. And this is also in line with SA 260. This is correct as per mandatory review, as per LODR, and this is correct as per SA 260 also. So if you have seen this question once, you will remember, okay, they say that these things are not relevant, but we will say that these things are relevant. Now, once again, they are not matching each and every point. Whether this was there in mandatory review, that was there in mandatory review, no. They are saying in general, all these points. If you see, out of this point was there in the mandatory review. Management letter points. Other things were directly not covered. But generally, as per SA 260, even all the problems of the audit should be discussed with TCWG. And you know, audit committee is our TCWG. Board of directors is our TCWG. But board of directors have delegated all the work of accounting and auditing to audit committee. That is called subgroup. Because they look after complete accounting and auditing. So we don't communicate directly to the auditor. We communicate it to TCWG. For all practical purpose, audit committee is our TCWG. So in short, if auditor is discussing all these things, he is absolutely fine. One point is covered in management, one point is covered in mandatory review, and other points are covered in SA 260. All these points are covered in SA 260. Institute could have given reference of SA 260 also. Okay. Come to 426. Now listen, this is a case study. In a case study, very simple case study. They are saying that the workload of the company has reduced, business has reduced. As business has reduced, there is not a lot of work. So instead of meeting 4 times in a year, we are planning to meet 2 times in a year. We are planning to meet 2 times in a year or 1 time in a year. Is it acceptable? Answer is no. And then be careful. They also ask about quorum requirements. 1/3 or 2, whichever is higher, and at least 2 independent directors should be there. Very simple thing. And they are saying unanimously they decided that they will meet for less number of meetings. No unanimous resolution is going to work. You cannot override law. You cannot override LODR. Then that next is very easy. Okay. Listen, one more thing. So it is about meeting. They reviewed monthly information system of the company and found no errors. So they are saying they reviewed MIS. You should again explain mandatory review. Mandatorily, these things should be given. This should be done. Only MIS is not sufficient. Only MIS is not sufficient. See, they are explaining mandatory review. They are again explaining. So that is the importance of mandatory review. They may ask a direct question. They may say that whether such discussion should be done. They may say that this is the only thing which is reviewed. Again, you have to explain mandatory review. Okay. Now, next is they are having 4 meetings. 4 meetings in 1920. Is that correct? Yes. In a financial year, you are having 4 meetings. That is absolutely fine. There should be 4 meetings. But then the gap, if gap is more than 120, that is more than 4 months roughly. If gap is more than 4 months, 4 months roughly, then it will not be in line. See, the first meeting is 15 June. Next is October 18, July, August, September, October. So it is 4 months. If you count, I have done the counting there. 15 days of June, 31 days July, 31 August, 30 September. It is 125. It is crossing 120. So requirement of LODR not fulfilled. And rest is fine. October to Feb, November, December, Jan, Feb. It is 18th. It is 18th to 10th. It is within 4 months. So roughly we can understand. Roughly we can understand. It is within 120 days. Listen, you don't need to compute number of days everywhere. You should see whether roughly it is 4 months. Roughly it is less than 4 months. No need to compute. When you find it is roughly more than 4 months, then you go for computation. Any penalty, no specific penalty is given. It's a non-compliance of LOD. And Companies Act I cannot comment. LODR here they have not given specific penalty here. Then next is 10th Feb to 10th of June. Again within 4 months. 4 months? March, April, May, June. Yes. Now the most important thing next is board composition. Board composition and chairmanship. Quickly, so if you go to audit committee, the most important thing is types of committees. Most important thing is types of committees, its roles and responsibilities. And then the next is, so all the questions till now were based on that only. And in between we have seen mandatory review. Now next most important thing is BOD composition. Lot of cases are asked on this. Someone give me page number. Board composition verification. FADU page number 52, column, first column. So come to page number 52. After number of committees, extremely important thing is board composition. Let's see. Now, board composition, first thing is about non-executive directors. How many non-executive directors should be there as per LODR? At least 50%. 50% of the board should be non-executive director. 50% of the board. Non-executive director. Next. And this non-executive director should be below age of 75. First of all, 50% of the board should be non-executive director and they should be below the age of 75. If a person has attained age of 75, age of 75, and if you want to keep him as a non-executive director, you can do it, but then special resolution will be required. You need to circulate explanatory statement explaining why such a senior person should be non-executive director and then pass special resolution, and then only person can become non-executive director. So first requirement with respect to NED, non-executive directors, and then about their age. Next is at least one woman director. At least one woman director should be there, and if it is top 1000, then at least one independent woman director. For normal companies, it is only woman director. For top 1000, condition has increased. It should be independent woman director. And now now we have seen requirement of NED and woman director, that is their small requirement. Big and the most important requirement is number of independent directors. How many independent directors are required? So answer depends on who is chairman. Answer depends on who is chairman. If a chairman is non-executive director, only one third of the total director should be independent. If a chairman is a non-executive director, no other conditions are there, one third of the board should be independent. But then requirement increases to one half in three situations. Requirement increases to one half in three situations. Number one, chairman is an executive director. If chairman is an executive director, without any doubt, it should be one half. 50% of the board should be independent. Chairman is a non-executive director, but he is relative. He is promoter himself, or he is relative of promoter, or a board member, or person one level below board member. Either he himself is promoter, or he himself is promoter, or he is a relative of promoter, or relative of board of director, or relative of a person working below board of director. So it will be gone. There was a beautiful case there. They said that brother-in-law is sitting in the position of chairman. Brother-in-law of promoter, brother-in-law of director, or key management, one person below board is sitting in the position of chairmanship. Okay. What will happen? Brother-in-law is not covered in definition of relative. So the catch point was brother-in-law is not a relative. As per Companies Act. Companies Act is very simple. Who is relative? You should do PT. No, school. Father, stepfather. Mother, stepmother. Brother, stepbrother. Sister, stepsister. Then son, stepson, and wife. Daughter, only daughter. And daughter's husband. Good for stepdaughter. She is not in definition of relative, no obligations. And then spouse. Not, listen, father, mother, brother, sister, son, daughter, only for that person, not spouses. Children will be same. Not necessary nowadays. Okay. Now, so listen carefully. If we are not talking about father, mother of spouse, brother, sister of spouse. So be careful. Spouses, father, mother, spouses, brother, sister are not covered. Children will come automatically. And again, be careful. Wives, spouses of brother, sister are not covered. Here also, these two things to ICI plays with. Relatives of the spouse are not in definition of relative, and spouses of brother and sister are also not put in definition of relative. So GIG, or what we call GIG, अरे वो तो अलग होगा, ठीक है. And Mama? Bawa? Okay, Bawa. So GIG is called Bawa. Acha. Okay. And Bhabhi is will also won't be covered. Yeah, ठीक है. चलो, Bawa and Vadina. Okay, Vadina. Both won't be covered. So GIG won't be covered and Bhabhi will not be covered in definition of relative. Sale sab it is already covered. No, okay, whatever. Then next is if superior right equity share, again it will increase to 1/2 in three situations. Executive director, 1/2. Relative sitting, promoter or relative sitting, 1/2. And if superior right equity share, 1/2. In three situations, requirement increase to 1/2. And if while calculation, if there is any fraction, then rounding off to higher integer. That's common sense. That's how you fulfill minimum. Then next is what is auditor's responsibility? Simple, to see whether these are complied with. Go and see whether these conditions are complied. Independent directors will submit how they are independent. They will make disclosures. Company will study are they really independent. So auditor should see whether requirements are fulfilled, where declarations were given, whether declarations are proper, and are they really independent. Now, next, so that small requirement of NED and woman director. There are big requirement of independent director. Again, very small things. Minimum director. If company is in top 2000, if company is in top 2000, not less than six directors. So this is a minimum requirement only for top 2000. Before this we studied top 1000 for risk management committee. For risk management committee, not less than 6. So there was a question on this also. The next question on this also, maximum directors, maximum directorship, sorry. A person can be director in how many companies? Directorships, director independent, maximum 7 listed companies. Be careful, 7 listed companies. You can be director in maximum 7 listed companies, or you can be independent director in maximum 7 listed companies, or any combination. It should not exceed 7. It should not exceed 7. That's a odd number. Then, if by any chance you become managing director or whole-time director in any listed company again, then your limit will reduce. Then you can serve as independent director in only 3 entities. If you become managing director or whole-time director in any company, then you can become independent director in only 3 listed. Your limit will reduce drastically by 4. You become MD because your time is occupied. You become MD or whole-time director anywhere, your limit will reduce to 3. Okay. Always while reading problem, clearly read. Are they, sometimes they write 8 directors including so and so. Or they may write these are the directors and other than this, the director. See, interpretation will change. If they are saying something is inclusive, it is different. If saying they are saying they are other than these directors, these are more directors. Be careful whenever they use the word other. Now, this condition is removed, deleted. In amendment, this condition is removed. Earlier, there was a condition for chairman also. Who can become chairman? Let's freeze. What was the requirements now here? First is NED and woman director. Then in between we have independent director. Then we have minimum directors, maximum directorship. Whenever two laws talk about one thing, you have to see combined interpretation, and in combined interpretation, generally we should see whichever is strict. So sir is saying that in Companies Act maximum is 10 and here maximum is 7. So if in listed company we have to follow whichever is strict. 7 is strict as compared to 10. Correct? And that must be again 10 for listed or unlisted or all. Public company, whatever. So generally speaking, till now there not has been single case where they mix Companies Act and LODR. Generally in audit they stick to LODR requirement only. From that point of view only questions are drafted. So no need to worry about that. Okay, come on the cases now. Okay. Okay, look at this quickly. So 430.500, this question is asked in November 21 RTP. November 21 RTP, it is top 500 listed companies. So this entity is in top 500. So risk management committee will get applicable. So top 500 means automatically in top 1000 and 2000. So sometimes people are confused. Top 500 is automatically you are in 1000 and 2000. So risk management committee will be applicable. And next, independent woman director. And next, minimum 6 directors. Okay, let's see. Verifying composition, and these are the details. Number one detail, there are 9 directors. Okay. If there are 9 directors, minimum director requirement is fulfilled. Minimum director requirement is fulfilled. Next, for non-executive director, we have just studied half of the director should be non-executive. So half of 9 is 4.5. That is 5. Only 4 are non-executive. 4 are non-executive. Condition is not fulfilled. Non-executive condition is not fulfilled. 3 independent director. Okay, 3 independent director. So for independent director, you should immediately first see what? You should immediately see who is the chairman. You should immediately see who is the chairman. Let's understand who is the chairman. Non-executive, but his brother-in-law, FMD. Listen, if chairman is non-executive and nothing else, its requirement will be 1/3. Requirement will be 1/3. But if he is a relative, requirement increase to 1/2. But then as we have discussed, brother-in-law is not called in definition of relative. So condition will not be 1/2. Condition will be 1/3. So 1/3 of 9 is 3. And how many independent directors are there? 3. Absolutely fine. Immediately we should go and see who is the chairman. Chairman is non-executive. He is relative. He is relative, but then, sorry, brother-in-law is there, but brother-in-law is not called in definition of relative. Next is only one woman director. She is executive director. It is top 1000. Should be independent woman director. Even that condition is not fulfilled. Non-executive condition is not fulfilled. Independent woman director is not fulfilled. Independent director condition is fulfilled. Brother-in-law is not covered in definition of relative. This is the case study from November 21 RTP. High chances that they reproduce it. Okay. Then next study material. What are the contents of management discussion and analysis? Management discussion and analysis, MDA. Who will give the page number? 54 column first. So if you come to page number 54, they'll ask you what should be the content of management discussion and analysis. See, what should be the content? First of all, they are saying you should prepare a statement called management discussion and analysis, and it should be disclosed as part of BOD report. Part of BOD report, you should make a statement, management discussion analysis, and you should include that statement in BOD report as part of director's report, as an part or as an addition to director report. Next, which should be ultimately included in annual report. So every year, make a statement, management discussion analysis, including the BOD report, and then I'll include that in annual report. What should be the content? So we had a soft discussion with Rishi. Soft discussion with Rishi that what should be in the MDA report. S stand for segment wise, product wise performance. Simple. S stand for segment wise and product wise performance. How your different segments and products are performing. Then O stand for outlook. What do you think about future? Future economy outlook. What do you think? How future of the economy, future of the industry? The broad idea how things should be there. Then F stand for financial performance with respect to operation. So explain how our operational performance has changed, whether it has improved, whether it has improved or it has deteriorated, and what is the financial impact of that. So simple, talk about operational performance and because of that impact on the financial performance. Then O stand for opportunity and threats. Overall, what do you think are the opportunity for the businesses and what are the threats for the businesses? So company may be into various businesses. So first we are discussing overall economy and industry. Then now that particular business, what are the threats and opportunities? Things may repeat. Then risks and concern. Specific risk to the organization. Specific risk to the organization, entity and its department, that there is a risk of obsolescence, there is a risk of theft, there is a risk of non-compliance. What are different risks and concerns? What is the industry structure? Is it perfect competition or monopolistic or monopoly or oligopoly? Then ratios, lot of ratios, and explain, give the reasons if there is a change in ratio more than 25% or more. So if a ratio has changed from 10% to 14%, is it 25% or more? Yes. 10% to 14%, that means it will be counted as 40%. If any ratio has changed from 10% to 14%, it will be counted as 40%. Be careful with that. Just to remember, we have made list of ratios. Assets in numerator, current asset ratio. Liability in numerator, debt equity ratio. Profit in numerator, lot of ratio. GP margin, net profit margin, return on net worth. In case of return on net worth, any change, any increase, decrease need to be explained. Generally people write, if they decrease because of low performance of business, it is increase because of high performance of business. Whenever there is any change on return on net worth, it should be explained. Interest coverage, in all of them, profit is at numerator. GP ratio, net profit ratio, return on net worth, interest coverage ratio. Sales in numerator, inventory turnover ratio, debtor turnover ratio. So you can remember this way: assets in numerator, liabilities in numerator, profit in numerator, sales in numerator. Shop resident with Rishi, that stand for human resource. How good is human resource of organization, including relationship with the union, employee unions. I, lastly, internal control and their adequacy. So in each and every annual report, in BOD report, there should be a document called management discussions. What is shortcut? Soft discussion with Rishi. S stand for segment wise, then outlook, then financial performance, opportunities and threats, risk concern, industry structure, significant changes, human resource and internal controls. One more thing, accounting disclosures. If there is a non-compliance of accounting standard in Ind AS by any means, if there is a non-compliance, details where there is a non-compliance, it should be explained in financial statement along with explanation, and same should be incorporated again. And same should be incorporated again in MDA, Management Discussion and Analysis. So if there is a non-compliance of accounting standard, explain it in BOD report, financial statement also, and explain in management discussion analysis also. What is auditor's responsibility? Simply verify this. Verify in the sense, not required to examine and check each and every data. Only go and see whether above financial, non-financial information is included in MDA, whatever they have discussed. Not supposed to examine and verify each and everything. Only whether LODR requirements are fulfilled and whether information look reasonable as per overall understanding of the entity. They're talking about so much of turnover, so much of discount, so much of employees, whether it looks acceptable, digestible, realistic. Once again, no need to verify each and every information given in MDA. We are not auditors of MDA. Read it once, see whether LODR is complied with, whether something unreasonable, and check whether anything is unreasonable as per understanding of the entity. You can check always consistency, means if any information is given in financial statements as well as LODR, simply check whether both they agree with each other. Once again guys, no need to verify. LODR requirement fulfilled, nothing unusual, they are consistent, that will be sufficient. Okay. Which chapter? Corporate governance, audit committee and corporate governance. So earlier it was committees, then it was mandatory review, then we saw composition of board. Now then we saw management discussion and analysis. All these are important questions. Now, okay. Let's see. Next is code of conduct. Code of conduct. Who will give me page number? Code of conduct. Code of conduct must be near management. 54, column 3. Code of conduct. And there is a question on code of conduct. Now, what do you mean by code of conduct? Listen. So first is meaning of code of conduct. It explains overall responsibility of directors and senior management. What is your overall? So it will explain overall responsibility. It will explain you should respect law. You should respect law. Then you should respect company policies. You should take care of your colleagues and employees. You should take decision in favor of the stakeholders. So it will give broad principles, overall responsibility, and then it will also explain principles how decision should be taken. It will explain what is overall responsibility of company, overall responsibility of directors, senior management, and how they should take decisions. So a lot of principles are there. A lot of principles will be there, and these are important when you take crucial decisions. For example, they may write customers first. So there is a very famous example of Johnson Johnson. So the first thing they have in their policies, business policies, customers first. And there was a doubt that their new medicine is having some ingredients because of which people may die. And one or two incident occurred. It was not proved that it is because of that medicine, but immediately Johnson they called back everything and destroyed all the stock. Now that is because of their code of conduct. So code of conduct explains overall responsibility, how to conduct, how to take decisions in favor of stakeholders. Yeah, it's like a manual. Yes, it's like a manual. A few pages will be there, important principles, and you will see them. And you can get it from website. And you will get it from website. You go to any company's website, you will get code of conduct. Now, who will develop it? It is responsibility of board of directors to develop code of conduct, overall responsibilities and principles, how to take decision for board and senior management. It should ensure that it should include requirement of Companies Act. Code of conduct should specifically say respect law, respect Companies Act and requirement of Companies Act. Once it is made, it should be posted on website of the company. So you should explain meaning. Then you should explain who should make it. And after making it, where it should be posted. Then every year, all board members and senior management shall affirm, that means confirm, shall affirm and confirm that throughout the year they acted as per code of conduct. And CEO shall sign a declaration annual report, should sign a declaration, put it in annual report that board members and senior management has sent affirmations to company. So every year they will send affirmations. Every year CEO will take list whether they have received, and he will give declaration in annual report. So people will send affirmations to company, and then after seeing them, CEO will give declaration in annual report. Responsibility of auditor simply comply whether company comply with all these requirements. What do you mean by senior management? Senior management means all the core people, all core. Definition of senior management means all persons in core management and exclude board of directors and include following. Everyone who is there in key decision making, they are called as senior management. Generally, it excludes following. It excludes BOD members. Exclude BOD members are different altogether. Their responsibilities are different. So when we talk about senior management, everyone other than board, CEO and manager, they may not be directors. So they will come in senior management. Below that, CFO. Below that, CS. All members one level below MD, directors and CEO manager, all of them will be senior management. Quickly, it will exclude all the board members because their level is altogether different. It will include CEOs, below that CFOs, below that CS, below that all members one level below. So this was requirement. What is the case? Case is the composition of senior management since there is no change in composition. The previous year affirmations may be considered as valid. Is contention correct? So they are saying during the year there is no change in composition. Because there is no change in composition, we gave the affirmations in the previous year. Use that only. No need to get separate affirmations. Absolutely wrong. Affirmations should be taken every year. It's an annual activity. even if there is no change, even if there is a no change in board of directors, even if there is a no change in board of directors, affirmation should be there every year. So that is where they went wrong. You cannot use previous year affirmation. Every year new affirmation, every year new declaration in annual report. Now, if member of board is, then will come in board of directors. He will not come in senior management. Yes, yes. See, corporate world is very intelligent and they're very political. They wanted to give all responsibility but not the authority. So they developed a new post, CEO. CEO means generally he's CEO, Chief Executive Officer. He's officer, but he's not a director, generally speaking. Generally, CEOs are not directors, but not necessarily. It may happen in some companies. CEO is a director also. But the point is why this post was developed. This post was developed if you want to appoint any person as CEO and don't want to make him director. Same with CFO. You want to make someone in charge of finance and don't want to make him director. So the name is CFO. Correct? So they are different level of fooling. Then they have COO. Nowadays, big Chief Operating Officer, Management Officer. And now the biggest fraud is Vice President. Nowadays, companies are having thousands of Vice Presidents. Vice President is supposed to be a person just below President. And generally supposed to be person next to President. But then company there are 1000 Vice Presidents. Correct? So every region, every department, everywhere, the person will become Vice President, will become VP. Now, next is POSH Act. So if a woman is harassed at a workplace, then POSH Act will get applied. It's a study material question. POSH Act. How POSH? Don't apply brains. So prevention, prohibition and redressal. Genuine Limited has established internal complaints committee under sexual harassment of women at workplace. So POSH means prevention of sexual harassment. Prevention of sexual harassment, POSH Act. And so there is a committee. If any complaint is there for sexual harassment, the details, names, email address and contact number of the committee members are available on company's intranet. So there's an internal network on which the details are available. So if anyone is facing sexual harassment, they are supposed to complain. Correct? Now it's only for women, not men. Correct? Women include men. Generally, he includes she as a, but this is not the case here. However, no disclosure regarding number of complaints pertaining to sexual harassment of women at workplace being made. No disclosures are made. Are the measures taken by company adequate? A very simple answer. In every year in annual report, you need to give disclosures. Number of complaints received, number of complaints disposed, and number of complaints pending in annual report. Which page? 55. 55. Every year in annual report, you are supposed to explain number of complaints filed, number of complaints disposed, and number of complaints pending. They gave details of the committee on the intranet, but they didn't give details of complaints in annual report. It's a non-compliance of LODR. A very simple question, non-compliance of LODR. नहीं, नीचे का जरूरत भी नहीं है, सिर्फ चार्ट देखो, नीचे वही दिया है. That is in sentence form only. That is in sentence form. It is Bhaskar book. There is chart, text, chart, text, chart, text, chart, text. Okay. Now, POSH is vigil mechanism. No, vigil mechanism is different. Sexual harassment is different. Vigil mechanism is different. Okay. Again, give me page number. Obligation of BOD. Obligation of BOD. 53. Okay. Now, obligation of board of directors and others. Again, an interesting portion where case studies are asked. So we have divided it. First, obligation of BOD. Next, obligation of independent directors. Next, obligation of directors, and then senior management. It's in a sequence. The biggest is BOD. Below that, independent. Below that, director. Below that, senior management. Now let's see. What is obligation of board of directors? Number one, compliance. Review compliance report of all laws applicable to listed entity, as well as step taken by listed entity to rectify instances of non-compliance. Very simple. It is responsibility of board of directors, most importantly is law, to see report whether company is complying with all laws, rules and regulations. So they will get a report in their hand by legal department. These are the laws companies complying with. These are the laws didn't comply with. This is rectification. It is their responsibility to review this compliance report and see if by any chance there is a non-compliance where rectifications are done. Next, so their first responsibility to ensure compliance of law. Their first responsibility is compliance of law. Next is meetings. Very simple. They have to meet 4 times in a year. They have to meet 4 times in a year. Gap should not be more than 120 days. It is same as audit committee. Then quorum should be 1/3 or 3 members. It is more than audit committee. Audit committee was 1/3 or 2 and minimum 2 independent directors. Here it is 1/3 or 3, whichever is higher with 1 independent director. So one condition is more, one condition is less. Always compare and say these small things. So they will remember, okay, in BOD there is one extra condition and one less condition. But quorum is only for top 2000. Top 2000 only, not for everyone. Generally they say that it is in top 2000. So first ensure law compliance, then meet regularly with proper quorum. Then next, succession plan. There should be a proper succession plan. You should keep track when particular directors are going to retire and who will take their step. People should be identified. They should be identified. They should be trained. They can be informed so that they become ready. So that they become ready for the succession, ready for the responsibilities. So first is responsibility of board of directors. Ensure legal compliances, meet regularly with proper quorum, and ensure succession. Three things. Next is independent director requirement. At least one meeting, independent director, at least one meeting of only independent director without presence of other members of the board. At least have one meeting where there are only independent directors, no other members of the board, and all independent directors should try to attend it. Second, so you meet, at least have one meeting where there are only independent directors are there. Will they be liable for the acts? If it's very simple, if the decisions have occurred with their knowledge, if they were aware what company is doing, what board of directors are doing, they had complete knowledge about it, they said yes to it, they had knowledge about it, they said yes to it, consent, or they with their connivance means secretly allow things. If it is proved that they had complete knowledge about it, it has happened with their consent, or their approval was taken secretly, then they will be responsible. You were aware about the frauds taking in the company, you are aware about the illegal activities happening in the company, and you agreed to it, you will be held responsible. Next, you were not careful, you were not diligent, you didn't attend meetings, you didn't read minutes, you didn't take any interest in what is happening, again you will be held responsible. So if you were aware, you are responsible. If you were careless, you are responsible. Meet regularly, meet once in a year, only independent. You will be liable for the act if you were aware or if you are careless. And next, there is a new thing which was added last attempt. D&O insurance. What is D&O insurance? Director and officer insurance. It's a very simple thing. It is an insurance to cover personal liability arising due to wrong act of director or officer while managing company. For example, so it's very simple. If any director or officer makes any wrong thing, any wrong statement, or does anything wrong, personal liability may come on him. To protect him, to protect directors and officers, company may take director and officer insurance. Even if they do something wrong, they are liable to pay penalties, but then there's an insurance policy which will pay on their behalf and they will be saved. Applicable to top 1000 companies and HVDs. Mandatory. It is mandatory for top 1000 companies and HVDs to have an insurance policy, and that is D&O insurance policy. Protect your directors and protect your officers. For whom? For all independent directors. Quantum and risk will be determined by BOD. Quantum and risk will be determined by BOD. How big will that be policy and what things will be covered will be decided by BOD. Yes, of course. Premium will be borne by company. No, if you don't take it that way, take it this way, that become independent director without any fear. Premium amount will be borne by company. Yeah, company only. So it is responsibility of the company that for all independent directors, they should take D&O insurance policy only to top 1000 companies and HVDs. Next is, so first, at least meet once and be careful. And when you meet, be careful. If anything illegal is happening, don't be careless. Have insurance. And next is, there's an amendment here also, time to replace independent director. If any independent director is resigned or removed within 3 months. Earlier it was within 3 months or immediately next. Now they have done it within 3 months, straight away. Not next meeting, which is later. No. Within 3 months. replacement should happen within 3 months, not whichever is later. So earlier more time was there, now only 3 months are there. So first there was requirement for BOD. 3 requirements for BOD. Compliance of law, meet regularly with quorum and succession. Independent director, again, meet once. In meeting, be careful, don't be careless. There will be insurance for you, don't worry. And you should be replaced within 3 months if there is a removal. Now this is most important cases on this. A director can become maximum limit for membership and chairmanship. Can become member for maximum 10 committees and can become chairperson for maximum 5 committees. When you count committees, count only 2 committees. Audit committee and stakeholder committee. Count only 2 committees, audit committee and stakeholder committee. Only 2 committees should be counted. And when you count, consider all public companies, not listed. Listed or unlisted, consider all public companies. Now these are again weird. Generally LODR is for listed. But now here for counting they say count all public company, listed or unlisted. Okay. Who will be excluded? No need to count foreign companies, HVDs, private companies, Section 8 companies. Foreign company, if you are involved in foreign companies, will not be counted. HVDs will not be counted. Private companies will not be counted. Section 8 company will not be counted. Listen, if you are public company by any chance, you will be counted. No exclusion can help you. Exclusions are of clarificatory nature. That okay, only being foreign company, Section 8, HVDs will not be there. Senior management shall disclose to board all material, financial and commercial transaction where there is a conflict of interest. If a person is also having some benefits or rights or interest in another company with whom company is dealing, that is called conflict of interest. You are director also, you are a senior management person here and you are director somewhere else. When both the companies deal, that is called conflict of interest. So give all the details quickly. There are requirement for board, requirement for independent director, requirement for directors. That's only one requirement, that is maximum number of membership and maximum number of chairmanship. And then finally senior management, give information about conflict of interest. Now listen, let's see, this is in study material also, is dying to come again. 10 directors are there and a non-executive director is a chairman. There are 10 directors and non-executive person is a chairman. Let's see, 5 meetings during the year, absolutely fine. If you are having 5 meetings in a year, that's really great. That's great. Gap should not be more than 120. So if you see April to June, it is less than 4 months. Absolutely fine. June to September, October, less than, see 120 days is 4 months. 1st April to 1st June, okay. 1st June to 1st September, okay. September to Jan, October, November, December, sorry, September, October, November, December, there's a problem there. So 124 days is the gap. That's a non-compliance. So that's a non-compliance. 4 independent director, one of them resigned. A new independent director was appointed on 1st of September 17. First of all, 4 independent. Chairman is non-executive director. So 1/3 of the members should be independent. 1/3 of 10 is 3.33. That is 4. 4 requirement is fulfilled. But then one independent director resigned on 25th of May. June, July, August. Person should have been appointed by 25th of August. Not appointed, then it is a non-compliance. Chairman of Audit Committee did not attend. Wrong. Chairman should be independent director and he should attend AGM. Internal audit report was obtained by audit committee on quarterly basis. Quarter 1 internal audit report commented on certain serious irregularities regards electronic online auction of scrap. The agenda of audit committee did not deliberate on it. Wrong. We have seen mandatory review points. All the internal control weaknesses either informed by statutory auditor or informed by internal auditor, they should be reviewed. How come we are not discussing this? They should be discussed. Again, it's wrong. No woman director. Every company there should be one woman director. So all non-compliant, only one compliance. Independent directors are fine. Okay, now next is again very important 434.250. Listen. Okay. So there is a concept of material subsidiary. There is a concept of material subsidiary and there is a definition of material subsidiary. There are two definitions. Any material subsidiary which contributes 10% or more of consolidated net worth or consolidated revenue, they will be called as material. There is one more definition, which contribute 20% or more will be considered as material subsidiary. Now listen. The generic definition which will be applied everywhere is 10% or more. But there is one requirement that independent director of holding company should become director at material unlisted company. Only for that requirement is 20%. Once again, if you want to treat any subsidiary as a material subsidiary, the requirement is contributing 10% or more of net worth or 10% or more of revenue. But for independent director to become director of the material unlisted subsidiary, requirement is 20% or more. And the same thing is there, complete thing is discussed. Two cases are there on that. So it is in mock test paper. What is there are two subsidiaries, Bus and Robus. Bus and Robus both are unlisted subsidiaries. And the consolidated net worth is 350 crores. Bus is having net worth of 36 and Robus is having 80. So one is contributing around 10%, another is contributing 20%. One is contributing 10% plus, another is contributing 20% plus. What is, on observing this fact, your senior manager advises you to inform to make certain changes in board of directors of both the subsidiaries in accordance with LODR. So there are two subsidiaries and what they are saying? Board of directors of both the subsidiaries should be changed. So we'll say answer is no. There are two, we'll say that, okay, there are two definitions of material subsidiary. In general, the definition is 10%. But independent director should become director. It is only 20%. Only one subsidiary is fulfilling that condition. Only one subsidiary is fulfilling that condition. So only in case of Robust Limited, board will be changed. There will be some changes in the board. At least one independent director of holding company should become director and robust limited. Is this point clear? So the contention was wrong, not both, only robust. This point is clear. May 21 mock, a very simple question, straightforward question. See, audit is not a very difficult subject. It's voluminous. So if someone makes you study it anyhow, whether you want to study or you don't want to study, that is the only way you can become comfortable with this subject. If you leave it to your option, correct, then it is difficult. But if someone makes it mandatory for you, then it is fine. Again, May 21 mock. So they are in love with this concept. In May 21 mock also. Quickly, May 21 mock. It's a listed entity and details are given for 5 out of 7 components. Components means subsidiaries. So total income 300, total net worth 800. And then incomes and net worth of the components. What do you mean by components? Subsidiaries are components. Okay. Then they further explain two components F and G were unaudited. F is material, G is not material. This fact has been discussed in writing with TCWG. In writing with TCWG, and it will become part of key audit matter. Okay, key audit matter also they are saying, we'll put it there. So the question is, which of the components can be termed as material subsidiary? And next, in which subsidiaries one independent director should become director? It's simple. So we have to make a table. So we have to make a table. Percentage contribution. What is percentage contribution in income and what is percentage contribution in net worth? If any of this crosses 10%, it will be called as material subsidiary. And if any of this crosses 20%, independent director should become director. So see, a very simple table will be made. A, B, C, D. A is a material, C is a material, D is material. So ACD will be considered as material subsidiaries. But 20% criteria is fulfilled only in C and D. ACD will be considered material and only 2 are considered material for independent director. Okay, is this point clear? Now next question is, you got this point?
Yes, sir.
Okay. Next concept is, two of the subsidiaries are unaudited. What will happen? So it's very simple, guys. Listen. If, as per, we study this in chapter of consolidation. If a subsidiary is unaudited and if it is an immaterial subsidiary, not a big enough, then we may give OMP. No need to modify. We may give OMP and explain that one of the small subsidiaries not audited. Generally, in Reliance, you get this OMP. In Reliance, you get this OMP that one of the joint venture, one of the associate, one of the joint venture is not audited. It's a small thing for them. So they put a OMP. But if a material subsidiary is unaudited, you have to modify the opinion. You may qualify and if required, you may give disclaimer if it's a very big thing. So for immaterial, you may put OMP. No need to modify. If a material subsidiary is unaudited, you will have to modify, give qualification or give disclaimer. Now they are saying that it is discussed with TCWG. Fine. All important findings should be discussed with TCWG. That discussion is fine. And they are planning to include it in key audit matter. Now listen, when we come to that, we'll discuss. If any matter is become eligible for modification also and for key audit matter also. What is key audit matter? During the audit, if you have applied lot of time and resources on any matter, you have given lot of time and lot of resources on any matter, that is called key audit matter. That is called matter of most significance. So if any matter becomes eligible for both, who will win? Modification. You will write in modification and you will write one line in key audit matter. That matter given in basis of modification section is also a key audit matter. So if they want to give a reference, that is absolutely fine. See what they say. First of all, they discuss all theory related to the above thing. And then they talk that all the components should be audited. If it is immaterial, what to do, and if it is material, what to do. And finally, so we have discussed, if it is immaterial, you may think of giving OMP. If it is material, you will have to modify. Always look for quantity also and qualitative factor. That means what is the nature of the problem. So what is the final conclusion? In case of component F, the auditor opinion consult in terms F is material, it should be modified. And in case of G, which is not material, you should put OMP, other matter paragraph. Very simple thing. Last, okay, vigil mechanism. Okay, this very simple. You are aware what is vigil mechanism? If any director, any employee wants to make a complaint that something wrong is going on in the company, he should get the opportunity to make complaint, and after making complaint, he should be protected. He should be protected. And that's why, so they say that if you want to make anonymous complaints, any complaints, detail of the chairman of the audit committee should be given. And after complaining, the person should be protected. He should not be removed from the job and so on. So the issue here is the information is on company's intranet, but as per LODR requirement, the complete details of the chairman of audit committee, if you want to make complaint, how to go about it and everything should be on the website and BOD report. Details of vigil mechanism should be on the website, and it should be also during the year, it should be on the website, end of the year, it should be on BOD report. So it is a non-compliance. This is a second case of intranet. First was that POSH Act. It's again very simple, quickly. It's a listed entity. Listed entity, one director of company is also chairman of stakeholder relation committee, was acting as an audit committee. What they are writing? One of the director of the company is also chairman of stakeholder relationship committee and acting as audit committee chairman in 4 other listed companies as well as one private company simultaneously. So we have discussed, you can be chairman in maximum 5. Maximum 5. And what will be counted? Public companies will be counted. So the person is chairman here and only 2 committees are counted, stakeholder and audit committee. So the person is chairman of stakeholder, that is 1 counting. An audit committee, 4 listed companies, it will be counted. So 1 plus 4, 5. And then one more private company that will not be counted. That will not be counted. So it is absolutely fine. Are you getting this point? Yes, no. Then nomination and remuneration committee consisted 6 members and they regularly met biannually. So institute said biannually means once in 2 years. So it's a non-compliance. It's a joke. It's a joke because biannually generally means twice in 2 times in a year. But then you stick to what? You stick to what institute says. Then risk management committee consisted 9 directors. Consisted 9 directors, out of which number of independent director is majority, but it was less than 2/3 of the total strength. Okay, so which committee? Risk management committee. It is the last committee, and in last committee, and they are saying that there are no outstanding superior, there is no outstanding superior right equity share. There are 9 directors, out of number of independent directors is majority. It is less than 2/3. Will that be fine? Listen, last committee was risk management committee, and in that we studied that majority of them should be board of directors. There was no there was condition with respect to independent director, but it was not that majority should be or 2/3 should be independent. So guys, this when it comes to committees, okay, you have to go through that chart on maybe daily basis, and last day before the exam you have to see that chart. All these are case studies from the study material itself. Come on, the last thing in the chapter, and very interesting and very important. Very interesting and very important. Listen. Okay. Anyone give me page number? 50? 56 column. First. 56 first column. It is circular on resignation. Circular on resignation of the auditor. So what they're saying, a very simple thing. If any person resigns within 45 days from the end of the quarter, so quarter has ended and person is resigning within 45 days, it is mandatory for him to give report on the quarter which is completed. Mandatory for him to give report on quarter which is completed. And if person resigns after 45 days, it is mandatory for him to give report on quarter which was completed, number one. It is mandatory for him to give report on the current quarter also, because major time of the current quarter is also over. You have already crossed 45 days of current quarter, so give report on current quarter also. Third, if you have given report on 3 quarters, first 3 quarters, it is mandatory to give report on last quarter, and it is mandatory to give annual audit report also. That's the most important thing. Now, see case study. (434.700). Last question, and it's an interesting one. It is in November 22 mock. November 21 mock. It is dying to come. Now listen. N Limited and O Limited. N Limited and O Limited are two companies. Both of them are listed. And what auditor is deciding? Due to personal commitment and increased workload, he has tendered his resignation in N Limited on 30th of Jan. On 30th Jan. On 30th Jan and asked company to appoint another auditor and to issue audit report for remaining quarter and financial year 2021 as a whole. But the management of the company did not accept the same. Let's evaluate. So it's a listed company. This circular is applicable. Circular is applicable to all the listed companies and its material subsidiaries also. Anyways. So he has already done audit of April, May, June, July, August, September, October, November. No, October, November, December is yet to do it. He is resigning on. He is resigning on 30th, 31st, okay, 30th January here. 30th Jan. Listen, he has given report on first two quarters. He is resigning after third quarter within 45 days. Within 45 days. He will have to do audit of. He will have to do audit of September, October, November, December. If you are resigning within 45 days from the end of quarter, after December quarter ended, he is resigning within 45 days, he will have to do audit of third quarter. And moment he signs third quarter, he has signed all the 3 quarters. He will have to sign fourth quarter as well. And he will have to sign annual financial statements also. Are you getting this point? Yes, no. So he cannot run away. He has tendered his resignation, but he cannot run away. He will have to do third quarter, and because he does third quarter, he has to do fourth quarter also and the year also. Very interesting, important. In next company, what happens? Wife borrowed sum of 5.85 lakhs from the company. In the other company, he wants to continue. But in one company, he tendered resignation, but he cannot run away. In other company, he wants to continue, but wife has taken loan of 5.85 lakhs. So he is disqualified. And in circular, it is written that if any auditor is disqualified, this circular is not applicable. If any auditor is disqualified, this circular is not applicable. You are no longer auditor of the company. You are out of the post of the auditor of the company. This circular will not get applicable. So disqualification is an easy escape. You get disqualified and your circular is no longer. But then it brings bad name to any auditor. That how careless he is, that he got disqualified. Okay. So guys, okay, take a break of 5 minutes. So we are through with all the standards, 3 chapters. We are through with the big one, corporate governance case studies. And now we have option to do some small chapters. Want to do some small chapters? Or you want to go for tax audit? Okay. No. Lot of what? Listen. Now, applicability of consolidation. It's very simple, straightforward, but then a lot of cases are asked on the same thing. Consolidation is applicable to all the companies. It's applicable to all the companies, listed, unlisted, public, private. All of them need to prepare consolidated financial statements. Even if there is subsidiary or associate or joint venture, if any type of component you are having, you need to prepare consolidated financial statements. Then there is an exemption in Companies Act. There is an exemption in Companies Act, and that is intermediate company. So if suppose A Limited is having subsidiary B, B is having C, B will be called intermediate subsidiary. If there is an intermediate subsidiary, it may be fully owned or it may be partially owned. Then that subsidiary will decide that, okay, we are an intermediate subsidiary. Our holding company A Limited is going to prepare consolidated financial statement A plus B plus C. In case of intermediate subsidiary may decide we don't want to prepare consolidated financial statements because our holding A will prepare and submit. So they will inform all the shareholders that we are planning not to make consolidated financial statements. If none of the shareholders object to it, then they are exempt. They don't need to prepare consolidated financial statements, provided their holding or ultimate holding should prepare and submit financial statements, and it should not be listed or in process of listing. So intermediate subsidiary can get the exemption if they inform all the shareholders about it and no one objects. That's a very simple exemption given in Companies Act. Now, Companies Act says that for consolidation you follow Schedule 3. You follow Schedule 3. Schedule 3 says that for consolidation you follow AS, Ind AS as the case may be. So ultimately, what is going to govern consolidation is AS or Ind AS as the case may be. And now, so listen, first you talk about applicability of Companies Act, then there is the exemption of Companies Act, then there are two exemption of AS 21, two exemption of AS 21 and three exemptions of Ind AS. Listen, come to question number 436.300. 436.300. Okay. It is there in the list. Yes, it is there in the list. 50% point. Quickly, it is mandatory to all. One exemption is in Companies Act and two exemptions are in accounting standards. If accounting standard is applicable to any company, there are two exemptions. Exemption number one, temporary holding. If you have held shares for temporary purpose, so in question they write it, shares are held as stock in trade, or shares are held for only 3 months, or there is an intention to sell shares within some time. If it is a temporary holding, no need to consolidate that subsidiary. It is an exemption. No need to consolidate that subsidiary. Next is, if there are restrictions, suppose subsidiary is in Ukraine or Iraq, Syria, where war is going on. Now it is not possible. It is not possible to get money from there. Repatriation is not allowed. So again, such subsidiaries should not be consolidated. If you cannot get financial benefit out of them, no need to consolidate them. So AS talks about two exemption, that is temporary holding exemption and no repatriation, again exemption. Ind AS talks about three exemptions. Ind AS talks about three exemption. One is investment entity. One is investment entity. So what is investment entity? Their basic business is to invest money. So if we have an entity, basic business to invest money, okay, again, they don't have to prepare consolidated financial statements. Next, same intermediary subsidiary, if conditions are satisfied, even they don't have to prepare consolidated financial statements. Third, employee benefit plan. Sir, so if there is a company which is running a employee benefit plan, they are running a pension fund, they are running a pension fund, gratuity fund, even those plans don't need to prepare consolidated financial statements. So it's very simple, guys. Investment entities don't need to prepare consolidated financial statement. Intermediary subsidiary don't need to prepare consolidated financial statement. Employed companies running employee benefit plans, they don't need to prepare consolidated financial statements. As a relaxation to the company, don't prepare it. Okay. Now, what game they played in between? It was a very famous question. They will ask always as per accounting standards. They will specify generally that explain as per accounting standards or explain as per Ind AS. So in between they played a game. So they will say it's an investment entity, and they will say answer as per accounting standards. So in accounting standard there is no exemption of investment entity. Intermediary subsidiary is fine, it is covered by Companies Act and employee benefit. So answer will be no exemption, or they will do reverse. They will say there is a temporary holding or there is a restriction on repatriation, and answer as per Ind AS. Again, these exemptions are not allowed. So one very popular case will be on applicability of consolidation. Okay. So if there is a question on applicability of consolidation, first to explain Companies Act, it is mandatory. Then you explain financial statement should be prepared mutatis mutandis on same lines as per Schedule 3, audit report also on same lines. Then you explain there is an exemption by Companies Act. Then you explain there is an exemption as per accounting standard if the case is on accounting standard. Then you explain exemption as per Ind AS if case is on Ind AS, and then you discuss the case and give conclusion. So it will be very important to understand whether the case is as per accounting standard or case is as per Ind AS. So if they are silent, you have to take assumption. Either you can say that we assume Ind AS is applicable and answer according to that, or you can explain both AS and Ind AS. So now this was the case 436. Shares are stock in trade. This question was repeated a lot of times. May 19 exam, November 19 exam. Sometimes this also happened. Same concept got repeated immediately in the next exam. Okay. But then it was having a twist. It was a temporary holding. So everyone thought there is a exemption as per accounting standards. But then they wrote their Ind AS. So temporary holding and repatriation, no exemption as per Ind AS. Consolidation will be done. That is where things went wrong. First explain Companies Act, then explain accounting standards, Ind AS, and then ultimate conclusion. Now same lines. This is very simple. It is as per accounting standards. See, many of the questions are coming from old course. So by default, they are applying accounting standard. Because in old course there was accounting standard. but then be careful. If they are silent, you should take appropriate assumption and answer as per appropriate assumption. It's a repetition about temporary holding. They will write stock in trade, or they will write that shares were sold. In some time, shares were sold, or subsequent disposal was done. All these are indicators of temporary holding. Shares were sold, subsequently they will be sold, so on. It's an indicator of temporary holding. In case of accounting standards, no consolidation will be done. Now, this is investment company. We have discussed, it is in November 22 RTP. November 22 RTP, we have already discussed whether investment company will get exemption. Yes. One more thing. Now there is no confusion. Exemptions are in Companies Act also, and exemptions are in standards also. If you get exemption anywhere, exemption will get applicable. No need to do consolidation. Okay. Some student used to have confusion earlier. Sir, but Companies Act is not giving exemption. How can accounting standard or Ind AS override law? It's not like that. Law itself is saying follow Schedule 3, and Schedule 3 is saying follow AS and Ind AS. So there is no contradiction. Everything is in line. If law itself is says follow AS or Ind AS. So exemption by AS and Ind AS are absolutely valid. Now, whenever there is an exemption, in notes to account, you should give list of the subsidiaries, entities which are not consolidated, and you should give reasons also why they are not consolidated. So in case of investment entity, no consolidation because exemption is given in Ind AS 110. But then you should write the reason why consolidation was not done in notes to accounts with list of the entities not consolidated. Okay. So let's freeze. We have discussed applicability. Basically, three types of exemption as per law, as per AS, as per Ind AS. Be careful while applying them. Next is, suppose there is a company where majority of the shares are held by one company. Suppose there is a company C Limited, and A Limited hold 60-70% of shares. But B Limited controls the board. So one entity has equity shares and one entity controls the board. What will happen with C? With whom they will get consolidated? With both. One is having control because of shareholding. Another is having control because of ability to control board. Entity will get consolidated with both the companies, A Limited as well as B Limited in general. Now, in this particular case, this very simple question, but definitely percentage holding will be used, will be whatever is the percentage. Now, in this they are saying that there is a company which hold only 10% of equity share, but they control board of directors. Will consolidation happen? Answer is yes. Consolidation will happen because of controlling board of directors. There is a control. And as an auditor, what will you do? This question has been asked in May 21 mock test paper. As an auditor, what will you do? First thing, there are very simple procedure. Obtain understanding. First, understand the whole group. First, understand how many companies are in the group, which is the parent company, which is the subsidiary companies, associate company, joint venture company. Understand the whole group in general. Understand, are they doing same business or different business? Understand what is the nature of accounting policy. Are they having harmonized accounting policy or different accounting policy? First thing is very simple. Understand the whole group, number of companies, relationship, what kind of business they do, and what kind of accounting policies they have. Next, after obtaining basic understanding, they are saying they are having control over the board. Get the documents which prove that there is a control over the board. There may be an agreement between company and a financial institution. Obtain an agreement. There may be agreement between company and technology provider. Get that agreement. Try to understand what is the reason for control over board. Is it an agreement with banks? Is it agreement with technology provider? Is it an agreement with some another company? Which agreement, which contract, which law gives power to control the board? Those documents should be taken, it should be read, it should be understood, and control should be confirmed. Okay. First obtain basic understanding of the group, then control. Then finally, once you do that, fine. You know that there are two types of adjustments in consolidation, that is permanent consolidation adjustment and current consolidation adjustments. There are two types of adjustments are done. Go and check both the types of adjustments, permanent and current. What do you mean Param consolidation adjustment? Adjustments which are done in the first year. Adjustments which are done in the first year and generally they don't change over a period of time. They are called permanent consolidation adjustment. And that simply means computation of goodwill or capital reserve. See, in FR, when we solve, we don't distinguish between permanent and current. But in practical life, we distinguish because goodwill and capital reserve, which is computed in the first year, generally remain same over a period of year. How you compute goodwill capital reserve? You take cost of capital. You take cost of capital. Then you adjust pre-acquisition dividend. Yes, no. You take cost of capital, you adjust pre-acquisition dividend, and then you can take pre-acquisition equity. That is called capital profits also. Pre-acquisition equity. Before acquisition, what was the equity of the subsidiary? Yes, no. That is adjusted. Holding company share, holding company's share is adjusted to cost of capital and you get goodwill or capital reserve. And minority share is collected and computed separate, minority share. Goodwill capital reserve is computed, minority share is computed. This is called permanent consolidation adjustment. This is generally done once in the first year and same is copy pasted, continued in the remaining years. So check permanent consolidation adjustment, check current consolidation adjustment. Every year you will adjust intercompany transaction. Every year will adjust intercompany balances. So check those. Then AS 18, listen, there are two notes on which there will be a big impact when consolidation happens. One is related party, and second is segment reporting. When you prepare consolidated financial statement, lot of related parties will get eliminated. Yes, no? You are combining 10 companies, now it's a one entity. Lot of related parties will be eliminated. Check that carefully as per AS 18 and 550. Next is segments will appear. Suppose holding company was doing only one business, cement manufacturing. Subsidiary is doing one more business, computer manufacturing. And now when they consolidate, if you are doing only one business, there is no segment reporting. But if you are doing two or more businesses, then there will be segment reporting. So many a times when you do consolidation, segment reporting is attracted. You have to give segment. Always remember two notes are most affected. One is related party and that is segment reporting. And finally, after doing all this, check whether financial statement is true and fair. It's very simple thing. First, obtain basic understanding. Then ensure there is a control. Consolidation should be done. Go and check adjustment, permanent and current. Two notes are getting affected. Related party and segment reporting. Finally, whether financial statement is true and fair. 438. We have discussed this. Adjustments which are done in the first year. Adjustments which are done in the first year, they are called as permanent consolidation adjustment. It basically includes computation of goodwill or capital reserve, and computing initial amount of minority interest. Initial amount. And then you explain that how you take cost of capital, how you adjust pre-acquisition dividend, how you adjust pre-acquisition reserves and share capital, and then you get goodwill or capital reserve and initial balance of minority interest. See, generally guys, you get these initial balances, goodwill capital reserve. Can you knock off goodwill capital reserve of different entities? Yes. As per as it is allowed, you can knock off. But then if you knock off, you have to give details in notes to accounts. So then you, so explain what do you mean by permanent adjustment? Explain how it includes two things, computation of goodwill capital reserve and initial amount of minority interest. Explain how it is computed. And then explain you can net off. But if you net off, you have to give details in notes to accounts. Now listen, current consolidation adjustments. Adjustments which you have to do every year. Adjustments which you have to do every year. They are called as current consolidation adjustment. Now listen guys, you can have one sequence. I am giving you, maybe later on you note it down. First, every year you may have to convert foreign subsidiaries into Indian currency. You have to do it every year. That is a current consolidation adjustment. First. Then after conversion, you have to do adjustments of GAAP. Subsidiaries are as per US GAAP and you are as per Ind AS. So you have to adjust the subsidiaries data to bring it in line with Ind AS. Wherever there is a mismatch. Yes, no. Then harmonization of accounting policy. They may be following one method, one policy, and you are following another. So you need to harmonize. You need to again do adjustment to bring its policy in line with parent every year. Then next, every year need to adjust intercompany sales and purchases. Every year need to adjust intercompany receivable and payable. Every year need to adjust stock reserve. Aware about stock reserve? Yes, no.
Yes.
If intercompany stock is not sold, then there is an unrealized profit. Every year you have to make that adjustment. Correct? And then they are talking one very interesting thing, but that is not in FR also. That is not in FR also. I don't know from which author they took. Everyone is aware about stock reserve? Yes, no. So basically what you do, you say that profit is unrealized. So you debit P&L and you create a stock reserve which is deducted from the inventory. P&L account debit, stock reserve account credit, this credit balance reduced from inventory. So when you debit P&L, are you getting tax deduction for it? Are you getting tax deduction for it?
No.
No.
Not
You are not getting, is income tax giving you tax deduction? No. It is not giving you tax deduction as on today. But in future this will be sold. In future whether these things will get reversed? Yes. Listen, you are debiting consol P&L, but you are not getting any deduction in current year. You are paying all the taxes. But you will, in tomorrow, this will get reversed. Tomorrow this will get reversed. Okay. So you have to make DTA, deferred tax asset. Whenever you book any expense and you are not getting its benefit in income tax, you make a DTA. Such adjustment you don't do in FR also, but they discuss this in audit. Anyways, finally, okay, sometimes dates don't match. Do you agree with this?
Yes.
Date of balance sheet date of parent is different and balance sheet date of subsidiary is different. For example, you are having balance sheet of 31st of March for parent, but you are having balance sheet of subsidiary of 31st of December. There is a gap of 3 months. How much gap is acceptable? 3 months. 3 months or 6 months?
Months.
3 months as per Ind AS. 3-month gap is acceptable. You will have to make adjustments. If any big transaction happens in subsidiary between Jan to March, you will have to take that effect. That is called subsequent events. So you have to do it every time. They all will come in consolidation, that they all will come in current consolidation adjustment. See how I remember, every year you bring back subsidiary from outside. So that is foreign currency adjustments. They need to do gap adjustments, then harmonization, then also time period. If time period doesn't match, those adjustments. Then every year knock off intercompany transaction. Every year knock off intercompany receivable and payable. Then every year knock off stock reserve, and every year to make DTA. If you try to remember in this sequence, you will remember current consolidation adjustments. Now listen, what is responsibility of parent? It is very simple. It is very simple, logical. It is responsibility of the parent is first to understand its whole group. Identify how many components are there. Identify relationship with components. How many subsidiaries, how many joint venture, how many associates. Then identify how they need to be consolidated. Some will be consolidated from line to line method. Yes, no. Some will consolidate from equity method and so on. Then inform all the subsidiaries. Everyone inform what information we want from them. We want balance. We want balance as on 1st of April for some. We want details from balance for date of acquisition balances. We need revaluation balances. We need stock reserve balances and so on. It is responsibility of the parent to inform everyone, collect the information, perform permanent adjustment, current adjustment, and prepare consolidated financial statements. In notes to accounts, keep 2 notes in mind, which related party note will get affected a lot. And second is segment reporting. Same things they've explained. Identify components, get information, perform conversions, harmonization, include financial statement, do consolidation adjustments, and take care of 2 notes. .500. See, the small chapters can come for 4 to 6 months. Can come. No. In FADU chart book is not having 5 chapters. It is not having console. It is not having NBFC. It is not having bank. It is not having insurance and AAE. Audit in automated environment. Now listen. It is in November 22 mock. Suppose auditor of subsidiary company modifies opinion whether, see, audit report of subsidiaries will be read by auditor of the parent company. So he knows that there is a modification. Will he include that modification in his report? Okay, so listen carefully. You should give reference of, first of all, when you deal with components audit report, there are 2 things important. One is SA 600 and next is guidance note on consolidation. So there are 2 standard, SA 600 and next is guidance note on consolidation. And then you explain that whenever consolidation is done, we need to compute a new maturity level for the group. We need to compute new maturity for the group, maturity that is called group level materiality. This materiality is very important. First important use is decide scope. Which subsidiaries we should focus on and which subsidiaries we should not focus on is decided on the basis of this group level materiality. First use. Second use, when you have to check consolidation adjustments, if you get any misstatement, whether this misstatement is material or not, that will be based on this group level materiality. Third, whether to include any modification or not, that depends on group level materiality. If as per group level materiality it is material, we will include it in our audit report. Otherwise, we will not include it in our audit report. Is this point clear? So you explain that you need to compute group level materiality, and as per group level materiality you have to decide these things. You give as reference of SS 600 and guidance note on consolidation, compute maturity for group as a whole, use it to determine whether components are material. Principal auditor should also compute component level materiality and give advisory that listen, use this materiality while doing audit. For each component also, and inform them. Ensure that component auditors are independent. They are in following fundamental principles. Now, concept of materiality will be used whether to include EMP, OMP and modification. You cannot simply ignore. See if it is material, include it. If it is not, leave it. Okay. Clause 21 of CARO is different. What is clause 21 of CARO? Okay. First of all, CARO is not applicable to audit report of consolidated financial statements. That is a general statement. But 20 clauses are written in audit report of standalone financial statement. There is only one clause which goes in audit report of consolidated financial statement, that is 21. So you can call it as a exception. And what you write there? If there is a adverse reporting in CARO clauses across the group, then you write name of the company. Okay, this is the parent, this is the subsidiary, this is the associate, this is the joint venture, and in their CARO report, clause number so and so, clause number so and so, clause number so and so is having adverse comment. Once again, clause number 21 is applicable only to audit report of consolidated financial statements. Consolidated financial statements. Okay, and in that you give list. These are the names of the company. In their CARO report, these are the clause numbers which are having adverse comment. You give only those details. You don't give details of types of opinion. You give details only when in CARO there is a adverse reporting. Finally, last question, May 22 RTPT is asked, and it's important. This question on reporting. There's a question on reporting. What is this question? Listen. See, different 5 situations are possible. Number 1, auditor of the parent company and auditor of the group company is same. Auditor of parent and auditor of subsidiaries same. This is one situation. Then the second situation is both are different. Third situation, FRF followed by the parent and FRF followed by the subsidiary, it is different. Fourth situation, standards on auditing followed by the parent and standards on auditing followed by the subsidiary is auditor is different. And fifth, when subsidiaries are not audited. Let's understand. It's very simple. First, auditor of the parent company, auditor of the parent company and auditor of the subsidiary company, both are same. What will happen? You will prepare very simple, straightforward audit report. Nothing new will be incorporated. If everything is fine, you will give clean report, financial statement view true and fair view. If something is wrong, you will give modified opinion. There will not be any change in the regular audit report. All the elements will come as it is and you may give unmodified or modified opinion. Next, both are different. What will happen? If auditor of subsidiary company, if auditor of subsidiary company is different, okay, then in that case, you need to explain that auditor of component is different. You need to put OMP, other matter paragraph. You need to explain these are the 3 subsidiaries, these are the 4 subsidiaries, they are not audited by me, they are audited by someone else. And need to quantify. This is their total revenue, this is their total cash flow, this is their total assets. Either quantify in amount or quantify in percentage. Okay, so if some components are not audited by you, you should express it in your audit report. This is called division of responsibility. Clearly divide the responsibility. So many things are not audited by me, they are audited by someone else. Hit OMP. Now, next is, this is interesting, FRF is different. 2 options are available. If FRF is different, 2 options are available. First, option number 1, financial reporting framework is different. So first option is, see, our subsidiaries in Australia. So you call for option number 1, you call for the financial statements. In India, you convert it into rupees first. Then you make adjustments. Then you make adjustments for gap because they are following different gap and you are following different gap. Then you do gap adjustments. Then you do harmonization. Then you do time adjustments. Then you prepare revised financial statements of the subsidiary. Parent is doing all the hard work and parent auditor will check all of them. Parent will do all the hard work. Parent auditor will check everything. Okay, this is option number 1. Option number 2, you instruct Australian company, listen, you only prepare revised financial statement, you only convert it into rupees, you only do gap adjustments, you only do harmonization, you only do time adjustment, and ask your auditor to audit all of them and send audit report to us. We will only check consolidation things, that's it. Listen guys, so it is, they are giving, not, this is not reporting exactly, they are giving solution. If financial reporting framework of parent and financial reporting framework of auditor is different, either we do all the hard work and our auditor does the audit, or they do all the hard work and their auditor does the audit. These 2 options are available. So next is, auditing framework is different. We are following standards on auditing issued by ICAI and they are following auditing standards issued by Australian Institute. What will happen? We will instruct them, listen, parent company's audit report is as per standards on auditing issued by ICAI. You perform audit as per Australian standard as well as Indian standards. Perform and see, many times it will be same. All the standards are almost same. You perform audit and give report as per Indian standards followed by the auditor of holding company. If you do that, we accept your audit report. If you don't do that, we don't accept your audit report. We will consider component as unaudited. So you make a proper audit report as per our standards. This point clear? Make as per our standard, we accept it. You don't make it, we don't accept it. Last, if any of the component is immaterial, is unaudited, then if it is immaterial, we may put OMP, other matter paragraph. And if it is material, we will modify the opinion. If a material subsidiary is unaudited, that is unacceptable. We will qualify. Okay. So guys, we are through with one more chapter. That was a small one. Okay. I will discuss shortcut to remember clauses of Caro. See, we have prepared wonderful shortcut to remember 21 clauses of Caro and then to remember 34 clauses of PE and then to remember 54 clauses of 50, sorry, not 50, 50 clauses of tax audit. And they all are based on one technique, and that is called as image recognition technique. So if you use that technique, it will be easy to remember the clauses. Okay. Come to page number 41. Come to page number 41. So unless, so it's a well proven fact that we remember images much more than text. We remember images much more than text. Like you will remember face of people, correct? But then you may not remember the name. That generally happens with me. Okay. You know, so like you meet me after 6 months, I will think, oh, we were there in Hyderabad class. That will be fine. But then name, I may not remember. Okay. That's fine. So when you meet me, sir, my name is so and so. I was there in your class. Okay, okay, correct. You were there. Okay. Now, quickly. So it's a very simple shortcut. How many clauses are there? 21. So we have divided it in three parts. 7, 7, 7. So for memory, the best rule is divide and rule. You have to divide it. And we have make a very simple situation. Okay. So who will be in the situation? What's your name? Akhil. So Akhil. So the situation is Akhil has become chartered accountant. Sir. Okay. So now remember these images. Remember these images. So first is yellow color icon, that is which Flipkart. So he goes and does all the shopping at Flipkart. Then next you see an aircraft, that is Indian Airlines. Indian Airlines. Now he says that I am a CA, I will fly. He will fly. Okay. To various metros, he has booked tickets. Next, now he is going to various locations. Whom to contact in these locations? So we went to the next website, that is LinkedIn. Next website, that is LinkedIn. He goes to LinkedIn, whom to contact. blue color logo. These images are important. Then, so he makes list of the people to contact. Finally, he drafts live.com is the email service. So colorful logo live.com. He drafts email and he gets documents from Dropbox. Dropbox is a cloud service. He gets documents from there and he sends mail to everyone. After that, so he's ready. So then he says, CA taught me a lot of things, but it didn't teach me one thing, current affairs. Correct? No current affairs, no affairs. CA debit, everything else, credit. No time for anything. Okay. Okay, okay, fine. Okay, fine. Now, come back. Next, so before going to for interviews, he sits on his laptop, opens CNN, red color logo, CNN, and current affairs. Finally, he's relaxed. He is on the airport, relaxing. He opens Spotify and listens to music. 7 claws are done. First image is yellow color. Flip color is important. Yellow color, that is Flipkart. That is for fixed assets. Then there is a aircraft, Indian Airlines. That is for inventory. Then there is a blue color logo. That is LinkedIn. That is for loans given. You have to give details about loans given. Then there is a multicolor logo. That is live.com. That is loan under 185 and 186. So two loans clauses are connected. Then there is a blue color box, that is Dropbox, that is for deposits. And then you have CNN, red color CNN, that is for cost records. And then we have green color Spotify, that is for statutory dues. Now the point is, don't try to remember numbers. You will get confused. But if you remember images, so suppose there's a question on deposit, you should recollect image, blue box, 1, 2, 3, 4, 5. Clause number 5. Cost record, that is CNN. So it is second last, that is 6. That is the best way to remember. If you can recognize, if you can remember the images, numbers will come automatically. Okay. Next is companies. So now the interviews happen. Again, blue color logo, complete blue color logo, that is Tata Steel. Then it is blue and yellow. How interesting to know that people use a lot of blue color in their logos. Blue color is Tata Steel. And then you have blue and yellow, that is LIC. Then you have in which font will say uh, thin font, correct? Thin font. You have Infosys. I am used to talking in Hindi. I just say patla font hai. So it is a thin font, that is Infosys. Okay. Infosys. Then you have blue and black, that is Phenolics cable. Quickly. Blue Tata Steel. Then blue and yellow LIC. Then your thin font Infosys. Blue and black Phenolics cable. Then black and red Network 18. Then golden and black Reliance. Then orange and blue Indian Oil. Okay. Now recall the images once again. Tata Steel. You have to comment on transactions, unrecorded transactions. Then after that, blue and yellow LIC, you have to comment on loan repayment. Loan repayment. Then Infosys, you have to comment on IPO, FPO, whether IPO, FPO money is IPO, FPO private placement money is properly used. After Infosys, there is blue and black. Blue and black is Phenolics cable, that is fraud. So these are 4 companies in line. And then blue and red Black and red, that is network 18, that is Nidhi companies. Golden and black, that is Reliance, that is related parties. And then Indian Oil, that is for internal auditing. Quickly. Tata Steel, that is for transactions. Then next is LIC, that is for loan repayment. Next is Infosys, that is for IPO, FPO, private placement money. Then you have Finolex, that is for fraud. Then Network 18, that is for Nidhi company. Then Reliance is for related party. And then finally, Indian Oil is for internal audit. So there were 7 websites. Then there are 7 companies. Now Akhil wants to eat something. Akhil wants to eat something. So we have Kaju Badam, that is almonds, cashew nuts, that is nuts. Kacha Badam, nuts. And then again some healthy thing, carrot, orange. Then chiku. What do you call chiku in sapota? Okay, this is chiku. Otherwise, shortcut won't match. Shortcut would match chiku. Then some things which are not good for health, rabdi. Then madira, and then chocolate. Finally, one superfood, avocado. So some good food, that is nuts. Nuts, you have to recall the image, guys. Moment you recall nuts, that is for non-cash transaction. Then you have carrot, that is for certificate of registration. You have to comment on certificate of registration in case of NBFCs. Then after that, you have chiku. You have to comment on cash losses, whether there are cash loss in the current year and previous year. After that, then you have rabdi, that is resignation. Resignation, you have to comment in case of resignation of statutory auditor. Then madira, material uncertainty. Correct. So there will be material uncertainty to comment on MU. So see, in going concern, why Caro? Because Caro gets applicable at a lot of places. So SA 570 going concern comes, you may write, but institute has till now, institute has never referred Caro clause, but you can refer. They may refer in future that whenever there is an issue of material uncertainty, they refer the Caro clause. Madira, material uncertainty. Then chocolate, that is for CSR. And finally, avocado, that is for adverse comment. So now material uncertainty. So when we talk about suppose there's a, so which clause, how to recall clause number? So we'll start first 7 is done, then 7 is done 14, then 15, 16, 17, 18, 19. 19 is Madira, that is material uncertainty. So this is how you can remember Caro clause. There is only one amendment in Companies Act. You all must be aware, small company. Check small company definition. Quickly check your FADU if whether that limit is updated. Small company, update it. It is now 4 and 40. Page number 40. Page number 40, last column. Small company limit is now 4 and 40. Okay. Now, in FADU session, which I do, I cover important clauses. So I cover important clauses there. So we can have important clauses from that session only. Let's do one more small chapter. So we are through with first 3 chapters of standards. Then we are through with corporate governance, consolidation. We are through with company audit also. So the company audit, Caro is part of company audit. Yeah. See, the tax audit will not get over in half an hour. I will also not get over. Liabilities of auditor. Okay. Listen, guys. So, uh, Hall. Now, now in this chapter we discuss punishments which a chartered accountant may face in different acts. Definitely, it is not exhaustive list. They have given some limited lists. They are given some lists from the Companies Act where punishment will come on chartered accountant. Then some list in Income Tax Act where punishment will come on chartered accountants. Okay. So they have divided the punishments in two parts. When it comes to, let's understand, in liability of auditor, first they discuss various liabilities which may come on chartered accountant under different sections of Companies Act. It is divided into two parts: criminal liabilities and civil liabilities. So if punishment is just monetary, that is civil liability. And if punishment includes going to jail, imprisonment, that is a criminal liability. Now listen, guys, except those 5 chapters, and again, I I was waiting for the new course, otherwise I would have completed it. Anyways, these charts will be very, very helpful. So if you go to chart book, you will get very well drafted charts for all the chapters. And first we'll discuss civil liability. It's very simple and straightforward. Let's understand. So there is section 35. There is section 35 of Companies Act which says that first it gives situation. If any person has invested in securities of the company, subscribes to the securities of the company, and he subscribed it on the basis of false information, misleading information, and subsequently he loses money. The situation is person has invested money in securities of the company on the basis of false and misleading information, and subsequently he loses his money. Then point number 2, then in this case, point number 2, there will be liability. There will be liability to compensate each and every person who suffered the loss. So monetary amount should be compensated to each and every person who suffered the loss, irrespective of what is written in section 36. So section 36 is again a punishment, a liability for basically brokers. If brokers did something wrong, it's punishment for them. So irrespective of what is in section 36. Now the question is on whom this liability is. So first you should know this is the situation. Liability is to compensate each and every person. And the point is who will be liable to pay this compensation. First of all, company. It will be a joint and several responsibility of first company. So they cover everyone, company, and after that, who is big thing is company, and then promoter of the company. So it's in a sequence, descending sequence. Biggest company, below that promoter, below that person who is director at the time of issue. Person who is director at the time of issue. Then person who agreed to become director. This is called to be director. Who said that, okay, I am busy right now, but I will become director. Agreed to become director of the company after few months, after 2 months, 3 months, and you can include my name that I will become director in future. Person who agreed to become director, to be director. The person is called to be director. All the authorizers, all those who sign prospectus, okay, generally directors only sign, but sometimes generally include directors, but sometimes selling shareholders. Who? Selling shareholder. You all know when public issue comes, uh, public issue offer for sale. When public issue comes, suppose public issue is for 5 lakh shares. 3 lakh shares company is going to issue new shares, and 2 lakh shares old investors are going to sell. So they are called selling shareholders. They also put their signature on the prospectus. They are also called authorizers. Apart from that, all the experts whose reports, whose valuation are included in prospectus and they have given consent. Yes, you can include my name. You can include my name, my reports, my valuation. So CA will be covered here. Generally, CA will get covered here. Once again, who will be responsible? Company. Below that, promoter. Below that, director. Below that, to be director. Below that, authorizer. Below that, all the experts whose reports or whose valuation is included, and he has given consent that include my name. So section 35 covers everyone. Section 35 covers everyone and makes everyone responsible to pay for it. Then it talks about exception. So they give a small, one by one they give exemptions. So first exemption is to be director. Suppose to be director agreed for it, okay, I will become director, but he withdraws, I don't want to become director. He says, withdraws his consent, I don't want to become director before issue of prospectus. If he has withdrawn his consent before issue of prospectus, okay, and prospectus with his name was issued without his consent, without his authority, then in that case he will be saved. So to save himself, he should prove that he has withdrawn his consent and prospectus with his name was issued without his consent and authority. So if he proves these two things, he will be saved. Next is if anyone proves that prospectus was issued without his knowledge or consent, if anyone says that my name was included, things were included in my name, but no consent was taken from me, but he wants to protect himself, as soon as he comes to know that his name is included, he should give public notice. He should put it in the newspaper that, see, one of the prospectus is issued with my name and details, but my consent was not taken. So if anyone wants its protection, they should give public notice. So to be director should prove two things. Anyone else wants to protect themselves, they should give public notice and protect themselves. Third, if anyone proves that, see, my name is there in prospectus, I understand, and I have said few things I understand, but I have said this on the basis of report given by expert. I relied fully on the expert. I never had any doubt on expert. I relied on expert. I never had any suspicion on expert. I am not aware that expert has withdrawn his report. I have I have acted in good faith. Then in that case, he will be relieved. And who will be responsible? Expert will be responsible. So if you want to save yourself, there are three exceptions. One is to be directors can save themselves. People who have given public notice can save themselves. And third, people who relied on expert can save themselves. So three. Now next is, so that was exception is subsection 2. Subsection 3. Subsection 3, what is this now? If it is proved that prospectus is issued with intent to defraud, that means the whole thing is bogus. The basic intention to issue prospectus was to defraud people. They all are working together and trying to fool people. If it is proved that there are people who are working together and the sole intention was to defraud, then in this case, okay, everyone who is involved in this, even if they have given public notice, even if they say they relied on expert, even if they say I have withdrawn my consent, if it is proved that the whole game of prospectus was to defraud people, everyone involved in the fraud will be held responsible. They will not get relief under subsection 2. They will not get any kind. Every person specified in subsection 1 above shall be personally responsible without any limitation of liability, without any exception. So basically, your exceptions will be withdrawn and you will be personally liable to pay the compensation if it is proved that the whole scheme was framed to defraud people. There is no one or two things. The complete thing is fraud. Okay. In practical life, now see, this section makes everyone responsible. In practical life, generally, if in court people prove that whatever statement I made, I was honest, others made mistake, court generally doesn't impose liability on them. Court imposes liability only on people who made such statements in practical life. Let's read this. Now this is example of civil liability. Which section? 35. So first you explain situation, people losing money. They will arise liability to compensate and list of the people. Then subsection 2, exemption. First exemption is for to be director. Second, give public notice, save yourself if your consent was not. Third, relying on expert. If the whole thing is to defraud, everyone will be held responsible. You will not exemption under subsection 2. Okay. So it's a very famous question. How many times it has been asked? So many times. When was the last time it was asked? May 16 exams.
11 times.
So that's why it has come in important. It is long due. Long due. Next is criminal liability. Next is criminal liability. See, as per our important list, first question is of criminal liability. Again, it is since long it has been asked. Okay, there can be a MCQ on this. There can be MCQ on this civil liability and now criminal liability. For criminal liability, we have section 34. In fact, there are a lot of sections. There is section 34, There is section 140 subsection, this is in a sequence, section 34, then bigger than that, section 140 subsection 5, then bigger than that, section 448. Okay, and all these three sections say one thing only. So we have section 34. We have section 34. And what it says? If it again says, if something goes wrong, punishment will be as per 447. 145 also says, if something goes wrong, punishment will be as per section 447. 448 also says, if something goes wrong, punishment will be as per 447. And 447 has provision for imprisonment. So there are these three sections, they point out that punishment will be as per 447, and because it is having imprisonment, it becomes criminal liability. Now let's understand what section 34 says. It's very simple. If prospectus is having false information, misleading information, untrue information, or any important information is omitted, if any important information is omitted, okay, then in this case, everyone who has authorized, basically directors and selling shareholders, they will be punished as per 447. So understand one thing. See, 35 talks about compensation for loss. That is different. You will have to pay compensation under 35 and you will be additionally punished under 34. Both the sections will apply. You compensate people under 35 and you pay penalties under 34. Now, there are exception. Directors and selling shareholders, authorizers can save themselves if they prove that whatever information was misleading, whatever it was omission, it was immaterial. There was a spelling mistake in the name, immaterial. If they say that the information which was wrong is immaterial, they can protect themselves. Okay, something was wrong, but that is immaterial. Next, reasonable. If they say that, okay, yes, I have given a false information. Okay, we have signed on the prospectus, but we had reasonable grounds. We did it on the basis of documents and in good faith. We had enough evidence to assume that this information was correct. If they prove that they have acted in good faith on the basis of proper documents, again they can save themselves. Prove it is immaterial, save yourself. Prove you had documents on which basis you did this, save yourself. So two exemptions are there. That's very simple, section 34. So section 34 penalizes whom? Authorizers. And how many exemptions they have? Two exemptions they have. First, it is immaterial. Second, reasonable grounds. Now, we have section 140 subsection 5. What it says? Removal of auditor. Tribunal suo motu. Tribunal suo motu can start the proceedings. Start the proceedings means start the case. Tribunal suo motu can start the case, or they can, see, I consider tribunal as the highest. Then below that, central government can send application, or below that, any concerned person, either suo motu tribunal, below that central government, below that any concerned person, they can send an application to tribunal. Dear tribunal, we want to give you application and say that auditor is doing fraud. Auditor is doing fraud. Auditor is doing fraud, or there is a collusion between auditor and of director, officers, employees, or he is abetting. Abetting means encouraging. He is encouraging people in the company to do fraud. He himself is doing fraud, he is colluding with people, or he is abetting. Okay, then in this case, application is sent to tribunal that we feel this is happening and this is the proof. Tribunal will call for information. Tribunal will call for information, and if they are satisfied, yes, auditor is doing fraud, very bad, then little less collusion, little less encouraging. This is the case. First auditor will be changed. First punishment will be, they will say this auditor is removed, point new one. First punishment, he will be removed. Second punishment, he will not be eligible for appointment for next 5 years. Listen, existing assignments he will continue, but he won't be able to get appointed for next 5 years. Existing assignment will continue wherever he is. There's other misconduct. That's fine. If misconduct happens, that doesn't mean that he is no longer auditor. Correct? Okay. Now, then last, finally, see, he will be removed, point number 1. He cannot be appointed for 5 years, point number 2. He will be punished as per 447. Okay, so section 34 says punishment as per 447 for false misleading information. 145 also says punishment as per 447. In fact, 3 things. Change is first punishment, 5 years ban is second punishment, and 447 is third punishment. If central government has given application, decision should be taken within 15 days, and next right can be given to central government itself. Now next is 448. 448. Okay. What 448 says? In whole Companies Act, if you are submitting any document, about document is statement. If you are submitting any document or any statement or return or financial statement or certificate or report, see, even that is in sequence. Smaller thing is document, then statement, then return, then finance certificate or report, and you were aware there is a omission of important information or material misstatement, misleading information, and then also you submitted it, then also you gave these things, you will be punished as per 447. So criminal liability can arise under 34, under 140 subsection 5, or under 448. Okay, 444. See, this is the effect Zahir has. It increases your creativity. And this is the first time. Very good. 444. Correct. Yes. And 84 fraud. And I got it. 84. I also said 84 fraud reporting. Okay. So 4 is fraud. 240. 4 is fraud. So, bus enough. Huh? Now,
The section 34 में only authorized members are falling expensive.
he may be one of the authorizers. He may. Sir, I doubt that only authorizers. So CA basically not just auditor. They are talking about CA in general. So CA can play any role, and in any role he should be aware. So this information is given to you, so you are aware that, remember, if you're dealing with prospectus, be careful. You may be punished in 35 and 34. Huh? Your office is was working on one of the IPOs. Okay. Okay. So, and you made a prospectus. You guys made a prospectus. So if your office partners are signing it, correct, their reports and said they are covered under 34 and 35, you are saved. It yes.
Section 140
He can continue his appointment with other.
but in 141 qualification.
That is okay. Very good, sir. Section 141 subsection 3 says that if a court says that auditor has done fraud, then he is disqualified for 10 years. That is a conviction by court, and this is by tribunal. So there is a difference. Okay. Now let's see. 447 is very simple. It sets a limit. Limit is 10 lakhs or 1% of the total in turnover, which is lower. So limit is set on lower side, which is lower. Why lower side? So that people get bigger punishments, which is lower. If limit if you reach limit or exceed limit, imprisonment of minimum 6 months, and this will increase to 3 years if public interest is involved. Minimum 6 months, maximum 10 years. Then only people are little bit frightened. If it's only monetary for monetary amount, chartered accountants are not at all worried. We'll take loan and repay if required. Only thing is when it's imprisonment, minimum 6 months, which can increase to 3 years up to 10 years. And then fine, amount of fraud, minimum and maximum 3 times amount of fraud. See, you have to give back amount of fraud, and this is additional penalty apart from giving the money back. Amount of fraud and 3 times amount of fraud. Otherwise, people will get encouraged. Okay, I have just to give back. Fine. Next, if fraud is of less amount, go and check. If there is public interest. If there is no public interest, fraud is of low amount, no public interest also, imprisonment will be from nil to 5 years. Again 2 5s. And then fine is nil to 50 lakhs. It has reduced to 5 years and it is reduced to 50 lakhs. What if amount is low but public interest is involved? This will happen rarely. Amount is low but public interest is involved. Again, then higher imprisonment and fines will apply. This will happen rarely. Amount is low but public interest is involved. Again, the higher penalties and fine will get applicable. Okay. So listen guys, this time there was a case study. So this first question is criminal liability. We are through with that. There's a criminal liability. We are through with that. Then next, that is prospectus 35. We are through with that. 35 is civil liability and 34 is criminal liability. But most important thing is there is a case study. November 21 mock. First time they asked case study. What is the case study? And this question is not yet come in exam. So it becomes extremely important. What is it? As a part of listing process, prospectus was made and there was one pending litigation. There was one pending litigation. This was not disclosed in prospectus. Not disclosed in prospectus. They omitted this fact. This was omitted. Mr. K, who was well aware of this matter, had authorized himself to be named as to be director. He was all aware that there is something, they have omitted this, and he authorized to become to be director. Mr. K was little reluctant, so he informed and agreed that he shall become director after some interval of time. So he is not director, he is to be director. He is not director, he is to be director. Unfortunately, after few days, this matter got leaked and share prices tanked and investors incurred huge losses. Mr. K is now defending himself, stating that he is not a director, so no action should be taken against him. Okay, so this case is of two be director. So you need to invoke section 35. Section 35, explain that in short. And you need to explain all the theory, subsection 1, 2 and 3, and then you explain section 35 clearly covers people who have agreed to become director. They are called to be directors. Not just directors are covered, to be directors are also covered. Because to be directors are also covered, okay, you will be covered and you will be one of the party to pay compensation to all those who lost money. He cannot say that I won't be responsible. Section 35 covers you. So they are applying first section 35. In fact, 34 will also get applicable. Why? No.
For last one.
So okay, listen. So section 35, okay, listen. Section 448, listen. See, this person is to be director under section 35. So he will be punished. And further, we will apply 448. 440 is huge. Any document, any statement, any report, any certificate is submitted and person is aware that it is false, it is misleading. 448 says apply 447. So in this case, they have applied section 35 also, and as per section 448, what will apply? 447 also. So you'll get punishment. So basically 440 is big enough. It covers every damn thing. It covers every damn thing. So go to the court, punishment under 35 also, and punishment under 448 also. Yes. But see, I didn't write 30. They are not mentioning 34. It will be incorrect to mention 34 because so he may become authorizer also. If to be directors, generally directors sign, to be directors also sign. Okay, anyways, you write, you give reference of both section 34 and section 448. Section 34 covers all the authorizers. But listen, they are not talking specifically about to be directors. They are talking about authorizers. So you will have to say that he is one of the authorizer and you apply 34 also and then you apply 440. But ultimately both the sections say that punishment will be as per 447. No, this is not like that.
Because in criminal, all partners only signing for
But let's not segregate that way that one is applicable to firm and one is applicable to individual. Correct? So that understand that firm will not go to jail. But still. Okay, fine. Now, last thing for the day. Last thing for the day. So we'll be through with 7 chapters. Tomorrow we'll finish off remaining chapters. Correct? Now, liability under, so right now we discuss liability under Companies Act, civil liability and criminal liability. Now there is wonderful, again, liability under Income Tax Act. See, I'm in love with sequences, and now this new 444, 5, these things help to remember when in current situation exam, all these things help. Yes, there were 3 4s. Now, what was the 3 4? Think about it. 34, 140, and 447. Now, 448. Yeah. Now, there is rule 12A, then there is section 271J, 277, 278, and 288. So, there are 5. It's very simple. Not very simple. So many sections. You don't. It's very simple. There is rule 12A. Listen. Assessee can anytime appoint a representative that you prepare tax returns for me and you submit these returns to department. Now, rule 12A gives power to assessing officer that you can ask representative to appear before me. Okay. So, rule 12 is powerful. Rule 12A says, okay, client, you are asking client to appear, that is fine, but it powers them to call representatives also. So, chartered accountants will be covered here. So, chartered accountants who prepared return can be called for questioning by assessing officer under 12A. So, many times we listen to CS, we didn't sign return, but you prepared it. So, if it is proved that it is you prepared it, assessing officer can call you for questioning under rule 12A. Further, he can ask question, he can ask to submit either before or after appearing further details, particular of account, statement, other documents submitted by assessee to prepare. Assessing officer can call and ask questions. He can say, give us all the documents which assessee gave it to you. He can ask for documents. He can further ask, have you performed any examination? Did you examine any P&L, balance sheet, any statement? If yes, give that report also. Now, what is the situation? If authorized representative who is called under 12A makes false statements, whatever info, quickly, which rule gives power? 12A. To call whom? Representative for questioning and then for submitting documents or whatever examination. Whatever information representative gives is covered in section 277. So that basically is, we'll study 277. Basically, if representative makes any false statement, gives any false information, he will be punished as per the fines given in 277. And those punishments are, it can be fine and imprisonment up to 7 years. So this rule 12A is for all the representatives. Be careful. If assessing officer calls you, you give wrong information, you give wrong documents, you give wrong things, you will be punished as per 277. And in that, there can be imprisonment up to 7 years. Not just that, nowadays even CA final students, they make returns for side income. And if you're making false information, you may be called, and if you give wrong information, there can be imprisonment up to 7 years. But then practically such thing doesn't happen. Correct? Because what CA students generally play in lakhs, sometimes in crores. They are big fishes to catch. But anyways, representative can be punished for, sir, we'll have to discuss a lot of things about basics. Okay, that's a different question. That is moral issue, as we are paying taxes and you're punishing us. Okay, anyways. So it was taught to us in civics. All laws are applicable. We are supposed to follow any law. If it's non-compliance, we'll be punished. It's okay, sir. See, justice, injustice, keep it aside. You're not following law, you'll be punished. Fine. Listen, after, it's okay, sir. He got worried, I will be punished for 7 years. Now, section 271J, it says that if any accountant, bigger than accountant is merchant banker, bigger than merchant banker is registered banker. Any accountant or merchant banker who helps in IPO, FPO or registered banker furnishes false report certificate, furnishes report certificate and information is incorrect. It may be intentionally, it may be unintentionally. If you are giving any reports and certificate and it is having incorrect information, in this case, assessing officer or commissioner may ask him to pay sum of 10,000 for each report and certificate. Listen guys, it's a very small thing. So irrespective of whether the mistake was intentional or unintentional, if you are making wrong certificates and reports, they will be immediately attracting penalty of 10,000. See, all these are cumulative. Huh? You give false information, 12A will apply. 271J, 10,000 will also apply. But and further 277, 278 be applied if it is intentional. Let's see now finally 277, 278. It's very simple. If any person gives, any person give false information, situation, if any person makes reports or certificates after verification or gives any accounts or statement which he knew is false, any person is giving reports or certificates or giving any documents or statements and he knows that this information is false. Basically, this section is targeting chartered accountants. You are making false certificates and reports, giving false information, and you are aware that this information is false. This is very important. You are aware. So you can still protect yourself if you prove you are not aware. In fact, there is a question. There is a question that false documents. There is a question. Assessee gave documents to CA, and CA gave those documents to assessing officer, and those documents turned to be false. Will he be punished? So institute has said no. He was not aware. He was not aware information is false. If he is not aware information is false, he will not be punished. One more thing. Same case can be asked if they write as per Income Tax Act, it is a question of liability of auditor. And if they write as per CA Act, it is a question of professional ethics. Same question comes and last line changes. If they write Income Tax Act, this chapter will apply. If they write CA Act, professional ethics will apply. Okay, anyways, come back. If any false information, any document false information is given, be punishable. What is the punishment? Tax and penalty exceed 25 lakhs. Minimum 6 months, it is matching with 447. Minimum 6 months and maximum 7 years and fine. Fine amount is not given. No, if it is small, then minimum 3 months, not 3 years. Minimum 3 months and maximum 2 years. This is not matching. In 447 it is nil and 5. Here it is 3 months and 2 years. Sometimes you have to compare so that you remember in better manner. Okay guys, let's read. So basically if any person gives false reports and knowingly false reports and certificates, give any false information documents, he was aware it is false, he will be punished under 277. 278 copy paste. But here, if any person abets, encourages, pressurizes, induces, so CA himself is not giving false information, but is encouraging other to give false information. He is influencing other to give false information. He will be punished under 278. Yeah, punish penalty same. Don't write 277 penalty. Only for retention I have written the same. Or encourage anyone to evade taxes. So if chartered accountants are encouraging people to give false information or evade taxes, they will be covered in 278 and punishment remains same. Okay, so there are punishment of 4 sections till now. 12A, who will be punished? Representatives for giving false information. Then 271J, report certificates must be the same, intentionally or unintentionally. You knew that information is false. 277, punishment. What is the limit? 25 lakhs. 25 lakhs is the limit. Imprisonment up to 7 years. And if it is low, then 3 months and 2 years. And 270, if you are influencing others, then same punishment. Finally, 288. Now listen, 288 is not imposing any 288 is not imposing any penalty. Then what it is, sir? It is imposing disqualification. So punishments are not always same. Sometimes punishment can be in the form of disqualification. What 288 subsection 4 says, if any person is removed from government service, he is always disqualified. He cannot represent any person in income tax. Cannot represent any person in income tax. Are you getting this point? This is disqualification. This is disqualification to represent anyone, in income tax department or to give audit reports and certificates. Any chartered accountant is removed from government service, he will never in his lifetime will be able to represent anyone or give reports under income tax. Smaller than that, income tax department, if any chartered accountant, in fact, they don't write chartered, they write person. Any person, if convicted for an offense in income tax proceedings, so income tax cases were going on and person did something wrong and he was convicted that you did something wrong, he will be disqualified as per order issued by, see, very interesting, Principal Chief Commissioner, Chief Commissioner, Principal Commissioner. So first they write Principal Chief Commissioner, then Principal Commissioner, then Chief Commissioner. As per order, if order says disqualification is for 2 years, it is 2 years. 3 years, it is 3 years. As per order. Next, if any, see, it's in sequence again, government related, then income tax department related, then others. Person becomes insolvent till the time he is insolvent. Convicted by court for fraud, 10 years. So it is government related, income tax department related. In others, there are 2 points. Person becomes insolvent or there is conviction for fraud. 10 years. Subsection 5. Subsection 5 says, if a person who is governed by professional bodies, that means lawyers and CAs, if you are governed by any professional body and the professional body has found you guilty of misconduct, found guilty of misconduct by respective authorities of the profession, and they have suspended right to practice. Very simple. If a person is governed by professional bodies like accountants and lawyers, and their alma mater institute has punished the person by suspending their COP, till the time that suspension continues, person cannot represent anyone in tax proceedings, tax cases. Next, if person is not governed by any professional body, is found guilty of professional misconduct, Chief Commissioner will decide for how many years he will remain disqualified. So there are 2, people who are covered and people who are not covered. Yes, please. So there were so many sections. Section Rule 12A, 271J, 288, 278 and then 288. See, so we are through with 6 chapters. 6 chapters we are through. Now, see, if you want to sit for 9 hours, we have to go with reasonable speeds. Otherwise, people will get consumed within an hour or 2. and then everything is over. Fine, so we have covered decent number of questions. Tomorrow, my target will be to cover at least two, three questions from each chapter. So that feel of that chapter is there. At least as soon as you cover each chapter, you get the feel, okay, I'm covering something. At least the fear of that chapter, or we can say that, why students are frightened, because sometimes they don't know what is covered in that chapter. When someone tells them, okay, these are the only points you need to cover. These are the only points you need to cover. So suddenly students start covering those things. Correct. Okay, guys, now we are through with chapter number 1, 200 series to 500 series. Chapter number 2, which focused majorly on 300, 540 and 600 series. Chapter number 3, that focused on SA 315. So you have seen 3 chapters on standards and auditing. Then we moved from there. We saw corporate governance. Then we saw audit of consolidated financial statements. And then we saw liabilities of auditor. Now today, let's start with tax audit. It's very interesting. Sir, it's interesting, but very bulky again. Only 50 clauses. Let's see. Let's first see section 44 AB. So if you come to page number 57, you'll see section 44 AB. It's very simple, straightforward. Who are good morning. As there's a new style of okay, wishing good morning. Fine. Now, section 44 AB tells us which assessee needs to get their books of accounts, financial statements audited. So as per 44 AB clause A, big businesses, all the businesses where turnover exceed 1 crore, they need to get their financial statement audited. Then as per clause B, professions where gross receipt exceed 50 lakhs, professional receipts, gross receipt exceed 50 lakhs, big professionals, they need to get their financial statement audited. Then there are assessees which are covered under presumptive income of taxation. Section 44 AE, small transporters. Section 44 BB, non-residents doing oil exploration business. 44 BB, foreign company which is into construction of turnkey projects. So 44 AE, 44 BB, 44 BB. If they are declaring income less than the presumptive income, if they want to go below presumptive income, they need to get their books of accounts audited. See, again it's in sequence: AE, BB, BB. Then small professionals, section 44 ADA. So if profession where the legal form is either individual, HUF or partnership, not LLP, simple partnership. If assessee status, if assessee is covered in these 3 forms and professional receipts are not exceeding 50 lakhs, again it provides presumptive basis of taxation. Simply declare 50% of the gross receipt as taxable income and pay taxes. If assessee wants to go below the presumptive income here also, Here also, if small professionals don't want to follow presumptive basis of taxation, they want to go below this particular limit, they need to get their financial statements audited. But there is an exception. There is an exception to this point. What is the exception? If assessee says, my income is not crossing even basic exemption limit, I am incurring losses, I am not even, not just, loss is not necessary. He is saying, even I am not crossing even basic exemption limit. Then law says, okay, we will exempt you from audit. If he has that reason, no need to get audit done. So listen, there is difference in 44 AE, double B, triple B and 44 ADA. In those sections, there is no exemption. Declaring below presumptive, audit required. Here also, declaring below presumptive, audit required. But there is one exception. If you say that your basic income is not even crossing, your taxable income is not even crossing basic exemption limit, okay, then no need to get audit done. See guys, it's very simple, straightforward. So big businesses, turnover exceeding 1 crore, big professionals, receipts exceeding 50 lakhs, then presumptive guys, if they want to go below presumptive basis, presumptive income, they get audit done. Small professionals, if they want to go below presumptive, then again get audit done. There is an exemption. What is the exemption? If their income is not even crossing basic exemption limit, no need to get things audited. There is a case study on this point. Then 44 AD, small businesses. So if the assessee is in the form of individual, HUF, partnership firm excluding LLP, and turnover is not exceeding 2 crores. Turnover is not exceeding 2 crores. They can declare their income on presumptive basis by applying 8% or 6% as the case may be. If it's through banking channels, then it is 6%, otherwise it is 8%. Again, if you want to go below this presumptive income, you need to get things audited. Again, there is an exemption. If assessee says that I am not even crossing basic exemption limit, again, no need to get things audited. Is this point clear? So how many clauses are there? 5. Big businesses, big professionals. Presumptive basis of taxation, then small professionals, and then small businesses. For small business, this more clarification. This 44 AD won't be available for people who have their income on commission basis. So if there's an agent or agency, if someone is into agency business, earning commission or earning brokerage, 44 AD will not be available. Common sense. Because commission is complete income, commission or brokerage. If you will apply 8%, 9%, 8% or 6% to it, it will be hardly anything. Okay, so this particular 8%, 6% thing is not available if someone is earning commission income, someone is earning agency income, someone is earning brokerage income. And then what people started doing, if actual is less, go with actual. If presumptive is less, go with presumptive. The government said that was not the reason we brought this. We brought this so that you don't need to maintain your books of accounts. But then you are misusing it, so they made a rule. Once you go for presumptive, you have to go for presumptive for next 5 years. No cases asked till date. Next 5 years. If you don't do it, suppose you did presumptive, a place of taxation in 1 year. Next 5 years you have to go for presumptive. But after 2-3 years, you shift it to actual. Then if you contravene that, you will not be getting benefit of presumptive for next 5 years from the correct after the year in which you used actual basis. So they are saying if you want to use presumptive, use it for at least 5 years. Fine. Then next it is very simple. This 1 crore limit will increase to 10 crores. This 1 crore limit will increase to 10 crores if two conditions are satisfied. Condition number 1, your cash receipts and your cash payments should not exceed 5% of the total cash receipts and total cash payments. Is this point clear? Your cash receipts and cash payment both should not exceed 5% in respect of cash receipts, in respect of cash payments. Now be careful here. When I talk about cash receipts, include both the receipts, capital and revenue. So suppose you got some cash sales, take that. Suppose you got some cash loan, take that also. And in total receipts also take both capital and revenue. So simple thing is in numerator also you will have revenue nature plus capital nature. In denominator you will also have revenue nature and capital nature. Is this point clear? So there are cases on this. Now let's see cases. Now there is a very famous question. Very famous question. Applicability of tax audit. Now they will always give you this turnover. Consider it only price into quantity, nothing else. Don't think about it. Is it coming from sales register? Is it coming from sales account? Very simple. It is simply price into quantity, nothing else. So in this particular question, turnover is 1.13 crore and they have written before adjustment. Generally, it is before adjustment only. Even if they don't specify, we understand that it is before adjustment. Now, let's see things one by one. Cash discount. All the discounts which are given at the time of sale. Let it be any name. It may be in the name of trade discount, loyalty discount, quantity discount, bulk discount, festive discount, birthday discount, New Year discount. Whatever is the name, it doesn't matter. Okay. All the discounts given at the time of sale, they are called trade discounts, which are your bill is in bill, it is deducted. Assessee is never going to get that money. So it is deducted from the turnover. That money will never be received. How can you take it? How can you consider it revenue? So discount given at the time of sale will always be reduced. If discount is given after sale has taken place, so that person gives money early, that is treated as expense and not deduction from revenue. So here they are saying cash discount other than allowed in cash memo or sales invoice. It is other than. Okay. So this discount is given after sales. It should be shown as expense. It should not be deducted from sales. So you will not do any adjustment. Trade discount. This is given at the time of sale. All the discounts which are given at the time of sale, let it be on any name, it should never become part of turnover, deducted. Commission on sales. It is an expense. It is an expense. It should be debited to P&L. It should not be deducted from the revenue, turnover. Sales return. Now listen, sometimes they will give sales return of the current year and sales return of the previous year. What will you deduct? Current year sales return, previous year sales return, or both? Both. In accounts, it doesn't matter that sales return is from current year sales or previous year sale. You simply pass same accounting entry, same treatment is given. So understand this. Sometimes students may get confused. It doesn't matter whether sales return is from current year or from the previous year, it will be deducted. What about sale of investment? We want sale of goods and services. This will be again ignored. So once you do that, we will get the turnover. We'll get the turnover. Listen, they have done these adjustments. Turnover deducted trade discount. They have ignored cash discount. They have taken trade discount, ignored commission, deducted returns. So it is 100.30. Is it crossing 1 crore? Yes. It is crossing 1 crore. So audit will be applicable under section 44 AB. So you should ideally explain income section 44 AB of Income Tax Act 1961, give the provisions, then give the calculation, give the reasons also, maybe give reasons also, and then conclusion. Okay. The next very important 526.500 asked in mock test paper M21. So it becomes extremely important. Then okay, let's see what they say. So anyways, it's a proprietor, sole proprietor is there. See, if there is sole proprietor and if he's small, that means turnover not exceeding 2 crore. If individual, HUF, partnership firm, small businessman, they will be covered in clause E, last clause. Moment they cross that turnover, they will get covered in clause A. Are you getting this point? Okay, not that also. 3 types of assessee will be covered in clause E. All other assessees will be covered in clause A. That is perfect interpretation. Now, this is a proprietor, it will not have any effect. Now, turnover expected to be made is 10 crores. 10 crores, 24 lakhs. He is not a small businessman, he is a big businessman. See, to be called a small businessman, you need 2 conditions. Individual, HUF, partnership and turnover not exceeding 2 crores. If you are not fulfilling these 2 conditions, you will go in clause A. Now, so now here, expected turnover is 10 crore 24 lakhs. Goods returned in respect of sales made 20 lakhs. Not included in above. See, what do you mean by not included? That means they have not given the effect. Don't get confused. Sales return not included means they have not given the effect. So we have to deduct 1024 lakhs minus 20 lakhs. Then cash discount allowed to his customer for prompt payment. This is given afterwards. It is an expense, not deducted from turnover. Special rebate allowed to customer in nature of trade discount. Will that be deducted? Yes, that will be deducted. So we have 1024 lakhs. Out of that, 20 lakhs deducted for sales return. So we have 1000, 1004. Then 5 lakhs will be deducted for trade discount. 5 lakh will be deducted for trade discount. So we'll get 999 lakhs. That means 9.99 crore. So turnover has reduced to 9.99 crore. Further, they are saying aggregate of all amount received, including amount received for sales, turnover or gross receipt during previous year in cash does not exceed 5% of the said amount, and aggregate of all payment made including amount incurred for expenditure in cash is not exceeding 5%. Okay. If both the conditions are satisfied, cash receipt not exceeding 5%, cash payment not exceeding 5%, then the limit will increase to 10 crores. If limit increases to 10 crores and we just computed it was 9.99 crores, no tax audit applicable to this particular individual. Goods return will be deducted, cash discount will not be deducted, special rebate, trade discount will be deducted. 999 lakhs, 9.99 crores, as both the conditions are satisfied, limit will become 10 crores. Limit will be 10 crores. Okay. Then November 22 RTP. So they are targeting that point. Very good cases they have included. Very high chances that these are asked. All these questions are fresh and new, not in exams till date. Let's see. Now, it's a very interesting thing. There's a wonderful game out here. First line says it's a partnership firm providing engineering consultancy services. And then they engineering consultancy services. Okay. And then they explain. So this is providing consultant services. Then they explain receipt from sales and data turnover is 8.5 crores. Turnover is 8.5 crores. So total turnover for the year is 8.5 crores. Receipt on account of sales is 6 crores. Out of that, cash receipt is 0.10. Expenditure during the year 7. Out of that, cash expenditure 0.21. Cash loan repayment 0.05. Now listen guys, we have to compute percentage of cash receipt divided by total receipts, cash payment divided by total payment. Take both revenue nature and capital nature. So let's first focus on the receipt side. Tell me, what is the revenue nature cash receipts? 0.10. Do you agree with this? Is there any capital nature cash receipt? Cash loan or fixed asset sold, investment sold, anything like that? No. So in numerator we will have 0.10. 0.10. Now tell me, what is the total receipt? First, revenue nature receipt is 6 crore. Receipt on account of sales and debtors. They are saying how much? 6 crores. Is there any capital nature receipt? No. So ratio will be 0.10 divided by 6 into 100, 1.67%. So cash receipt is 1.67%. Then let's talk about cash payment. Tell me, revenue nature cash payment. Cash 0.21. Capital nature cash payment 0.05. Then total payment Total payment, not cash. Total revenue nature payment. They have not given anything. That means we'll have to consider expenditure. If they would have said like above, they have said receipt from debtors, but in down they have not said. In case of expenditure, they have not said payment made. They have simply given expenditure. So we'll consider total 7 as a revenue nature. Is there any capital nature receipt, capital nature payment? Yes, 0.05. Are you getting this point? In numerator, we take only cash component. In denominator, we take both total, whether it is cash, whether it is credit. We take total. Yes, no. So numerator, cash payment is 0.21. Revenue nature. Loan repayment is capital nature 0.05. In denominator, you will take total revenue nature 7. Total capital nature 0.05. Are you getting this point? So ratio is 3.6%. Just remember, the only catch point is in numerator take both revenue and capital. In denominator take both revenue and capital. Numerator we need cash and denominator we need total. So as cash receipts are not exceeding 5% and cash payment is not exceeding 5%, turnover limit will go to 10 crores. And what is the turnover here? 8.5 crores. So this is a beautiful game they have all set. So 8.5 crores, that means tax audit is not applicable, is the incorrect answer. Wonderful. That's why institute is sometimes they draft very good cases. In first line they are saying consultancy services, it is a profession. Consultancy services, it is a profession. This conditional increase of 10 crore is only for businesses. So this conditional increase of turnover is only for businesses. It is not for profession. So tax audit is applicable. And in exam they will change only this line. So they are playing chase game. So they are giving some what do you call? They are giving some soldiers or anything to kill, and in the process they are killing your queen and king. So they are giving all the calculation, but game is not in calculation. Game is that it is a profession, and in profession this conditional increase is not available, and it is a November 22 RTP question. So they are not doing any calculation, but then good for us. In the process we learned how to compute percentage of cash receipts and percentage of cash payment. Then again November 20 on RTP. Again very good case. Now it is a business. Okay, great. So you got the lesson. For conditional increase you need business. So it's a business. No, not business actually. It's not business of the assessee. What they're saying, there is a CA firm and their work is to give consultancy services. So be careful. Don't be in haste. Oh, these services. They are talking about the firm. There is a CA firm which give consultancy services, tax consultancy services, and so on. Anyways, below is the list of different clients. So there are different clients, and this is the situation. Client number 1, 9.5 crore turnover, cash receipts 5%, cash payments 5%. It is not exceeding 5%. cash receipt is not exceeding 5%, cash payment is not exceeding 5%, and they are seeing turnover. Because they are seeing turnover, that means all of them are businesses. And then there is a remark, has been filing return as per the regular provision of income tax. Nothing to do with returns. Tax audit applicability is irrespective of whether they are filing returns or not. It's nothing to do with returns. Here conditional increase will happen. Turnover limit will go to 10 crores. Here it is only 9.5 crores. No tax audit. No tax audit required. Next, 1.8 crore. Cash receipt is exceeding 7%. Okay. Cash payment is fine, but one condition is broken. They will not get benefit of conditional increase. They will not get benefit of 10 crores. So limit will remain 1 crore. And now it is 1.8 crore. But further they are saying, this assessee has declared business income as per presumptive taxation. Okay, whether presumptive taxation will be available?
Yes, please.
Two things will be required: individual, HUF, partnership firm, and turnover should not exceed 2 crores. They have not given nature of the assessee. They have not given status of the assessee. So you'll assume, okay, he may be eligible, and then turnover is not exceeding 2 crores. Absolutely fine. If you are a small business covered in 44 AD, then you will get the benefit. Then you can declare income as per presumptive basis. No need to get audit done. So in this case, assessee is having turnover of 1.8 crore. Assessee is a small businessman, will get benefit of presumptive basis. Just declare as per presumptive basis. No need to get financial statements audited. So answer is no need to get things audited. Next, assessee is having turnover of 0.85 crore. Again, cash is exceeding 5%. So one condition is broken. They will not get benefit of conditional increase. Has declared income as per presumptive taxation. Oh, great. If it is not exceeding 2 crore, can you go for presumptive taxation? Yes. You can go for presumptive taxation, 6% and 8%. Has declared business income as per presumptive taxation under 44 AD of Income Tax Act during last 2 previous year, but during current previous year has declared income lower than as per section 44 AD. Okay, now assessee is acting smart. He is eligible for presumptive, but he is declaring less than presumptive. If you are declaring income which is less than presumptive, you need to get your books of accounts audited. But further he says, income is so low, that even basic exemption limit is not crossed. So this is covered in exemption. If you say that you are not crossing even basic exemption limit, you are so small, no need to get financial statements audited. It is an exception of 44 AD and 44 ADA. See, whenever you go below presumptive, you need to get your books audited. But in 44 AD and ADA, small businessmen and small professionals, if you say that you are not crossing basic exemption limit, no need to get books, financial statement audited. So because of the exemption, no need to get financial statements audited. Next is 3.2 crore. 3.2 crore. Conditional increase is not available. conditional increase is not available. Has declared business income as per presumptive taxation under 44 AE. Okay. AE is small transporter. So we have a SSE. Listen, in 44 AE, double B, triple B, there is no turnover limit. You follow 44 AE, no tax audit. You follow 44 double B, triple B, no tax audit. Turnover is not going to matter at all. Has declared business income as per presumptive taxation. But then they are saying during last 4 previous year. What about current year? Current previous year has declared income lower. Okay. There is a breach of 44A. Assessee wants to declare income which is less than the presumptive basis. If it is less than presumptive basis, what will get applicable? Tax audit. But his total income is less than basic exemption limit. Will he get exemption? No. Going below basic exemption limit is available only for 44 AD and ADA. It is not available for 44 AE. Tax audit will be required? Yes. Wonderful. Very high chances that this case will come in exam. Very high chances. It has to come. Only attempt is not fixed. Huh? Listen, sir is asking one doubt. We studied that if you breach 44 AD in between, then next 5 years you have to continue with actual only. Correct? So it is going to have impact in the future years. We are not given data of the future year. So that is not having any impact on the in this particular case. Are you getting this point? If you breach, then things won't be available for next 5 years. Correct? But then if someone wants to draft a case, they will draft it beautifully that it was breached previous year. They will say that it was breached last year. If breach of 44 AD or 44 AD only happens last year, the next 5 years 44 AD is not available. Only what base is available? Actual. If only actual is available, that means you will be covered in clause A and the limit is 1 crore. So very beautiful case can be drafted if someone wants to draft. But in this case, it's not going to have any impact because it's not going to have any impact in the current year. It's going to have impact in the next year. So give your opinion on tax audit applicability. So we have discussed the tax audit applicability, very simple, straightforward. Now, you know what forms are applicable. So when tax audit is done, we have to give tax audit report either in form 3CA or 3CB. Plus, we have to give statement of particulars. We have to give more details in form 3CD. So always 2 things will go. Tax audit report and statement of particulars. Yes, no? Okay. When is 3C applicable? If audit of assessee is done under any other law, then 3C A will get applicable. If audit is not conducted as per any other law, then 3C B will get applicable. And 3CD will be always applicable. It will be there always. Yes, no? Okay. See this page number 58. So we have tax audit report under tax audit reports. If audit is conducted under any law, answer is yes. Form 3C A. If answer is no, Form 3C B. Now listen, both 3C A and 3C B will have two parts. Tax audit report will have two parts. First part is dedicated for report on financial statement, and second part is dedicated for report on statement of particulars. That means report on Form 3CD. Once again, in part 1, auditor has to specify whether financial statements be true and fair view, and in part 2 he has to specify whether information in statement of particulars, that is Form 3CD, is true and correct. Why true and correct? So see, where a lot of judgment is required, we give opinion. Correct? We give opinion true and fair. Fair means it's neutral, it's reasonable, it is acceptable. But that also means alternative can also be there. SLM is giving fair view. It is also possible that sum of digit method of depreciation may also give fair view. Fair means, okay, it's giving realistic information, reasonable information, but alternatives can also be there because element of judgment is involved in accounting and auditing both. But when it comes to Form 3CD, majority of the information is factual. What is the name of the CC? What is the PAN card? Majority of the information is factual. Because majority of the information is factual, why you want to give opinion? Directly comment on the accuracy. So you say in 3CD, in part 2, when it comes to 3CD, you have to comment whether it is true and correct. Yes, no. In part 1, you use the wording true and fair for financial statements. In part 2, you use wording true and correct for Form 3CD. Now let's see. So part 1, part 2. Part 1 is report on financial statement and part 2 is report on Form 3CD. What will happen in 3C is simple. Part 1, he will say that audit is already done. First, identify the assessee. Name of the assessee. PAN or Aadhaar of the assessee. Identify the assessee and then specify who has done the audit, in which law he has done the audit, when was audit report given, attach a copy. Simple thing. Identify the assessee and then explain who has done the audit, in which law audit was conducted, when was report given, and simply attach it. You can remember very simple thing. First give law, whatever sequence is. First give law, in which law it was done, who did it, and when he did it. Attach the report. And then in 3CD simply specify whether information in 3CD is true and correct. And if there are any qualifications means, why we say qualification? Qualification word also means conditions, conditional. Whenever we have to give conditional opinion, that means subject to, except effect of, we say qualification, observation, specify here. What will happen in 3CB? Part 1 now, you don't have any report available. So in part 1, financial statements, you'll simply identify the assessee and you will say, we have obtained all information explanation. As per that, proper books are maintained. These books agree with financial statement give true and fair view. Simple. Collected information, books are proper, they agree with financial statement and financial statement give true and fair view. It's in sequence. In 3CD, same old thing. Information 3CD is true and correct. If there are any qualification observations, specify that. Is this possible? That even when audit is applicable under any other law, still we have to give 3CB? That means you are saying a company, audit is applicable under Companies Act. Still you are giving 3CB? Is that possible? Yes. Two situations. Number one, if financial year doesn't match. Companies following financial year, Jan to December. And for income tax, we want April to March. You know that in certain circumstances, you can go to ROC and take permission of a financial year, different financial year. So they are following Jan to December, and we want April to March. Even though audit is conducted under Companies Act, still we will have to apply 3CB because financial doesn't match. And second, auditor was appointed, but he didn't do audit. This was asked in exam. He didn't do audit. He didn't conduct it. He didn't complete it. So no option left with us. We don't have audit report to attach. What will we attach? So again, we'll have to follow which form? 3CB. So sometimes it is possible. Sometimes is it possible that we still have to give 3CB. Are you getting this point? Auditor not appointed or conducted, report not available, whatever, 3CB. Now, they're asking this theory question. Advise the matter to be considered by Mr. PK while furnishing particulars in 3CD. Okay, so there's a confusion of the century. Who prepares Form 3CD? Articles. Yes. As per guidance note, client has to prepare it and we have to make a report on it. But while drafting theory, many a times they say that auditor should write this, auditor should do this, auditor should do that. So indirectly they are saying who is preparing 3CD? Auditor. In questions itself, in theory itself. And in practical life we know auditor only prepares it. So don't be confused. It's okay. Be conceptually clear. Academically they have to prepare it and we have to give report on it. Correct? But definitely when client gives information, he keeps consulting whom? Auditor. What kind of information is accepted, what do you want, and so on. So here in question also, in ICI question, they are saying Mr. PK is doing tax audit, so he is a chartered accountant. Advise the matter to be considered by Mr. PK while furnishing particulars in Form 3CD. So question itself is conceptually incorrect. So don't be bothered much. We know what should happen. But because of practical things and a lot of discussion happen between the client and the auditor, they always say that auditor should write this in 3CD, he should not write this in 3CD and so on. Okay, anyways. Question is when Form 3CD is prepared, what matter should be considered? Consider means carefully thought. What points you should keep in mind? So, we have made a shortcut, Candid Jaggu. Ask Candid Jaggu. Number 1, cross-reference. C is for cross-reference. What do you mean the cross-reference? Suppose there is one financial item which is covered in multiple clauses. If there is one financial item which is covered in multiple clauses, you should give reference of each other in the clauses. So if you are talking about stock, if data of stock is covered in multiple clauses, give cross-referencing that in this clause there is also stock information, in this clause also, there is also stock information. So if one financial item is covered in multiple clauses, for the benefit of assessee, give cross-referencing so assessee sees both the things properly. Fine. Then next is A stand for accounts, books of accounts. accounts, books of accounts. The information from 3CD should be based on books of accounts and records. Whatever information you are giving in 3CD, it should be as per books of accounts. All the information should come from books of accounts, not from any other source, not from the budgets, not from the estimations, not from the budgets. It should come from books of accounts. So give cross-referencing. Information should come from books of accounts. Then N, if particular clause is not applicable, he should write not applicable. Great. Again N, sometimes it happens that in listen, sometimes it happens law is amended, but form 3CD is not yet amended. It always happens late. So as an auditor, you should always consider amended provision, and as per that give information in form 3CD. Are you getting this point? Yes, no. So sometimes amendment happen late in 3CD. Always give information, consider amended law, even if 3CD is not yet changed. This is very common thing. First changes Income Tax Act and then there is a change in form 3CD. Candid, then D stand for difference of opinion. If there is a difference of opinion between auditor and assessee regarding what type of information should go, state both the views. What should, suppose there is a disagreement. Assessee says deduction should be there. Auditor said it should not be there. Give both the views. Why it should be there, why it should not be there. See, the whole concept of 3CD is so that taxation happens easily. Assessing officer get all the information with respect to taxation. Give both the views. Then I stand for in case prescribed particular given in part or piecemeal to tax auditor or relevant form is incomplete, the assessee did not give information against all or any of the clauses. See, they are saying suppose out of 50 clauses, number wise it is 44 clauses, but counting wise it is 50, because in between there 29A, 29B, 30A, 30B, 30C. Suppose some of the clauses are left blank. What should auditor do? Should not wait much. Qualify the report that assessee is not giving information these clauses. Subject to that, except that everything is fine. Financial statement be true and fair view. Don't hold your report only because assessee is not giving information for form 3CD. Fine. Lastly, Jaggu, in case auditor relies on judicial pronouncement, mention the fact. So it's very simple, guys. So when 3CD is formed, some issues may crop up. How to deal with them? They are candid Jaggu. C for cross-referencing. A for accounts, information as per accounts, books of accounts. N for not applicable. N for if there is no amendment, consider amended position. I for incomplete qualified, and J for judicial pronouncements. So first we have studied applicability. There were interesting cases. Then now preparation of 3CD. Now before we go to 3CD, let's get the shortcut. So you remember yesterday's shortcut? There were 7 websites, 7 companies and 7 food items. So it was 7 plus 7, 14 and plus 7, 21. Quickly, yellow color, Flipkart, white color plane, Indian Airlines, then blue color box, LinkedIn, multicolor website, live.com, then open box, blue color open box, Dropbox, then red font, CNN, then green, Spotify. Yes, no. Then blue logo, Tata Steel, blue and yellow, LIC, and then font, thin font, Infosys. Then we have blue and black, Finolex. Then black and red, Network 18. Network 18. Then golden and black, Reliance. Then orange and blue, Indian Oil. Then food items. Then you'll see cashew nuts, almond, that is nuts. Then orange color, carrot. Brown color, chiku. And then there's a rabdi. And there is a bottle, Madira. And then there are chocolates. And then finally, avocado. So those were 21 clauses. Listen, see, there is a uh, power in having overviews also. Moment you have overview of few things, you start feeling comfortable. That at least I know clause numbers at least. I know clause numbers at least, and then further the next step is I take overview of the clause. This is how study happens. First you take overview of the subject, then you take overview of the chapter, topics, and then you go in detail. First overview is required, and then only you can go in detail. That makes you feel comfortable. So students are quite frightened with tax audit. It's a 150 page topic only. Only 150 pages. Okay. So, and there are 50 clauses. So what you should do, you should know all these 50 clauses numbers and about what it is. A rough idea. And you should simply focus on the questions asked on those clauses. Simple. If question is asked, understand that question and so on. No need to study clauses in great detail. In FADU chart revision, I will take clauses also, but here we'll focus on the questions. Let's see, guys. So if you come to page number 59, let's remember these 50 clauses. It's simple, easy. So first of all, first 10 clauses, preliminary clauses, first 4 are dedicated for identification of assessee. First 4 are dedicated for identification of assessee. So you will have name of the assessee, address of the assessee, PAN card number, indirect tax registration number. First 4 are for identification. Next is basic tax information. Status of the assessee, individual, HUF, partnership, company, previous year, assessment year, and in which clause audit is being done. And there is one more clause actually, 8. Okay, we are not coding shortcut. 8A. Whether company is going for concessional rate of taxation. You are aware that nowadays company is having concessional rate of taxation. So that is clause 8A. Anyways, next you give detail of owners, who are the partners and what is their business. So this is initial 10 clauses. First 4 for identification of the assessee. Next 4 for basic tax information. Next 2, who are the owners and what business they are doing. So we are through with 10. Now there is a different flavor out here. So you have to remember the image. So for entertainment. So theme in the previous shortcut was what the person will do after becoming CA. So there are websites, there are companies, and there are food items. Now theme here is entertainment, entertainment, entertainment. So first entertainment, movies, Indian movies. So you have just focus on the image, Bahubali, then Parmanu, then Maricom, then Vicky Donor, then Shahrukh Bhai and Deepika. Correct? Sir, you said Shahrukh Bhai, not Deepika Ben. Then Chennai Express. Now listen. So these are the 5 clauses. Bahubali, that is for books of accounts. Parmanu, that is for presumptive income. Maricom is for method of accounting. Wicked owner is for valuation of closing stock. And Chennex is for capital asset conversion. Quickly, simple. Bahubali is for books of account. Parmanu, presumptive income. Maricom, method of accounting. Wicked owner, valuation of stock. And then Chennai Express, conversion of capital asset to stock. Now, so we want more entertainment. The movies are over. Next is cartoons. So you see blue color, that is Pokemon. Blue and yellow, Pokemon. Then we have famous Tom and Jerry. Then we have contemporary famous Doraemon. Doraemon, and then Aladdin, and then we have Bheem, Chota Bheem. So quickly, cartoon we have blue and yellow, that is Pokemon. Then red color, Tom and Jerry. And then we have blue color again, Doraemon. Then we have Indian, Aladdin, and Bheem, Chota Bheem. So now, Pokemon, PNL incomes not created. Incomes were there but not credited to PNL. Incomes are there but not credited to PNL. Tom and Jerry, transfer of property below stamp act value. Transfer of property below stamp act value. Doraemon, that is for depreciation. Aladdin is for whether deduction is admissible. So they give a complete list of 15-20 sections, and as an auditor we have to check whether amount is admissible or not. Finally, Bheem is bonus and commission. Okay, you don't need very heavy tax knowledge. Okay, questions are sufficient, no need to go in depth. It doesn't matter in practical life you have done tax audit or not. Okay, so don't take a lot of tension. Some people, sir, I have not paid income tax, what will I do? Like, doesn't matter. Just focus on the questions. As such, you don't have so much of time. You cannot go in each and every section. Sir, I never did this in articleship. Whatever articleship you do, out of 8 subjects, you will be able to cover 30-40% of one subject. Not more than that. Even if you have done a lot of audits, you would have done audits of particular type of entity. A lot of other things are left. So don't worry, no articleship is perfect. Many things must be left. It doesn't have any impact on your academics. In fact, there can be negative impact, not positive. If you go and write as per practical audit, you will get less marks. Okay. I have to say this thing because some people, they're always unsatisfied, unhappy. My articleship was not good. My articleship was not good. No one's articleship is good.
Yes, sir.
Yes. Something or the other is always wrong. Okay. Because moment I start tax audit, some people start thinking, oh, I never did all these things. In fact, those who did tax audit in practical life, many times they didn't apply their brain also. They were doing only copy paste, copy paste, copy paste. That too last year. Okay, last year this was this year this was this. Now, Pokemon, PN income is not created. Then we have Tom and Jerry, transfer of property. Then Blue, Doraemon, depreciation. Then Aladdin, red cap, that is admissible. Then Bheem, bonus or commission. We want more entertainment. So Hollywood movies now. So if you are a Marvel fan, you will understand. So this is DC. Okay, Deadpool, and then Iron Man, then Predator. See, images are important. Deadpool, Iron Man, Predator, Doctor Strange, Captain America. So Deadpool is debited to PNL but not allowed. Give details. Debit to P&L but not allowed. Iron Man, interest under MSMED, not allowed. Give details. Predator, payment to relatives. See, predator and relatives, they're together. Some relatives, some relatives, there are always some relatives who are difficult. Then, Doctor Strange, deemed income. If you break certain conditions, it will become deemed income. Then Captain America, chargeable under 40, section 41. Again, that is reversals happen many times. You recover bad debts, creditor is written back, all those things come here. Quickly, Deadpool, debited to P&L but not allowed. Then we have Iron Man, interest under MSMED, Predator, payment to relatives, Doctor Strange, named income, Captain America, chargeable under section 41. So initial we had 10 clauses, 10 identification, 10 basics, then owner business, and now we have here 15 clauses, 5 Bollywood, Indian, not just Bollywood, Indian, and then 5 cartoons and 5 Hollywood. Okay. So now, see, earlier Bollywood used to be the dominant force, but now it is South is the dominant force. A very happy moment for India to get Oscars, 2 Oscars. Correct. Now, so to keep controversy aside, Indian cinema. Okay. Now, we want more entertainment. More entertainment. Really, if someone is listening to our lecture, what's going on? How come this CFI and audit? Okay, so more entertainment. So listen what politicians say. So blue color shirt, Parikar Saab is no more, was a good politician from Goa. Then Chidambaram Saab, then Smriti Rani, Sonia G, and then Hillary Clinton. So we introduced her also in the shortcut. So first we have Parikar Saab, that is payment basis deduction. Payment basis deduction, 43B. 43B. Chidambaram Saab, it suits him. Senvat, details about Senvat, credit. Smriti Rani, shares received free of cost or without consideration. Free of cost or without consideration or less consideration. Sonia Gandhi is shares issued and we have written 2 there. Because this 29A and 29B also. And correct, Rahul Gandhi and Priyanka Gandhi, even that logic is there. Correct. And then Hillary Clinton, clause number 30, Hundi. Hillary Clinton, if Hawala is done, there is Hundi. 3 is written. She is not having 3 kids. It is 30A, 30B, 30C. So in some clauses there is repetition, A, B, C and so on. So there are 5 politicians, 5 things. Parikar Saab, payment basis. Chidambaram Saab, Senvat. Smriti Rani, shares received. Sonia ji, shares issued. In one it is received and one it is issued. And then Hillary Clinton, Gundi. We want more entertainment. So we went to zoo. So we saw a big animal, very big animal, that is lion. Then smaller than that, leopard. Then smaller than that, doggy. Then smaller than that, tortoise. See, even that is in sequence. And then you came out of the zoo. You saw a goat. You will not see. He says mutton. Obsessed with food. What? Bawarchi. Yeah. Yesterday there was a plan to go to Bawarchi, but then I saw what is the time required. Half an hour, 45 minutes to go and then come. So I dropped it. So we had dinner here only. Oh, sir, you had a dinner party? Yes. We missed all of you, know. Today we can do it again. Okay, listen. So, Lion, that is, you have to give details of loans and deposits. Details of loans and deposits. Loan, deposits taken and repayment. So, black to white is same thing. Suppose you are having 25 lakh rupees cash and now you want to use that money in the business, buying machine. What you can do, give it to some party, that cash, and take check from it. It will be shown as loan. So if in any assessee, if you see a lot of loans, that means he has recycled a lot of cash. Cash to buy it, cash to buy it, cash to buy it. This is how practically many times things are done. So details are given here. Loans taken, loans and deposits taken, and its repayment. Leopard, give details of losses. Dog, doggy, give details of deduction in chapter 6a. Tortoise, give deduction of TDS. Goat, give details of goods quantity. Then lot of entertainment. You need money. So money is paid in dollars. Then it is Canadian dollar. Then euro. Then shilling from Kenya. And then finally our rupee. Dollar, DDT, dividend distribution tax. Canadian dollar, cost audit report. Euro, excise audit report. Shilling, service tax report. If anything negative is there in these reports, it needs to be reported here. Then rupees for ratio. Quickly, first is dollar, DT. Next is Canadian dollar, cost audit report. Next is euro, excise audit report. Next is shilling, service tax report. And then next is rupee ratios. And now from which bank? Latest news is Deutsche Bank is under stress. If Deutsche, a lot of banks are collapsing, even Credit Suisse is under. Whose banks in US collapsed recently, and now European banks are also under pressure. If these banks collapse, it's a big issue in Europe. And who are going strong? Indian banks. Yes, Indian bank only take charges, so they can never collapse. They make their customers collapse. Okay, let's see. Good. As such, if world economy is disturbed, it's not good for anyone because everything is connected. But the good thing that is not happening in India. Yes. What happened? Good governance. He's seeing as if he is governing. Good governance. Okay. Now, next is Deutsche Bank. Blue color. We have Deutsche Bank. Then we have doggy again. Syndicate Bank. Then RBL Bank is RNB. And then Bandhan Bank. Four banks are there. Deutsche Bank give details of demands and refunds and other laws. Other laws. Syndicate Bank where statements are submitted by the assessee in Form 61 and 61A. Basically, it is high value transaction. Whether high value transaction details are regularly submitted by the assessee to the government. Then report under 286, it is applicable to few assessees who are MNCs. If assessee is a MNC, they need to make report under section 286 of Income Tax Act. And then finally we have Bandhan Bank, that is breakup of expenditure. How much is paid to registered supplier, unregistered supplier, and so on. Let's freeze, guys. So now remember the images. First 10 initial, then 5 movies, 5 cartoons, 5 Hollywood movies, 5 politicians, 5 animals, and then 5 currencies, and then 4 banks. So that is 44. So suppose I ask you about TDS, which clause? Tortoise. So first 10, then next 15, 25, then next 5, 30, then 31, 32, 33, 34. So you can get any clause, just remember image. If you remember image, you can get any clause number. At least you know now which clause number to apply. Many times students know answer, but they don't know clause number. So this will help you retain the clause and get that precious 1 mark. 1 is not 1, it is 25%. Now, okay, let's see. Question number 532. Listen. So basically, it is a case where assessee is having printing press and he says, I get the order. Sometimes supposed to print A4, A3, calendar, this, that. I get the order, I get the raw material, I print it, I deliver it, and stock with me is of very less. So many times either is no stock or stock of the current order, because variety of raw material keeps changing, variety of WIP keeps changing, variety of finished good keeps changing. It's not possible for me to keep records. So basically he's saying I am not keeping stock records. I am not maintaining any details about the stock. Comment. So tax audit is applicable to a printing press and they are not maintaining any stock record, no stock details are there. Okay. Listen. So when it comes to reporting, auditor has to give opinion on financial statements. Has to give opinion on financial statements, and in financial statements you have one of the items as closing stock. So auditor has to go and verify. If he is able to verify closing stock with whatever records or whatever assets are there, if he is able to get sufficient appropriate evidence, see, it is not mandatory to maintain stock records. It is not mandatory. From 11th class you have studied that in financial books we directly go for stock counting at year end and pass which entry? Closing stock entry. It is absolutely fine that if we don't maintain stock account. Okay. Auditor's object is to give opinion on financial statements. Number 1. On financial statements, if he is able to get sufficient appropriate evidence about income, expense, asset, liability, even of the closing stock, whatever it is, he will give his opinion. Financial statement true and fair. Apart from that, if he is not able to do that, no proper evidence, he will modify the opinion. Apart from that, there is clause 11. What is clause 11? Books of account. Clause number 11. So 10 initial and then Bahubali, that is books of accounts. In clause number 11, he has to mention 3 things. Whether books are prescribed. Whether books are prescribed for the assessee under section 44AA. 44AA. 44AA prescribed books only for specific professionals. So generally answer is no. not prescribed. For business, they don't prescribe. Then next, which books are maintained and which books are maintained and which books are examined. Which books are maintained and which books are examined. If proper records are not maintained, proper books are not maintained, then he will have to mention under clause 11, he need to qualify that proper records are not maintained. Maybe for purchases proper records are not there, dispatches proper records are not there, and there is no proper records for closing stock of the inventory. Further in clause 35, goods quantity, he will not be able to give details about the goods quantity because proper records are not there. Let's freeze, guys. If he is not able to get sufficient appropriate evidence for financial statements for closing stock, modify the opinion. Clause 11, if he feels proper records are not there, again qualify. He cannot provide quantity of goods, again qualify. So you have to take into consideration three things: opinion on financial statements, and then clause number 11, maintenance of records, clause number 35, goods quantity records. So simple thing, not properly maintained, he has to specifically mention the same with the reasons for non-maintenance stock registered by the entity. So three things will get affected: opinion will get affected, clause 11 will get affected, and clause 35 will get affected. Simply specify that. It is not in, see, it's very simple thing, okay? You don't have to go in a lot of detail there. Come to 543. 543, simple, straightforward. If cash payment exceed, how much? What is the limit? 10,000. If cash payment exceed 10,000 per party per day, and if it is related to hiring or plying, 35,000. Okay, so very simple thing. We just studied debited to P&L but not allowed. What was the image? Debited to, they are expenses which are debited to P&L but not allowed. Debt pool. So what is the clause? First 10, then 15, then 20, 21. 21, debt pool. Very simple case. So companies engage in leasing of goods carriage. So it's hiring or plying your goods carriage, trucks. Listen, it is not necessary to be in that business. If payment is connected to that anyhow, limit increase to 35,000. So engage in the business, limit increase to 35,000. 6 invoices of 5,000 each made to Mr. X. 6 into 5, 30,000. So per party per day payment is 30,000. It is within the limit of 35,000. It will be allowed as deduction. No, it will be allowed as deduction. Then 2 invoice of 18,000. 18,000, that is 36,000. But then on 5th of July and 6th of July, absolutely fine. Payment of 40,000 to Z on 7th of July. But then this expense is not of current year, it is of last year. Will it need to get reported? Yes. It doesn't matter whether the cash payment is for the current year or previous year or next year. Per party per day limit is crossed, need to be reported. Is point clear? Okay. If expense belongs to current year, section is 40A3. Belongs to previous year, it is 40A 3A. Sir, should we remember this? Fine if you remember, fine if you don't remember. Section numbers. Okay, or try to remember only those section numbers which come in questions. Listen, you have to give details of the expenses which are not allowed, in this particular clause. and you can also explain under which section they are not allowed. So section is 40A3 and 40A3A. 40A3, if current year expense exceeds the limit of 10,000, 35,000. 40A3A, if previous year expenses exceed the limit 10,000 and 35,000. It's very simple, guys. Next is what about entrance fees? Entrance fees paid to clubs. Suppose company is paying membership charges of club for the officers and employees, and they're also paying for club expenses. Whether they will get disallowed, we'll have to see the nature. If it is as per company policies, it is official nature, it will be allowed. If it is personal nature, it will be disallowed. And you'll have to give details under again clause 21. So you have to go and see company's policy and nature of the expense. Personal nature, disallowed, and if it is official nature, it is absolutely fine, it is allowed. So simply see the nature. .500. Now, asked in study material, how will you verify the income expenditure of earlier year credited debited to current year? Now listen, clause 27. So that was so what is clause 27? First initial 10, then 15, 25. 26 is Parikar Saab and 27 is Chidambaram Saab. Chidambaram Saab is for Senvat. There is one more thing in that clause, prior period items. One more thing is prior period items. What is prior period items? If there are mistakes in the previous year which are corrected in the current year, and in the process, if any income or expense arises, that is called prior period items. So in clause 27, you also have to give details about the prior period. So they are explaining few things about the prior period. What are they explaining? First, they are explaining a very simple concept that generally you will get prior period items. Prior period items means mistakes in mercantile basis. You will not get these mistakes in cash basis. See, in cash basis, you account for all cash receipts and payments. If you don't account, things don't tally. Things don't tally. Things don't tally, and automatically you hunt for it and you rectify things. So they are saying generally prior period items are not there in cash base of accounting. It is there in accrual base of accounting. And you know that both the basis of accounting is allowed in income tax. People can follow cash base also. They can follow accrual also. Professionals follow cash basis, and generally others follow accrual basis. Like doctors, they follow cash basis. So simply explain that if assessee is having mercantile basis, then this clause is relevant. Is having cash basis, then it is not relevant. So first explain relevance. Then explain that if you get such items, the tax auditor should obtain particular of expenditure of income of any earlier year debited credit to P&L. He should go and talk to assessee and ask all the details. Get the details about prior period items. get details about prior period items, go and talk to them, do inquiry, ask them whether any previous year income expense which was left out is recorded in the current year. In case of person whose accounts or business have been audited under any other law, the information may be available from the annual accounts. So basically they are explaining how to get information about prior period item. Talking to assessee can be good source of information. See audited accounts. You know that in schedule 3 you have to give details of prior period item on the face of the P&L. That can be good source of information. So then if that is not the case, do scrutiny of the ledger. Go to the account, see big entries, big debits and credits, and see whether they belong to prior period. If they belong to prior period, is a prior period item. So first explain that in mercantile basis it is relevant, in cash basis it is not. Then explain sources of information. There are 3 sources they are saying: talking to assessee, seeing audited financial statements, and then doing ledger scrutiny. Finally, they are explaining which, if you come across prior period item, which information you should note: nature of the item, amount of the item, which year it belongs to. Simple. Nature of the item, amount of the item, which year it belongs to. So you need to explain 3 things: relevance in mercantile basis, not cash, how to get the information, and finally details. See, moment you make such points, it is easy to understand and retain also. You, as I have been repeating again and again, you have to take answers to this particular level, then only it makes sense to do questions. Doing lot of questions without having grip on it doesn't make sense, because you won't be able to write. Next is come to 547, 29B. Okay, listen guys. Okay. So nowadays a new virus is going on. Ensure that you get that virus as quickly as possible. Yes, that's a simple solution. So there will be flu for a few days, and then you will get natural immunity. Then you are safe. Instead that it happens at the time of exams. It is good. It happens before exam. So sir, we should search for such people and hug them. Give me virus. Yes. He said last week only I am done. I'm done with it. Okay. Sir is wearing mask. I'm saying this, I think that is the best solution. Instead it troubling you at the time of exams, it is good that it happens right now, and then you are fit and fine, safe. Personal opinion, you may not follow. Shop, check the. Okay, there's a serious effect of Zahir audit. She said there's a new business opportunity. So we can open some shops. If you want virus, come to us. We'll give you virus.
Sir, user idea.
Yes.
User idea.
User idea for what? Making new? New is here. Yes. What? 50? हाँ 50 बरसा पानी दे. अच्छा, okay, idea. Okay. Here is also a serious effect. Okay. The subject itself is here. Okay. Now, 29B. Listen, guys. Earlier, shares received free of cost or with inadequate consideration. So, that was covered in clause 28. Smriti Raniji. But now that clause is discontinued. That clause is now discontinued. See here. See here, page number 61. Page number 61. We have second column. Clause 28 is now no longer active. It is superseded by clause 29B. What is 29B? It's very simple. It's about gift. 29B covers all the gifts received as per section 56. Again, no 56 subsection 2 clause 10. No need to remember. It is about gift incomes. So if any assessee gets money, RWAC received without received without any consideration, the whole amount of money will be treated as income in the hands of the assessee, and information needs to be given under clause 29B. If he gets immovable asset without any consideration, if he gets money will be treated as amount of money will be treated as gift income. If he gets immovable property, not market value but stamp act value, stamp duty value will be considered as gift in the hands of the assessee. If there is an inadequate consideration, that means he got property of 50 lakhs only for 10 lakhs, then difference will be treated as gift income. But again, difference between what? Stamp duty value and consideration, that will be treated as income. Now there is one thing. So government said it's okay if difference is little small, 10% it is okay. 10% of the consideration. That means if consideration received is 100, money you got is 100, and stamp duty value is 102. We understand you are going below stamp duty value. You are getting property for discount. Stamp duty value is 102 and you are getting property for 100. What is the difference? 2. But percentage wise it is 2 divided by 100. How much? 2%. Till the time difference is up to 10%, it will not be taxable in the hands of the assessee. Moment it crosses 10%, it will be taxable in the hands of the assessee. But listen, you have to give details. Even if change is less than 10%, you have to give details in this clause. Listen, giving information clause is one thing, and whether it is taxable is another thing. So if you are getting any property in less consideration, then difference should be given here. Difference between stamp duty value and consideration should be given here. And remember, taxation will happen only when difference is more than 10% of the consideration. If you get any other asset without any money, then fair value of the asset will be treated as gift income. For immovable property we have stamp duty value. For other asset we have fair value. And for inadequate consideration, then simply difference between the fair value and consideration. Okay. Further, taxation will be done only when the amount exceeds 50,000 in totality. Complete amount gets taxable, not just the excess. If yes, give details. So in clause 29B, you have to give details of gift income. Gift in the form of money, in the form of immovable property, in the form of any other asset. This is not relevant now. You can cut it if it's there. Not relevant. If it's not there, great. So here in this case, 1000 shares are received for 70,000 shares are received. Market value is 75,000 nil. It will be reported under clause 29B and it will be chargeable to tax because it is exceeding 50,000. Simple. $550.500. Listen, clause 34. What is clause 34? So first 10, then next 15, 25, then 5 politician, 30. 31 is lion, 32 is leopard, 33 is dog, 34 is tortoise. Tortoise is TDS. Sits on TDS. You observe that they are timely filing TDS returns. For TDS return on salary, the company has not furnished list of details which are not reported in the statement of TDS at so under the pretext that TDS statements are furnished within prescribed time. As a tax auditor, how would you deal with it in the report? So they are filing returns on time. That's not the issue. But then has not furnished the list of details which are not reported in the statement of TDS at source under the pretext that the statements are furnished on time. Listen. See this clause 34. Listen. Now, three things need to be reported under clause 34. Number one, TDS, TCS details. So, how much TDS, TCS was payable during the year and how much it is paid. You need to give details of TDS and TCS. Then you need to give details of statements. Are you filing statements on time? Are you filing statements on time? And statements, see, first thing is that you pay TDS on time. TDS and TCS. Next thing is that you file statements on time. And if you are not doing this, you have to pay interest. So first is payment of TDS, TCS. Next is statement. Now, what they are saying, okay, we are paying TDS and TCS. We are filing statements also on time. But the problem is in statement you need to specify where you have not deducted TDS, where you have not paid TCS. You need to give details wherever there is a default. They are saying we are filing everything on time. Okay, everything is on time, but give details where you have not paid TDS, deducted TDS, you have not paid TCS. They are not giving those details. So that is wrong. In clause 34B, auditor need to mention that they are not providing the details of non-payment of TDS and TCS, which should be given. It's a theoretical thing. So clause 34B, statements need to be given. And see, these are the headings. So you have to give PAN number, then details are given in which form, what was the due date of the form, when did you file the form, whether the statement of TDS, statement of tax deducted or collected information, all transaction which are required to be reported, whether it is giving information about all transaction which should have been reported required. If not, furnish list of transaction details where TDS was not deducted or TCS was not collected and paid. You are filing returns, that is fine, but when you are missing something, you have to give list of the missing items. They are not giving list of the missing items, correct? That is the problem. They are not giving the list, that is the problem. So here in clause 34, we'll have to specify that list. That is the only thing. It's not very technical, it's a theoretical question. But then it is important because asked in May 22 as well as November 22 mock. Come to 555.500. November 20 exams, November 22 mock. Is engaged in manufacturing of textile products having annual capacity of producing so many units, 1 lakh units of garments. Is covered under the provision of GST with 12% rate. During the financial year 1920, received a demand notice of 15 lakhs pertaining to 1314. When the provision for excise were applicable, NKB Limited deposited the demand amount after discussing with the legal department. Are you as a tax auditor required to report? So the question is, first of all, this, what has happened? Excise demand came and amount is deposited. Now one by one question is, first question, this demand is not of current year, it is of previous years. So should we report it? Next is, amount is deposited. Should we report it? Next is, it is not current regime, it is excise. Should we report it? Answer is yes, we should report it. If demand order or refund order is issued under any other law other than Income Tax Act, Income Tax and Wealth Tax, apart from this, if demand, see, Income Tax Department wants to know how much demand and how much refund are coming under various laws, apart from Income Tax and Wealth Tax. Irrespective of whether payment is done or not, irrespective of whether money is received or not, details should be given for all demand and refund order, irrespective of whether it belongs to which year. Are you getting this point? So basically, furnish details of demand raised and refund issued. Demand raised and refund issued. They are not saying anything other than income tax and wealth tax. So we need to give details about the demand even though money is deposited. Even though money is deposited. This is exactly opposite to Caro. Exactly opposite to Caro, you know, statutory dues.
It is.
Spotify, clause number 7. In statutory dues, you have to give details of disputes only when amount is not deposited. In statutory dues, you have to give details of dispute only when amount is not deposited. Here you have to give details of all demand orders and refund orders. There is dispute, no dispute, doesn't matter. Amount is paid, received, doesn't matter. Give details of all, which year, doesn't matter. So you have to give details, serial number, under which act demand is raised, order number if any, date, which financial year it belongs, amount of demand, amount, adjustment of refund against demand if any, remarks. So basically you have to give all the details. That is important. ICDS. Aware about ICDS? Okay. You have to give this in method of accounting. What is method of accounting? Maricom. 11, 12, 13. In clause number 13, you have to specify ICDS full form, Income Computation and Disclosure Standards. Sir, we know this one. This is not applicable to individuals and HUF. If they don't need to get their books of accounts audited. Only 2 are exempted, and that too when no audit is applicable. Everyone else is supposed to follow ICDS. So here you have to specify, number 1, whether any adjustment is required as per ICDS. If yes, give details of the adjustment. And third, if any disclosure of information is required as per ICDS. First, whether any adjustment is required, yes, give the details, and next is give details of the disclosures as per ICDS. You have to report how many things? 3 things. So you first explain what is ICDS, income contribution disclosure standards. You explain it's applicable to everyone except individual and HUF, where they don't need to get their books of accounts audited. You have to specify how many details? 3 details. Whether ICDS adjustment is applicable, if yes, details, if yes, disclosures. How many ICDS are there? 10. 10 ICDS are there. We have made a story to remember all the 10 ICDS. Only this much is expected from us. We have made a story. If you go to page number 60, see, it's a funny story. Ajay Devgan. Imagine Ajay Devgan. Okay. He is having a white van. Ajay Devgan is having a van. Imagine a van. He goes to a construction site. Talk to laborers there. How much do you earn? What is the revenue? And then, out of sympathy, asks, are you having any fixed asset? In life, have you ever seen foreign exchange? He feels very bad. Then he asks government grants. But till the time government grant is received, he himself gives security, bears borrowing costs, bears borrowing cost, and bears provision. He borrows money, give it to needy people. He deposits security, bears borrowing costs, bears all the provision. So these are 10 clauses. Ajay Devgan, ICDS 1, accounting policy. Van 2, valuation of inventory. Construction site, construction contract, ICDS 3. Revenue recognition, ICDS 4. Fixed assets, 5. Foreign exchange treatment, 6. Government grant, 7. Securities, 8. Borrowing cost, 9. Provisions and contingency accounting, 10. So these are 10 ICDS. Simply know that there are 10 ICDS, that's it. Last question is asked in recent exams, so remove it from the IMP list. Just write asked in November 22. Okay guys, we are through with tax audit. Okay guys, now let's see 2 to 3 questions for each chapter. Now bank audit, I understand it's a huge chapter. A lot of things are there in module, but that's not possible for us to cover. In fact, when you do self-study also, not possible to cover everything. Simply focus on the questions, important questions. Now, four 454.500, it has been asked in November 21 RTP. Bank audit. Audit of banks. 454.500. Quickly, it's a very simple thing. So it's a private bank, doesn't matter, private bank, public bank, NPA norms and its clarifications are same. NPA norms and clarifications are same. Now they're asking is, so these are the audit queries. Comment on this. Interest on state government guarantee advance has been taken into income even though such advances has remained overdue for more than 90 days. Okay. First of all, we all know about NPA. If there is a guarantee, yeah, if there is a if there is a guarantee by central government, then those accounts are not treated NPA for the purpose of making provisions. If there is a state government guarantee, it doesn't matter. Only if there is a central government guarantee, those accounts will not be treated NPA for the purpose of making provisions. And if there is a state government guarantee, it's of no use. Account will be treated as NPA for the purpose of computing provision. Now here they are not asking about provision. They are asking about interest income. What will happen to income? Now listen carefully. Irrespective of whether there is a central government guarantee or state government guarantee, if you are not getting money regularly, that means if the amount is overdue more than 90 days, we will reverse accrued income. We will reverse accrued income and will shift to cash basis, even if there is government guarantee. Are you getting this point? So what is the conclusion? Guarantee can save you from provisions of NPA, but guarantee cannot save you for income recognition. So here, interest of state government guarantee, first of all, if there is state government guarantee, it cannot protect you from NPA for the purpose of making provision for NPA. You will have to make provision for NPA. And second, you have to reverse accrued income and shift on cash basis. Is everyone clear about this? Yes, no? Only central government guarantee can protect you from provision for NPA, but it cannot protect you from revenue recognition thing. As soon as any account is overdue for more than 90 days, reverse accrued income and shift it to cash basis. Next, there is an account for which an ad hoc limit has not been reviewed for 180 days from the date of such ad hoc sanction. And such account has been treated as performing asset in books. Okay, there is no chart of banks. Okay, I will show you one chart. I will provide you that. So now listen. So these we are discussing clarifications of NPA. And then there is one point with respect to temporary deficiency of documents and procedures. What is this? Very simple. It discusses 3 points, 3 issues. So temporary deficiency of documents or procedures, 3 points are there. Number 1, if bank has given loan on the basis of current assets, then bank says that you keep giving us stock statements on periodical basis, regular basis, maybe monthly, maybe quarterly. If the stock statement is older than 3 months, account becomes irregular. And if it continues like that for 90 days, then it becomes NPA. So think from the bank point of view. If bank has given working capital loan on the basis of current assets, even if bank is getting money on regular basis, but they are not getting stock statements. If stock statement is older than 3 months, and if such thing continues for 90 days, because of deficiency of document, it will become NPA. Then next, suppose you have given a CC limit or a OD limit. CC limit or OD limit is generally valid for 1 year. After the tenure ends, borrower is supposed to come, submit documents again and renew it for 1 year. Very simple thing. If renewal is not done for 180 days, if renewal is not done for 180 days, it will again become NPA, even if the person is paying money regular basis, because of deficiency of procedures. If there's a deficiency of stock statement, NPA, 3 months plus 90 days. Deficiency of procedure, NPA. And next is sometime ad hoc credit is given. What is given? Ad hoc credit. Ad hoc credit means temporary credit. Emergency credit is given. So borrower comes, says, I want ad hoc credit. Take this ad hoc credit. You are supposed to repay that within few months, or you are supposed to convert that into a regular limit, but that doesn't happen. Ad hoc credit remains outstanding for 180 days. It is not repaid. It is not repaid. Neither it is converted into a regular limit. Again, procedural part is not done. It will be treated as NPA. 3 things. Stock statement not received, NPA. Renewal not done, NPA. Ad hoc credit not repaid or regularized, NPA. So, here they are saying that ad hoc limit has not been reviewed, has not been paid, has not been converted into a regular limit within 180 days. It will become NPA. So in first case, we will say interest income should be reversed and shifted to cash basis. Second, we will say it will be as NPA. Third, one of the NPAs was sold for higher value than the net book value. Can sale of NPA happen? Yes. We'll discuss that maybe. Next question. Sale of NPA can happen. You sell NPA, it's absolutely fine. Can it be sold more than the book value? Yes, it is very much possible. For example, there was an NPA loan of 150 crores and provision for NPA was suppose 110. So what is the net book value? 40. Loan 150. Provision for NPA 110. What is the net book value? 40. And it is sold for suppose 60. Net book value was 40 and it is sold for 60. Sir, why will someone buy for 60? Because along with loan there are securities also. So people will buy it for 60. So people will buy it for 60. What is the extra amount? 20. That is a profit. So RBI says that if you are selling an NPA and you are getting more than book value, you are earning profits. Don't book it as a profit. Don't book it as profit. In fact, transfer that amount to provision for NPA so that it is used for other NPA loans. Be conservative. So whenever you sell NPA, if you're getting more, then the extra amount should not be credited to P&L. It should not be credited to profit account. It should be credited to provision for NPA. So credit to provision for NPA and use it for other NPA accounts. Next is in case of one account, an additional temporary limit has been sanctioned of 25% of existing limit. One of the accounts, an additional temporary limit has been sanctioned for 25% of the existing limit and for 120 days tenure, additional limit is given. The terms and condition of temporary limit in case of such account would be revised to 20% of existing limit and for 90 days maximum tenure. Okay. This is altogether new thing. This is not in module also. See, this is institute. They are saying that if you want to give additional limit, that should be for maximum 20%. This is not even in module. So sometimes students ask, sir, why there is something extra in the book apart from module? We are not fools. Because sometimes they ask something different altogether in RTP or MTP, which was not there. So again, that is important. This can be targeted in the MCQ also. Additional limit. Suppose a sanction limit is 100. You can give more limit of maximum how much percent? 20%. And tenure to how much? 90 days. Not more than that. On verification of outstanding foreign exchange contract, the net position in respect of one of the foreign currencies was not squared and was uncovered by a substantial amount. One of the outstanding foreign exchange, so there is a foreign exchange contract, the net position respect of one of the foreign currencies. So you have buy contracts and sale contracts. So you may be in forward you have bought or in forward you have sold. Was not squared. Not squared means not settled. There is no knocking off happening. When you buy and sell, there is a knock off. And was uncovered by a substantial amount. Uncovered means maybe there is no hedging. Are you getting this point? Yes, no. So what they are saying now, again, the net position of the branch in it refund should be squared off and get covered. Again, it's a new point altogether. Net position of the branch should be squared off and get covered by a substantial amount. Okay. Listen. Net position respect of each of the foreign currency should be generally squared off and should not be uncovered by a substantial amount. What they are saying, see, bank should not enter into speculation of forward currencies. That means, suppose bank is having a forward currency, you all know about SFM, foreign exchange. Suppose bank is going to receive $1 lakh receivable, and now bank is worried at what rate this dollar will be sold. If you are going to get dollars, you enter into forward sell. I am going to get dollars after 3 months, so I will enter into forward sell. So that is called, it is covered transaction. I am having a receivable and then I am having a forward sell. If I am having a payable, I will have forward buy. These are called covered transaction. That's called hedging. Banks should use forward currency forward contracts for hedging. They should have a receivable or payable position which they are covering with the help of forward contracts. Are you getting this point? So they are saying if you are entering into forward contracts, it should be substantially covered. And if it is not covered, suppose you have just entered into forward buy or sell, by year end, square it off. We don't want speculations. So here they are saying that there is no receivable payable and then also they are having position. So that is wrong. There are no receivable payable outstanding and you are having a forward position, that is wrong. You should square it off immediately. So last 2 points were good. Next is again very simple. November 22 RTP. November 22 RTP. Let's see. So it is financial year 21-22. There is an overdraft facility of 50 crore. and overdraft facility as on 31st March was 55.65. So we all know, you all know about CC and OD? Yes, no.
Yes.
CC and OD becomes NPA when account is out of order. When account goes out of order, if amount outstanding is more than the limit for continuously 90 days, or if amount is less but there are no credits, no money is received for continuously 90 days, or money received is even not sufficient to cover the debits for 90 days, it will become NPA. So if it is crossing the limit, NPA. If it is crossing the limit, NPA. If it is not crossing limit, no credits, NPA. Credits are less, NPA. So they are saying limit is 50 crores and outstanding amount is 56.5 crores on 31st March 22. The balance in account exceed the sanction limit for the whole month. Okay. So limit is crossed for the whole month. How many days? 30 days. Problem is when such thing continues for 90 days. Absolutely fine. Absolutely fine. No issue at all. If such thing is there only for 30 days, absolutely fine. If this would have continued for 90 days, then it would have become NPA. Then they are saying stock and debtor statement is required to be submitted on monthly basis. And last statement, latest statement is of Feb 22. Feb 22 showed the drawing power. You know that every time a stock statement is received on that basis we compute drawing power. Limit which is computed at the start, that is called sanction limit, and every month limit is computed, that is called drawing power. So drawing power is calculated anyways. However, stock data statement of previous months show adequate drawing power. Now listen, here also. Now stock statement, if it is older than 3 months, it becomes irregular, and if it continues for 90 days, it becomes NPA. Stock statement is hardly 1 month old, or if it is received at the start, it is hardly 1 month old. Stock statement is hardly 1 month old, no problem at all. It will not become NPA. Are you getting this point? So everywhere there it is within the limits. It is crossing limit for 1 month, okay. 30 days is okay. If the statement is just 1 month old, okay. Problem will arise when it is more than 3 months, and such thing should continue for 90 days. So this is the case study. We are applying all the theoretical things. Stock audit of borrower. Stock audit is generally conducted for loans of 5 crores or more. CC limits of 5 crores or more. Stock audit of borrower. Everyone is aware stock audit?
Yes.
Banks appoint CA firms that you go and see whether our borrowers are having stock and debtors. So they appoint CA firms to go and check stock and debtors. That is called stock audit. Chartered accounts are paid 25,000 for each stock audit. Stock audit report placed on record showed adequate drawing power in the account. However, it is commented adversely on declining turnover of the borrower. Turnover of the borrower is declining as compared to proportion in preceding year. If the turnover is declining, it never leads to NPA. Declining turnover is not a condition for NPA. No effect. Declining turnover is not a condition, no effect. No effect will be taken. Are you getting this point? The renewal of overdraft facility due on 20th October. The account was short renewed by competent authority for 3 months. So something was due on 20th October. It was renewed for 3 months. That means November, December, Jan. It is renewed for 3 months till 20th of Jan. What is the status as on 31st March? Feb, March, around 2.5 months. It is beyond its date of renewal. It is absolutely fine. Renewal should happen within 180 days. Renewal should happen within 180 days. It got short renewal till 20th of January. After that, it should have been renewed within 180 days. It is not yet renewed. It is absolutely fine. It is within 180 days. Not submitted complete renewal papers till 31st March. There is a request letter from borrower on record stating that valuation report of property located at a far location was taking time. Okay. So renewal is due. They are explaining the same case. I think renewal is not done because one property valuation is pending. It is absolutely fine. Property valuation is pending. You got enough time. You got 180 days. And right now, hardly how many? From 20th of Jan to 31st March, it is how many days? 11 days of Jan, 28 days of Feb, 39, then around 70 days only. Hardly it is 70 days. It is absolutely fine. So point in the whole case, it is absolutely fine. In exam, they may twist it somewhere or the other. It is very simple, straightforward application of knowledge. What we study about CC and OD limits and their clarifications. Okay. Now, this question is asked in November 22 mock about sale and purchase of NPA. Can sale and purchase of NPA happen? Yes, but there are conditions. Sale and purchase can happen, but there are conditions. Listen, same thing is there. So for sale, there is a condition. Number one, you cannot sell a NPA account till the time it has remained in your books as NPA for at least 2 years. So number one, if you want to sell, try to recover the money at least for 2 years. If you're not able to do that, then you can go for sale. When you go for sale, it should be only on cash basis. No credit basis. Amount should not be contingent. It should be without recourse. If the other party doesn't recover money, it should not come on us. It should be a full and complete sale without any obligation, without any risk. So wait for 2 years and then sell. When you sell on cash basis, when you sell, it should be without recourse. No liability should come on you. And then fourth, no legal and operational liabilities on the same lines. When it is sold, it should be removed from books of accounts. See, it's again common sense. Sell it after 2 years, only on cash basis, without recourse. You should not have any obligations on you. When it is sold, remove from books. If there's a shortfall, you get less money. If it is sold for a price less than book value, it should be booked as loss. But if you get more value by any chance, it may happen. You get more value, it should not be treated as profit in the P&L. In fact, that extra amount should be transferred to NPA. Provision for NPA, it can be used for others. If you try to remember in this sequence, you will retain more. For how many years, what should be the terms, what should be the terms and conditions, what should be cash basis, terms and condition, without recourse, which should be removed. What will happen if you get less amount, what will happen if you get more amount. So we have divided, there are some things which are connected to sales. We have segregated it. Then there are some things which are connected to purchase. If a bank is purchasing NPA, ensure it is not the NPA which was originally sold by them. So don't do that. You sold something and then again after a few years you are purchasing that thing. It doesn't make sense. It doesn't show your genuine intentions. You should not purchase a NPA which you have only sold some time back. Then once you purchase, The NPA purchase has been subjected to provision requirement appropriate to classification stated in books of purchasing bank. That means when you purchase, think from the purchasing bank point of view. Again, everything will start. Again, due date will be considered. And if amount is not paid, we'll wait for 90 days and then declare it NPA. And then we'll go for provisions. Are you getting this point? Now, if you get money, if you purchase NPA accounts, NPA loan, if you get money, don't treat it as income. First, recover the cost. Suppose you purchased an NPA loan for 40 crores and in first year you got 10 crores. Treat it as a recovery of the loan amount. Treat it as recovery of the cost. Once the whole cost is recovered and then you get anything extra, that should be treated as income. Be conservative. All the recovery first should be treated as recovery of cost. And you know capital adequacy ratio? Capital adequacy ratio. What is the formula? Tier 1 capital plus Tier 2 capital divided by risk weighted assets. What is the risk weighted asset? Take the list of the assets, apply weightage. Cash 0% risk. Government bond 0% risk. So these are risk weightages. So you take the assets, multiply by the weightage and you get risk weighted assets. Now this NPA loan which you have purchased is definitely a very risky asset. What should be the weightage? 100. So let's freeze guys. There are few conditions for selling bank and there are few conditions for purchasing bank. Don't buy your own NPA. After purchasing, apply your own NPA rules, NPA requirements. When you buy, debit it to the cost of the loan. Treat initial money received as recovery. Once recovery is done, then you go for income. And you should give what weightage? 100% weightage. So there is a question, November 22 mock about sale purchase of NPA. Come to 470.200. November 22 mock. A very simple thing is there. Large number of cash credits in the branch. You observe that during the course of audit, there are large number of cash credit. Bank has given lot of short-term financing. CC and OD is short-term financing. Large number of credit accounts are there. And that is a unique thing. Whole year there is no utilization of the limit. Whole year people are not using the limit. Suddenly in the month of March, everyone using the limit, fully utilized. And then you see that whoever has utilized the money, they have made FDs. So in month of March, they have withdrawn loads of money and they have made FD. And this transaction is reversed in the month of April. Comment. So it is window dressing. This is fraudulent financial reporting. They are manipulating balance sheet of the bank as on 31st of March. Lot of money is taken in the name of CC and again deposited in the bank. So both things will increase. In bank's asset side, loans given will increase. And on liability side, FD's deposit received will increase. So balance sheet will become bigger. Asset side will also become bigger and liability side will also become bigger. It will appear as if bank branch is working very hard. They are achieving all the targets of loans. They are achieving all the targets of deposits. The complete thing is manipulation, window dressing. So you need to explain. They have explained the case first, what is happening. You need to explain this is not a genuine transaction. At one point money is given and same point money is coming back. That means it's a pure rotation of money from one pocket to another. These are not genuine transaction. Further proof is it is liquid, it is reversed in the month of April. So it is not a genuine transaction. There is no real transfer of money. It's only rotation being shown, and this is done to manipulate balance sheet of bank as on 31st of March. So we should ask management to nullify it immediately. It is not a genuine transaction, it is manipulation. It should be reversed in the month of March only. If they do it, great. If they don't do it, put it in audit report, put it in LFR. LFR stands for long form audit report. So it's a simple questionnaire. It's a simple questionnaire on internal functioning of the banks, various departments. Are they good in raising deposits? Are they good in giving loans? Are they good in making investments? Are they good in maintaining CRR and SLR and so on? Whether various departments are working properly, we have to comment on long form audit report. So we will report there also. So guys, it's very simple. You explain what is the case. It's a complete window dressing. It is an okay 473. Listen, it was asked in recent exams. It was asked in recent exams, but I will just give the flow. See, if you get the flow, you automatically retain things for a long period of time. Like evaluating credit card internal controls of credit cards. What we have done, we have brought things in a flow. Number one, unissued credit card. Inventory of unissued credit card should be kept in safe hands with adequate security. There should be physical security over unused credit cards. Number one. Then, before issuing it to anyone, there should be scrutiny of the person, his financials, his financial health, and then only you should give credit card. Limit should be again decided as per financial health of the person. First, scrutinize the person, see his financial history, then give, and give proper, after analysis, give proper limit also. After giving limit, ensure that before any payment is made with the help of credit card, system should ensure limit is available. Now, all these things are happening electronically. Earlier things were manual. Ensure that when the credit card is swiped, the first thing system changes whether limit is available for making payments. Then, if limit is available, then payment should be done with the help of credit card. Immediately, intimation should be sent to the bank, okay, payment is done, this limit is consumed. This limit is consumed, and bank should ensure that now the money which is paid with the help of credit card, that is reimbursed to merchant. First money will go from credit card to bank. Sorry, from payment will be done from credit card. It will not go directly to merchant. It will go to the merchant's bank. Whatever the payment machine in which you are swiping, it will go to them, and from them it will go to merchant. Ensure that money is properly collected one place and then reimbursed. Ensure as soon as payment is made, who is charged? Customer is charged, his limit is consumed. And finally, monthly statement should be properly prepared and given. So when you talk about internal controls, it's in sequence. First, storage, then issue. Storage should be proper, explain controls. After storage, screening should be there, limit should be there. After that, before making payments, limit should be checked. When payment is made, bank should be informed, customer should be charged, and then merchant should be given that money, and last statements should be prepared, and there should be monitoring whether any credit card is misused, excessive payments, lot of payments, no deposits. So bank will have softwares to analyze all these things. That's called monitoring, and they will make list that these accounts are appearing doubtful or something is wrong with these accounts. Okay, that's enough for the bank. Now, after bank, guys, as I said, peer review, study peer review. We will not go anywhere before studying peer review. You're frightened of peer review? No, sir, there are changes in peer review. Okay. Come to insurance. We'll see two questions again. 2, 3 questions of bank. We should feel, oh, we are done bank audit. See, as from day one, the focus is that we use our time properly, whatever time we have, and try to reach as far as possible. Next is, now this is important, joint audit. So it is asked in May 21 mock. There are two types of insurance companies. One is government company, that is PSUs, and then there is others. In PSUs, who is going to make appointment? CNH. And when it comes to others, who will make appointment? Board of, no, shareholders. If they are companies, appointment will be done by shareholders at AGM. So you simply need to explain, in case of PSUs, appointment will be done by CNAG. In case of others, appointment will be done by at AGM. Now what is the question they are asking? There are two firms. There are two firms and they are appointed as joint auditors. Next thing to understand, joint audit is mandatory. In case of insurance company, there cannot be single auditors. Only joint auditors are there. It is mandatory for each and every insurance company, whether general insurance or life insurance. General insurance or life insurance, joint audit is mandatory. So there are two firms and they are saying that they are auditors of general insurance company, one general insurance company, then ROK is being appointed as joint auditor of one more general insurance company. TNK is appointed as joint auditor of one more life insurance company. How many further audit can be accepted by ROK and TNK respectively, either of general insurance or life insurance? Listen this. So what is the rule? A firm can do maximum 3 insurance audits and maximum 2 life insurance or general insurance. So there is total limit of 3 and then sector wise limit of 2. Total limit of 3, sector wise limit of 2. So first explain who can appoint, then explain joint audit is mandatory, then explain total limit is 3, then explain sector limit is 2. Now it's very simple. Let's think about ROK. ROK is already auditor of one general insurance and they are appointed for one more general insurance. So now, if first we see totality basis, they can accept one more audit of insurance company. And now they cannot accept general insurance, limit is over. They have to, they can accept only life insurance. When we talk about ROK, they have already consumed. So we first need to comment of total thing. One insurance and that too, that one should be life insurance. What about TNK? TNK is already having one general insurance and one general insurance, they are getting one more life. Okay, now total basis, TNK is already having 2 audits, one general, one life. They can accept one insurance company audit and that one can be either general or either life. Now the whole thing will be, are you discussing case and giving proper conclusion? If you are not discussing this case and not giving proper conclusion, correct, you won't be getting full marks. These are very easy questions, but proper discussion and conclude. And again, if you have seen this question once, you will crack it, but then that one time is required. Across these sessions, we have seen these questions are not difficult, but at least once you should be aware what is this whole concept, what are the broader points which I am supposed to remember. Exactly like this. For each question, either you should have a chart or you should have points written like this. Take each and every question to this level. Now, and I've said you can get this soft copy. Now, next is facultative reinsurance. Now, see this chart. So we have this chart quickly. Let's see. It's not there in here. Okay. If there is an IMP is not there, IMP list there or not there? Okay, team deleted it. Great. They included the. Okay, fine. You. I will share straight away. Uh, It is shared on the Telegram channel. Quickly. Types of reinsurance. What in the reinsurance? When one insurance company does its insurance from other insurance, that is reinsurance. Company which is doing it, company which is uh, doing this reinsurance, that is called doing it is called accepting reinsurance. Okay. Company which is giving its risk, that's called ceding, and which is accepting it, that's called accepting reinsurance. So two insurance companies are there. Entity who is covering its policies, that's called ceding, and the insurance company who is doing this, it's called accepting reinsurance. Anyways, now we know what do you mean by reinsurance. What do you mean by reinsurance? Then we know next is and we know that there is one ceding company and then accepting company. Next is types of reinsurance. There are two types of reinsurance, that is facultative reinsurance and treaty reinsurance. It's very simple thing from the insurance company point of view. So if insurance company is having very complicated insurance policy, they've issued very complicated, very big, critical insurance policy, like they have done insurance of ISRO, insurance of Taj Mahal, insurance of India Gate, anything, insurance of big stadium, insurance of a nuclear plant, and now they feel that their risk is very high, they want to get reinsured. So they will call reinsurance company, sit face to face, discuss the points one by one, discuss the complete policy, discuss each risk due to fire, risk due to theft, risk due to enemy action, earthquake, floods, discuss each risk and seed this risk one by one and decide what should be the premium. This is a very time consuming process. It's very time consuming process. Lot of negotiations happen and then final reinsurance happens. Insurance will take place. That is called as facultative. So when you do reinsurance on case to case basis by giving one risk and deciding and negotiating premium, that is called as facultative reinsurance. Next is treaty. If reinsurance company is having, suppose reinsurance company recently opened their branch in South Africa. Now they are saying, I want to do reinsurance of all the policies which I issue in South Africa. I have certain terms and conditions as per which I am going to issue standard policies. I want that as I do insurance in South Africa, automatically it should get reinsured. Treaty reinsurance means when you are doing reinsurance for class of policies, category of policies. For example, all the policies issued in South Africa or all the marine insurance policies. When you do it, for a particular category, or say you do it for all the policies having sum assured more than 100 crore and up to 500 crore. You do it for class of categories. It can be area wise, it can be nature wise, it can be depending on amount. Without going into each policy in detail, that is called as treaty reinsurance. Once it is done, automatically reinsurance keep happening. You don't have to go and discuss and negotiate each policy. So when you have to go on case to case basis, that is facultative. When you go for class, it is treaty. Now in treaty there are two more, proportional and non-proportional. If terms are such that you will end up sharing premium income and claim expense, claim loss, premium income and claim loss in same proportion. If terms are such that you will end up sharing premium and claim in same proportion, that is called as proportional treaty. For example, if terms are such that you will be sharing 20% of premium income also and you will be sharing 20% of claim loss also. That means if premium comes, 20% premium is yours, and if claim comes, 20% you will bear it. So if sharing is in same proportion for premium and claim, it is called proportional. In proportional, there are four types. Let's freeze. What are we discussing? Types of reinsurance. First classification is facultative, case to case, and then for category or class. In that we have further two, that is proportional and non-proportional. So we are discussing now proportional. If percentage is fixed, if fixed is fixed, so you say that South Africa, whatever policy I issue, 30% premium and 30% claim will be to the reinsurance company. If there is a fixed percentage, that is called as quota share treaty. So but then there is a problem in this. As business goes on increasing, percentage is fixed, amount is not fixed. My risk will go on increasing on continuous basis. Suppose business is of 100 crores, sum assured is 100 crores, 30 to them, 70 to us. Sum assured is 500 crores, 30 to them, okay, 150 crores, and then 350 to us. In quota share, percentage is fixed. As business increases, our sum assured also increases, there also increases. The only problem is there is no upper limit to our sum assured. Our risk keeps on increasing without any upper limit. That's the problem. No upper limit. And that's why there is a next treaty, and that is called surplus treaty. Now what happens in surplus treaty? In surplus treaty, company wants to take fixed risk, fixed amount, not fixed percentage, fixed amount, that I will take sum assured or risk of say 10 crores. Okay, I will take sum assured my risk of only 10 crores. That is called one line. It's called one line. See, we are in India, so I contact one UK insurance company. Will you do my reinsurance? Okay. My monetary amount or monetary limit is 10 crores. So I will listen. What is this one line? The base amount in which multiples things will be taken, that is called as one line. So I will say, listen UK guy, our base amount is 10 crore. That is called one line. I will do reinsurance in multiples of 10 crores. So I want 5 lines from you. 5 lines from you. That means I am doing reinsurance of 50 crore from you. Then I go and call Japanese guy. I want 6 lines from you. That means 60 crore from you. Or let's freeze 50 only. 50 crores from you. So listen guys, it's very simple. When I go for reinsurance and I say that I don't want fixed percentage, I want fixed amount, and the base amount will be called as one line, and I will talk in multiples of line, that base amount. So 50 crore reinsurance from UK and 50 crore from Japan. Total how much? 100 crores. When I keep my amount fixed, that is called 100 crores. My risk amount, my sum assured amount is fixed. Now see what will happen. If during the year business done is 200 crore, my amount is 100. Reinsurance is, sorry, okay. No, listen. When I do, again, when I go for reinsurance, I have fixed amount of reinsurance, Okay. That means if business done is how much? 200 crores. Business done is 200 crores. If business done is 200 crores, 100 will go to them. Yes. Okay. Wait. I जनरली एक्सप्लेन हिंदी तो उसमें अलग करता हूँ, यहाँ पे मैंने कुछ अलग कर दिया. Once again, fine. Once again, quickly, in this quota share, percentage is fixed, but I want to keep my amount as fixed, that I will bear only 10 crores. Now let's fix to that only. I want to keep my amount fixed. I want my sum assured of 10 crores only. Okay. And if my sum assured goes beyond 10 crore, you will bear it. Okay. Now listen. Suppose total business is of 20 crores. I am going to take how much? Base how much I am going to take? 10 crores. And 10 crores will be yours. So I will keep my risk amount fixed, sum assured fixed. End of the year we will compute. Total business was 20 crores. Now we will compute percentage. 50% is mine, 50% is yours. 50% premium mine, 50% claim, 50% of premium is yours, 50% of claim is yours. Suppose end of the year business is 40 crores. My amount will remain 10. 30 will be yours. 75% of premium will go to you and 75% of claim will go to you. Sir, what is the difference between two? In quota share, percentage is fixed. In every policy, 30% yours, 70% mine. But here, amount is fixed. So what will happen? We will keep our amount fixed and end of the year percentage will be computed. So it may happen that I am sharing 20% with the guys, or I am sharing 50% with them, or I am sharing 75% with them, or I am sharing 80% with them. So in surplus treaty, amount will be kept fixed, and any surplus above that amount will be shared with the reinsurance companies, and end of the year you will compute percentage, and in that percentage premium and claim sharing will happen. Okay, so sir, in quota share percentage is fixed from day one, but in surplus percentage is not fixed, it is computed end of the year, and in that percentage you will share premium also, in that percentage you will share claim also. Are you getting this point? Because we are discussing proportional treaty. In proportional treaty, premium and claim should be in same proportion. So the only difference is here from day one percentage is same, and here end of the year will compute the percentage. Any sum assured above that limit will be taken by the reinsurers. Percentage will be computed at the end of the year, and in that percentage sharing will happen. Next is auto facultative. Sir, what is this? Listen guys. Now, what is auto facultative? Listen, reinsurance company will have their own quota, own limits. That means, now come back to that example. We went to UK and we said that we want a treaty from you. So UK guy said, okay, I can take risk of 5 lines. That means 50 crores. So whenever extra thing happens, keep on giving it to me. Japanese guy said that I can bear further 50 crores. So whatever extra happens, keep it giving to me. But listen guys, at one point of time, these treaties will get exhausted. I kept giving business to them. UK treaty got exhausted, 50 crores. I keep giving business to Japan, it got exhausted. So what they're saying, at a point, after a point of time, your surplus treaties will get exhausted as per the maximum amount given by your reinsurers. Then what will happen? So I said, I have done one more thing. I have spoken to one Australian insurance company, and I've discussed with them that, listen, I am doing business in South Africa. I have a surplus treaty of 50 crores in UK. I have one more surplus treaty of 50 crores in Japan. Suppose if they get exhausted, I will come to you. I will come to you and I will decide whether to go for reinsurance. Option will be with me. I will come, I will sit face to face, discuss things, and I will decide whether to go for it or not. And don't worry, I will pay premium for that. Just like you pay premium for call option and put option. On the same lines, because I am getting that option, I will pay premium for that. Correct? Now that is called auto facultative. Why I say that is called auto facultative? It has both the features. To a certain limit, listen, to a certain limit, surplus treaties are working and reinsurance is happening automatically. Once that get exhausted, we will get the option, we'll go to Australia, sit in front of them, and we will decide as per that circumstances whether to go for reinsurance or not. We are discussing and sitting and discussing with him and deciding. So that is in nature of facultative. If you are having both the features, till a point of time you are sharing, and after that you have option to decide, that is called auto facultative. So let's freeze guys. When limits of surplus treaty gets over and you want to do more reinsurance, you pay premium for that, and such policies are called, such reinsurance called auto facultative, because both the features are there. You need to keep the other party informed of what is happening, and the document is called Border Acts. Border Acts is the document you keep informed. See, this is South Africa. This is the status as on today. This is status as on today. This much limit consumed of Japan, UK. This much limit consumed of Japan. It may come to you. You need to keep informing all the details to such Australian entity, and that is called as border acts. What is pool reinsurance? When reinsurance is not done by one company, it is done by pool of many insurance companies. That is called as pool reinsurance. What do you mean by that? It's very simple. Suppose there is a risk of loss due to terrorist activity. Due to terrorist activity, it's a big risk. In pool reinsurance, all the insurance company will share a fixed percentage of their premium in the pool. And if their loss due to terrorist activity happens, then amount will be paid from the pool. If you are sharing 15%, loss sharing will be also 15%. That is called as pool reinsurance. That's very simple. You share more, you will get more of the claim. Once again, when reinsurance is not done by individual company, it's pool of many companies, that's called reinsurance. The percentage in which you share the premium, in same percentage you will bear they will bear the claim also. That is very good because pressure doesn't come on one insurance company. The pressure is going on the pool. Quickly, there are 4 types of proportional: fixed percentage, quota, fixed amount, surplus, beyond surplus, auto facultative, and when there is no company but a group, that is pool reinsurance. Then we have non-proportional. What do you mean non-proportional? Non-proportional means I am not going to share premium and claim in same percentage. In this policy, we are going to share claims beyond certain limit. Claims beyond certain limit for a negotiated premium. Forget about it, how much I got. I will negotiate premium from you. I will negotiate premium for you and I will pay only that much amount. Are you getting this point? So and there are 2 types in non-proportional: excess loss and stop loss. So what happens in excess loss? In excess loss, we say that, listen, I will bear loss of 100 crore only. If claim loss goes beyond 100 crore, you will bear it. That is called excess loss. Treaty in which it is written that loss beyond a particular amount, excess loss will be borne by you for a negotiated premium. That is called as excess loss treaty. So we will fix 100 crores of loss by me, 200 crores of loss by me, 300 crores of loss by me. That is called excess loss. Then what is stop loss? If loss beyond fixed percentage will be borne by you, that's called stop loss. That means, suppose we say that 75% of the premium. That means if business is of 100 crore premium, 100 crore, 75%, my limit will be 75 crores. Anything which goes beyond 75 crores, you will bear it. Suppose premium collected during the year is 200 crores. Then 75% of 200 crores, 150. Anything which goes beyond 150 will be yours. If I am not fixing the amount, I am fixing the percentage. As business grows, my loss bearing capacity also increases. That is 75%. And if it goes beyond that, you will bear. Are you getting this point? Yes, no. Some people have doubt also. What is difference between excess loss and surplus? In surplus also you said anything which goes beyond 10 crore you will bear. Here also you said anything which goes beyond 100 crore you will bear. There we were talking about risk amount and we were computing percentage at the end. We were talking about risk amount, sum assured, and we will computing percentage at the end, and sharing was happening in a percentage. Here we are talking about claim amount. Listen, if limit is 100 crore, every rupee till 100 crore will be borne by me. Only when loss goes beyond 100 crore, it will be borne by you. There's a difference between two. In surplus treaty, end of the year we compute percentage. And every premium and every claim is shared in the same percentage. Here, sharing doesn't start from day one. Sharing starts only when loss amount exceeds a limit. Are you getting this point? Let's freeze quickly. We have just discussed types of reinsurance. One is facultative, other is treaty. In treaty, proportional and non-proportional. 4 types of proportional, 2 types of non-proportional. Non-proportional, we have excess loss, loss beyond fixed amount, and stop loss, loss beyond fixed percentage. Now, okay, come to this question. Facultative types of reinsurance. Facultative. Listen. You first explain when we go and do reinsurance of one by one, case to case basis, that is called as facultative. We do it for big policies, complicated policies, risky policies, unique policies, we do for it. Listen, then they are explaining what are the main drawbacks of this type of insurance are volume of work involved and time taken. It is, however, still used even today mainly. Why we use facultative? When it is so time consuming. When it is so time consuming, why do we use it? Why do we use it? So the shortcut is Tata Nagar city. Why we still use it? Tata Nagar. T stand for treaties. T stand for treaties. Listen, some treaties, some risks are not covered in treaties. So we don't have option. There are some nature of risks which are not covered in common treaties. We don't have any option. We have to go for facultative. We have to go for facultative. Then A stand for automatic covers. Sometimes automatic covers are exhausted. That means my surplus treaty, everything is exhausted. I am not left with any option but to go and discuss and negotiate and go for reinsurance. We are discussing why people go for facultative. Sometimes treaties don't cover proper risk. We have to go for facultative. Or limit is exhausted. We have to go for facultative. Again T. Sometimes insurer does not want his reinsurance treaties overburdened. He says that, oh, it's such a big policy. If I put it in treaty reinsurance, my limit will get consumed. I don't want to consume my limits. So better that for such a big policy, I go for facultative reinsurance. I don't want to pressurize my surplus treaties, my proportional treaties. So let's go for facultative. With particularly heavy abnormal risk. Then again A stand for the insurer is not having automatic cover for particular branch. For some branches, I am yet to start with reinsurance policies. Till the time I don't have separate treaty reinsurance, I should go for facultative. It is not available. N stand for nature of business. If it is very technical, very complicated, lot of discussion, analysis required, we should go for facultative. Quickly guys, why people go for facultative? Karanagar, T stand for treaties don't cover the risk. Treaties don't cover the risk. Then automatic cover is exhausted. Then next is we don't want to overburden our treaties. We don't want them to get consumed. Next A, no automatic cover is available for some branches and areas. N is for nature of business very technical. Come to 507.045. Listen, now we won't be able to cover everything, but still, can we issue insurance policy without receiving commission, without receiving premium? No. Or it insurance never works on credit. At least first premium should be received. Remaining premium can go on accrual basis. Till the time first premium is received, we can never issue policy. First premium should be received, then only policy can be issued. Okay. Now, it is asked in November 22 RTP, what is FLC? Very simple. That is free look cancellation. See, it's a catchy thing, catchy name FLC, and it has been asked in November 22 RTP. So it's very simple thing. What it says that whenever you issue insurance policy, whenever insurance policy is sent to the policy holder, so insurance company will get the premium, they will issue the policy, they will send it by courier to the person. Whenever insurance companies send insurance policy to the policy holder will have 15 days to cancel the policy if policy holder is not happy with terms and conditions. No questions asked, insurance company will have to refund the premium amount. So as per insurance regulations, you simply need to explain the meaning. Meaning is very simple, that whenever policy is sent, a forwarding letter, a covering letter should be there. We should clearly explain, if you are not happy with any terms and condition, you can go for refund. We will pay back the whole premium to you. That is FLC, free look cancellation. Second, you explain the reasons. Only if the person is not happy with terms and condition, no other reason is acceptable. Only when he cannot say that I want to buy another policy. So simple thing is, they should specify that they are not happy with terms and condition. That is only the valid reason, acceptable reason. Okay. We'll first explain the meaning, then we'll explain the reasons. Then third is mode of communication. FLC request means cancellation request. Cancellation request can come for email, fax, letters, in any manner. In case of written letters, the signature of policyholder should be matched with original proposal. It can come in any manner, signature should be matched. And whenever they receive this, refund should be done either by check or by direct credit to the policyholder. Either directly give the check or credit their account. Now, the most important thing is the last thing, deduction. Full amount will not be. This will be asked in the MCQ. Full amount will never be refunded. You have to deduct what? Proportionate risk premium. Coverage was there for 5 days, 6 days, 7 days, 8 days, 9 days, 10 days. You were covered for 10 days, so proportionate premium will be deducted. Then expenses incurred for medical examination will be again deducted. Otherwise, people will start misusing it. You want to get their health checkup done, go for insurance policy. And then you say, I am not happy with terms and condition. So when they will refund, they will first deduct proportionate risk premium, expenses for medical examination. Third, stamp duty charges. 3 things will be deducted. They may give a simple numerical also. They may give They may give a MCQ also. How many things will be deducted? So we took some questions from general insurance and some questions from life insurance. Correct? Now, that is how we will be completing one by one chapters. Otherwise, we won't be able to cover all of them. We won't be able to reach peer review. Okay. Audit of PSU. Let's understand different types of audit which are there in PSU. So if you see page number 64, they talks about 5 different types of audit. It's about 5 different types of audits. Let's see, financial audit, compliance audit, performance audit, comprehensive audit, and propriety audit. Now, how these audits are different from each other? Financial audit, as name suggests, in this audit the complete focus is whether financial statements are as per applicable law and standards which are framed for the government, whether financial statements give true and fair view, and whether proper systems are there to prepare financial statements. So it's all about financial statements, compliance, true and fair, and proper systems. When it comes to compliance audit, it is all about whether all the requirement of constitution, constitution there is law, act, act there is rules, regulations, then orders of authorities. Whenever a particular activity is performed, is it as per law, rules and regulation, that is compliance audit. So major focus is whether law is followed or not, and sometimes CNAG is also asked to check whether the law itself is appropriate. What the thing? We'll see. Then we have performance audit. Performance audit is simple, improving 3 things. How can we improve efficiency? How can we improve economy? Economy means acquiring resources at lowest cost. How can we make things economical? How can we reduce costs? After that, how can we make things efficient? That means better use of the resources, better use of money, better use of land, better use of laborers, better use of engineers, how we can make things efficient, how we can improve input output ratio, and effectiveness. Effectiveness means how we can better achieve objectives. How we can better achieve objectives. Whenever you study performance audit, study it from the point of view of government programs. Like we have Manrega. It is an employment scheme, and it says that minimum employment should be provided to workers in the rural areas. Minimum guarantee that you will be given so many days of work during the year. So improving effectiveness, how to increase number of days, how to make program better and better, that is called effectiveness. Improving 3 is economy, efficiency, and effectiveness. Then we have comprehensive audit. As name suggests, comprehensive audit, everything about our organization, about government entities, everything from start till end, that will be covered in comprehensive audit. We'll see. And lastly, it is propriety audit. Whenever any expenditure is done, to go and think beyond rules and regulation, whether it is giving real benefit to public at large. First of all, it should give real benefit. It should not be wastage. It should not be useless. It should give real benefit. And secondly, it should be for public at large, not for individuals, particular group, caste, community. Let's freeze, guys. So when we discuss audits by CNAG, Comptroller Auditor General of India, and its department is IAD, Indian Audit and Accounts Department. When we study about them, 5 different types of audits are generally discussed. Okay. Let's see one by one. Financial audit, as discussed, the complete focus is whether financial statements are as per applicable financial reporting framework. That means applicable law, rules, regulations, and standards which are specifically framed for government authorities, government entities. So that is the focus. and then whether they give true and fair view, and further whether government is having proper internal control system to prepare financial statements. Are they having proper softwares or proper mechanism to collect trial balance of all the branches, all the ministries, to compile them into one single financial statement to ensure completeness and accuracy? Are they having proper internal control system which ensure complete accounting records, accurate accounting records, and good compilation? So three simple things are focused in financial audit, which is almost same to what we study in general in financial audit. We also do the same thing. Whether financial statement as per applicable framework, if it's a fair presentation, whether it gives true and fair view, and we also comment whether as per Companies Act, whether internal financial controls over financial reporting, whether IFCR is adequate or not. Same things are commented here, no change at all. Next thing is compliance audit. So what is done in compliance audit? Two things are done. Either in compliance audit, they will examine a transaction. That is subject matter. It's called subject matter. Any transaction subject matter. It can be income, it can be expenditure, it can be asset, it can be any liability. They examine any transaction with respect to income, expense, asset, liability. Is it the biggest law is Constitution? Is it as per Constitution? Below that, law. Below that, rules. Below that, regulation. And other orders and instructions of competent authority, whether it is complied with. That is the focus of compliance audit. Now listen, financial audit happens for central government, state government, almost every year. What happens? Financial audit. But compliance audit is not like that. Compliance audit doesn't happen every year. It is case to case basis. Suppose a very big like defense deal is going to happen. Defense deal has happened. For example, Rafale deal has happened. So CNAG may select big transactions and big deals, and just to ensure whether everything from constitution till order by authorities, whether everything was complied with. That is compliance audit. So you can understand when the focus is full financial statement is financial audit. When the focus is only few big transactions and whether it is in line with law, rules and regulation, that is compliance audit. Next, it may also involve examining law, rules and regulation itself. Examining the law itself, what we check? Whether these law, rules and regulation, are they against the constitution? Are they against the constitution? If they are against the constitution, that means they will be void. Nothing can override constitution. Sometimes CNAG said you go and evaluate the law itself. Whether law is appropriate, is it as per constitution, and is it against other laws? If it is against other laws, we need to find out which law will prevail, which law. We need to find out the solution. So go and examine the law, rules and regulation. Is it against constitution? Is it against the other laws? Then go and examine what kind of controls are designed in the law. Sir, what do you mean by that? See, every law which is related to income, expense, asset, liability, it will design some system. It will design some system on how things should take place. That is called as internal control system. For example, if anyone wants to withdraw money from central government, they have to give UCs, utilization certificate. For example, suppose central government says that we will give Andhra Pradesh 5,000 crore for the welfare of children. 5,000 crore. There should not be malnutrition and so on. Andhra Pradesh government will not get it immediately. First, they will have to submit the plan, how they will use 500 crore. Then they will be given 500 crore. Once they are given 500 crore, they will have to submit certificate, how we have used 500 crore. Then they will get next 500. Then again submit certificate that we have utilized it. Then and so on. So every law, rate, income, expense, asset, liability, it will have a internal control system to ensure smooth functioning of the income, expense, asset, liability. Go and see whether what kind of controls are designed in the law. Are they really good? Are they really effective? Are they really working? Whether law requires maintenance of clear and unambiguous records. Majority of the law says that these registers should be maintained, so and so information should be recorded and maintained. So we will evaluate that also, what kind of documents it is asking to retain. And finally, whether department, if compliance audit is happening, whichever department is doing that transaction is able to achieve its objectives and aims. Suppose law is framed by following law, whether government is able to achieve its objective. Suppose there is a law for proper defense deals, whether it has achieved its objective. Let's freeze, guys. In compliance audit, how many things will happen? Two. First of all, whether transaction of income expense are as per constitution, law, rules, regulations, and orders of the authorities. Second, examining the law itself. Is it against constitution and other law? If it's not against, next, whether proper is it designing proper internal control system? If yes, next, is it asking to maintain proper records, financial, non-financial records to keep track of how things are happening? Next, whether after implementing this law, proper objectives are achieved or not. So to examine the law itself, how good is the law, even that is done in compliance audit. Now listen, there are different ways of doing compliance audit. Compliance audit can be mixed with other audits. For example, mixed, there can be various ways. Doing compliance audit separately, altogether different assignment itself. You know, Augusta Westland was a scam. So different, altogether a different assignment. It can be a separate assignment itself. Rafale, separate assignment itself. Augusta Westland, separate assignment itself. Or it can be done with financial audit. Combine them. When you are checking a transaction, see the financial point also and see compliance point also, legal compliance point also. So it can be combined together with audit of financial statement or in combination with performance audit. When you are checking economy, efficiency, effectiveness of particular activity, at the same time combine it with compliance audit. Okay, so it can be done either all alone or along with financial audit or along with performance audit. So you have studied very simple what is financial audit, what is compliance audit, two things are done and how it can be combined, either with financial audit or compliance audit. Now come to this comprehensive audit. See, first question was powers of CNAG. I am not covering it, it's very simple. Powers of CNAG are given by two laws. Number one, Companies Act. Companies Act section 143, subsection 5, subsection 6, subsection 7. Who has power to appoint auditor? CNAG. Then who will give direction? CNAG. Auditor will work and give action taken report to CNAG. Who can read and decide whether to circulate or not any part of the full thing? That is CNAG. If he is not happy with the report, he will say add a few things, that is supplementing. If he is not, no, he can supplement. If he wants to put any additional matter, he can comment. If he is not happy with the report, he wants to do audit separately, he can go ask for supplementary audit. Listen, after reading the report, he can ask for additions, he can ask for changes and so on. but is not happy with the overall work, he can go for supplementary audit. And if he himself wants to do the audit, that is called test audit. That is called test audit. All these powers are given in section 143 subsection 567. Powers are also given by CNAG Act 1971. There are two laws which gives power. Even Companies Act give power and CNAG Act 1971 gives power. That is sufficient. Then see what is the famousness of this question. Mock. Every mock we ask comprehensive audit, comprehensive audit, comprehensive audit. Exam it came in November 20. And before that it came in November 18. So there was a gap of 2 years. Okay. This will come again. Now, so they explain complete thing. This is the company, that is the company, and so on. And ultimately, what they ask, explain some of the matters. Question 599.000. Explain some of the matters to be undertaken by the chartered accountant firm while conducting comprehensive audit of Metro Company Limited. See, they explain a lot of things. There's a capital work in progress, this, that's of no use at all. They are finally asking, what do you mean by comprehensive audit? Explain what do you do in comprehensive audit. Come to page number 65. Okay. Listen. So comprehensive audit is generally done for PSUs, public sector undertaking. Generally, PSUs are selected and comprehensive audit is done for them. We assess overall whether entity is functioning properly. See, there's a difference between studying theory and practical. Okay, you will study comprehensive audit. Oh, they're talking about efficiency and effectiveness. We talk about this in performance audit. Here also they're talking about it. How come both can talk about same thing? You got these questions anytime? Don't think much. Listen, those who are good in practical, you should focus on each and every small thing. It is good. When it comes to theory, first part is drafted by someone else as per foreign author. Second part by someone else. Third part by someone else. And further, these parts are drafted at different point of times. Some things are 15 years back. Some are 10 years back. Some are 5 years back. This is one big khichdi. Biryani. Hyderabad, they don't eat khichdi. Okay. What? Sabudana khichdi? No. I'm saying, khichdi. Yes. When you're sick, you eat khichdi. And then I get sick 2-3 times in a week. Okay. So whenever I'm traveling, most of the time evening I will have khichdi. Okay. Listen. Now, what I'm saying, so I have read all the module, everything. Don't make fool of yourself. Now, there is no law or there is no standard or there is no guidance note on these audits. These are broad concepts. Don't go and compare every small thing, trouble yourself and trouble everyone and trouble your memory also, because the people who wrote this, they didn't think much about it. You are unnecessarily thinking a lot, and this is creating problem. You are thinking you are doing in-depth studies. Sir, I am studying in-depth. You need to change approach as per the topic. I can understand in law there is a lot of consistency. One thing is covered in one section, another thing is covered in another section. There is a reason why one section is there, why other section is there. Profound reasons. A lot of research is done. This is open-ended theory. People thought about the concept and they wrote it. Whatever happens in practical, that is different altogether. So you should be smart enough to understand that, okay, they may use similar kind of words. There is small difference. These are the things I am supposed to explain next. Are you getting this point? Because those who don't understand this, they suffer a lot in theory. Those who are good in practicals, they apply their practical mind and then they go mad. It happened with me also. I was in inter. So first day of the law subject, I went to sir, I want to buy dictionary. At our time, there used to Berat was already there. And that's fine. That's evolution. Nowadays, no Berat, it is fine. Correct? So, I want to buy dictionary. Sir said, see, I am there, I will explain. No, sir, I want to buy. Okay, buy. There's a dictionary. Now, my friends are sitting, I am sitting. Whenever new word comes, dictionary, law dictionary, and then there used to be the other dictionary. And there, every word used to have multiple meanings. I used to get more confused. See, because the problem was I was more interested to understand the meaning of the word. I was not focusing what this sentence wants to say. I was not focusing what this paragraph wants to say. What overall this chapter wants to say. So I was much more confused as compared to my friend. They were like, oh, very easy. And then I understood this. More than the words, it's important what that paragraph and what that concept wants to say. That is the way to read theory. Don't apply your practical mind. Approach for studying these two things should be different. In fact, within theory also, there is a difference. How to go about law, Companies Act, how to go about standards, how to go about professional ethics. Now, professional ethics. Don't apply extraordinary brain. Sir, what will happen? WhatsApp? What if I share status? What if I make LinkedIn? And no one is going to ask these questions. They are fixed clarifications. There are fixed clarifications and questions are drafted on that for past so many years, 60, 70 years. Out of 5 to 10 exam, it may happen that they ask something new, different type of question. I can give it in writing on stamp paper. Nothing will come beyond question bank. Nothing will come in P beyond question bank. But then some students, sir, I want to study very conceptual. I want to interpret each and every word of CA Act. Gone. CA Act is most uselessly drafted act. It is not a useless act, uselessly drafted. There are so many inconsistencies, so many confusions. You cannot interpret it word by word. It's a very simple thing. Institute has issued clarification for each clause over a period of time. You should know what that clarification says, and case is exactly on that clarification. Answer as per the clarification. Over. As simple as that. Yes, you should have some shortcut to remember it. So again, many students, they go wrong in their approach and they suffer a lot in theory subjects. Don't do that. Only some students are there. They are good at practical also. They're good at theory also because they know how to change gears. How to go about practical is different. Even a single line changes, whole problem changes. But that's not the case here. Okay. Now PSU audit. Why I'm saying this? Comprehensive audit. Why I'm saying this? You will say, sir, efficiency, effectiveness word. You use these words with performance. Doesn't matter. Overall, checking whether enterprise is working properly, how to make it better, that is comprehensive. Now look at the shortcut. Shortcut is, it's in a flow. Listen, any organization, they go for first research and development. So go and check first thing whether there is adequate research and development facilities and programs in the organization. Are they doing adequate R&D? After R&D, they will develop a new product. They will go for project planning, how to make factory of it, how to make a factory about this product, how to make a production line, how to make an assembly line. So first they will do R&D, then they will do project planning, then they will go and implement the project. That's called formulation and implementation. Finally, as per the project planning, they will go and make the factories. They will go and make the facilities and infrastructure. Then, so we have to check all of them, whether adequate research and development facility is there. After the research and development, whether proper planning is done. After planning, whether proper formulation and implementation is done. After implementation, go and check what is the cost incurred and what was the planned cost. Is there a huge difference between the cost? Then see how is the capacity utilization, whether there is under capacity utilization or over capacity utilization. Next, after capacity utilization, are we able to control the cost minimum? Then only things will become better. During the production, what is the amount of wastage and unproductive things? And finally, whether the final product is economical and effective. And are we earning planned rate of return? After all this, at the end, whether system repairs and maintenance are done properly. First, people will do R&D. After that, they will plan the project, plan the factory. Then formulation and implementation. After implementation, overall cost comparison. After costing, then capacity utilization. Is it under capacity or over capacity utilization? Then after capacity utilization, are we controlling the cost? Are we keeping wastage in check? If yes, then next question is, are we earning planned rate of return and proper repairs and maintenance is done? This is comprehensive audit, asked so many times. Asked in November 22 mock paper also. Now, May 22 RTP. May 22 RTP, we are going about small audits. First we saw financial, then we saw compliance, then we saw comprehensive. Now we are focusing a little bit on performance. Then we are left with only one simple propriety. Now come to performance audit. Different questions are there. Planning performance audit is one question. What are the issues and what to do in performance audit? It is a other question. Now listen. May 22 RTP question. Now look at this. This is great institute. They're talking about electricity distribution company. Electricity distribution company. So there's an electricity distribution company. It must be a government company. And we want to find out total cost of providing electricity is being recovered by timely submission to State Electricity Regulatory Commission. What is the work of distribution company? To buy electricity and to supply. Buy, sell, buy, sell. So we have to go and check where the cost of buying electricity is appropriate. Whether tariffs which are set by distribution company, they are appropriate. Whether billing etc. happens properly. Whether systems are working properly. What kind of audit is referred in above scenario? Also briefly discuss steps suggested to the auditor for planning such audit. In the whole question, they are not using the word performance audit. They are just talking about a electricity distribution company and what are the challenges which are faced by electricity distribution company. How they can reduce their cost, how they can keep their prices, how they can recover money, and so on. Now listen, guys. So if such question comes where they are talking how electricity company can become better, now you may debate with me, sir. Can't we apply comprehensive audit here? Someone may think, can't we apply comprehensive audit here? Okay, first of all, there is no concept of planning comprehensive audit. Direct comprehensive audit. Here they are saying plan performance audit. Planning of audit. So planning happens only in performance audit. Listen, guys, they are talking about electricity, and the whole answer they are not using it much about electricity and so on. Directly, listen, guys, directly come to planning performance audit. Planning performance audit. The following steps are suggested to auditors for planning and conducting such performance audit. Now, come to chart book. See, page number 65. Planning performance audit. Page number 65, last column. Planning performance audit. Now listen. Post lunch, it is sannata, correct? And that too with rice. Zahar. Okay. Zahar, yesterday was four options. Four options to die. Okay. So, what do you call, there is a word called popat. मतलब to make fool of someone. I am saying in Telugu what you say to make fool of someone. Hey, this is interesting word. So the question is haula. Haul- Halwa नहीं ना haula. Halwa नहीं. अच्छा. Haula is again little unique. Okay. Halwa to I had at hotel today. Okay. This halwa. Then. So how will you make haula of the water? Different ways to make haula of water. What nonsense. Yes. Packaging it as distillery. Good, interesting. So I will give different ways. By the end of the third one, people will go mad out here. Look, please, someone kill me. Yes? One, yes, yes, the different ways. Okay. So, so Jay, is very interesting person. He wants to make howla of water. So one day he wakes up, he wants to go to office, and there's no electricity. India is very common, it can happen anytime. No electricity. So he's alone in his apartment or room as the case may be. He goes to kitchen and gets a very clean vessel, big vessel, puts it on the gas. Then he uses aquaguard to get very clean water, and then he starts the gas, keeps it on for boiling the water, and then he waits till the time water starts boiling and steam comes out. So when the water is extremely hot, it starts boiling, steam is coming out. He says, okay. Quickly, he will shut the gas. He goes to his room, gets ready, and locks the room and go for the office. He makes howla of water. Water thought he's going to use for bath. People are going mad. Someone please save us. This nonsense. Of this better. After receiving this dose, it is better. Now I can better understand. So that is first way. Water thought will be used for bathing, but next he goes to bathroom, takes a bucket. Who what goes to bathroom? Someone are very fond of having a bath, I think. So goes to bathroom. Now he takes a bucket, keeps under the tap, then he starts that. Before water will go down and fall in the bucket, he pulls up the bucket. Sir, this is torture. Water thinks I will fall in bucket. Last. Well, now nothing will happen. We are already wasted. Okay, after third one, you all can give your options. There was a good option there. Correct. Put water in a bottle, unpurified water, and say it's a distillery. It's full of water again. Last. So what Jay does, he takes a lot of ice from the fridge, and almost 75% of the bucket is full of ice. Now he again starts the tap. This time water goes in the bucket. Wow. And bucket is almost full. So it is 100%. Then he covers the bucket for an hour with 75% of ice and hardly 25% of water. And then finally, then after 1 hour he goes. Then he simply puts his hand in bucket. And oh, it's so hot. It is so hot. Then water is confused. It is confused. Am I hot or cold? Like that was so bad. Gone. Yes, ma'am. You want to add something? Yeah. I want to, but I don't want to. How to frame it? No, it's not interesting. It tortures me. See, after listening to this, people will say, okay, planning performance audit is much better. How? Tell. Yes. Okay. See, there's the Zahir effect. अरे Tell them to stay away from the balcony. He will just after listen there if it's someone will jump. Yes. So employee joins a new office. He misses fills the so the employee he does a lot of shopping, gets a water bottle, fills the water bottle, and then he won't take it. He's worried, sir. Virus is spreading very fast. When one zehar was sufficient, so many zehrs. Who will bear it? Okay, listen. Now, come to performance audit. Performance audit. Performance audit is done for the government companies also and government schemes also. If you recall government schemes like Manrega, you will better understand performance audit. So the first question is, if you are planning performance audit, what things you need to consider? How to plan performance audit? See, we have divided it three groups. First, collect information about the program or government company. Collect information. Okay, you were not there for that. Oh, no. Now, what? Next time? People will go mad till that time. Okay, listen. I cannot do such thing. See, okay. Now, planning performance audit, we have divided in three parts. First, we need to collect information, understand what that government entity does or what that program is all about. For example, you should understand Manrega. So in Manrega scheme, it's very simple principle. People living in the rural area will have to make list of facilities which are missing in the village. Hospital is missing, school is missing, garden is missing, or some recreational activity is missing. They will make list. After making list, they will have to formulate a project, complete project report. We are going to make this. This will be the land. This will be the dimension. This will be details. This will be the cost. And then go to the collector or any government authority responsible. Get the approval. Once approval is done, the project money will come. Project will start. They will make the project and they will earn. So two things are happening simultaneously. Different things are made and people are earning money also. That is Manrega scheme. So they are saying that if you want to plan performance audit, first you need to collect information about the government entity or that plan. So what will you do? You should collect information to understand the program. First, collect information to understand the program. What program is all about? It's all about employment and development. Then understand whether there is any rule, regulation, order for this program. So whatever law is there or whatever rules are there, take a print of that and read that also. First, understand overall what is this program is all about. Then understand law, rules and regulation. Then also study management controls. That means what kind of internal controls are designed to ensure this program is working properly. What kind of controls are there? For example, in each district, they will keep track of number of projects completed during the month and number of projects which are continuing. This report is created and sent to the higher authority. So that report, from that report, we understand what is the status of the Manrega across the district and across India. Understand how government departments ensure that these schemes are working properly. What are management controls? Whether weekly reports are prepared, monthly reports are prepared, quarterly reports are prepared. Understand how they control these programs. Reports, what kind of reports, who prepares them, who evaluates them, who takes action. Study management control designed for programs. What kind of systems are designed to ensure that programs are controlled as per requirements of the government? So first step is to collect information so that we understand the program, so that we understand law, rules, regulation of the program, so that we understand, study management controls designed for the program. Next is frame strategy. Once you understand the program, you understand the law, you understand how they keep control over the whole thing, you frame strategy. First is very simple: previous audit significant findings and recommendation. Go to previous audit, read those findings and suggestions. Most important thing, who has done recently this particular audit, what were the findings, what are the suggestions. When you are making strategy, go with the previous year findings and recommendation. Then criteria needed to evaluate matter. Criteria means something which is used for comparison. Benchmark. Criteria. Listen, criteria simply means, like in when it comes to financial statement, FRF is criteria. It is that basic principle, and that format, schedule 3 is the criteria. So understand what is the criteria means, what, whether any targets were set for this program. Criteria means something to which we compare our results. We compare our results. So understand whether any targets were set by the ministries for these programs, whether the team has set some targets. Go and understand criteria needed to evaluate the matter. Criteria means what are the targets, what is used for comparison. Then what potential users want. While framing strategy, what previous audit has to say, recommendations. Then in current year, what standards should be used for evaluation, standards or law. And finally, what users want. Depending on what they want, frame the strategy. Next is draft the plan. From where we collect source of data. Collector office, village office, from where we'll collect data. How many people will be required to collect this data, sufficiency of staff, and finally on this basis write a detailed audit plan. This is called planning performance audit. First is all about collecting information, about understanding the program. Once you understand the program, then what are the, understand the whole concept, what are the legal requirements, and then finally understand management control. So collect information, understand simple things, what program, what law, what controls. Once you collect information, then you frame strategy. First use previous year findings and inputs. Very good to frame strategy. Then current year criteria, what is the benchmark target with which we are going to compare things. And lastly, who are going to use our reports, potential users. Then you go for draft plan, potential, write down potential source of data and its reliability, from where we can collect data, sufficiency of staff and other resources, from where we'll collect data, who will collect data, and make plan in writing. That is called as planning performance audit. May 22 RTP, guys. Now, how many finance committees are there? Come to 604.010. How many financial committees? 3. What? This was asked in November 22 RTP. November 22 RTP. Question is CNAG appointed someone associate, a chartered account firm, to conduct performance audit. To conduct performance audit of PSU. For performance audit, that means 3 E's: economy, efficiency, effectiveness. The firm conducted the audit with view to check all expenses of the unit are in conformity with public interest and public accepted customs, whether expenses are giving real benefit to public at large. The audit report submitted by audit firm was rejected by CNAG. Give your opinion. So they are saying which audit first? Performance audit. Where we are supposed to talk about EEE, economy, efficiency, effectiveness. And in report they are talking about whether expenses are giving benefit to public at large. Is there a problem? Yes. They were appointed for performance audit, but they are giving report as per propriety audit. So this is November 22 RTP. You need to explain that this is performance audit, EEE. You need to explain what is propriety audit to see whether public at large are getting benefit. Whether public at large are getting real benefit. That is propriety audit. And then you should say that this particular report is not appropriate. See what they have first discussed the case and given the conclusion. They're so and so in the case, they're absolutely wrong. They started with performance, they're talking about propriety. There is a complete mismatch. When they explain what is performance audit and what is propriety audit. Okay, both of them are performed by CAG. CAG is also called as SAI, Supreme Audit Institution. They are simply explaining the meaning EEE, economy, efficiency and effectiveness. Listen guys, they are simply explaining propriety audit in detail and they are explaining performance audit in detail and they are saying that this report is inappropriate. This report was for, they started with performance but they are commenting on propriety. Okay, how many committees are there? Finance 3. First is Estimates Committee. Second is PAC, Public Accounts Committee. Third is Committee on Public Sector Undertakings. Listen guys, there are 3 types of committees. See page number 64. There are 3 types of financial committees. Committee which sees what is the plan of the government regarding expenditure. Committee which sees what is the plan of the government regarding expenditure. It does its analysis before expenditure is done. Committee which sees how budget is prepared, is it logical, how to make it better, how it is prepared and presented, how we can make it better and better. So committee which evaluate things before expenditure is done, how to make it better, how to make budgets better, that is called estimates committee. Once expenditure is done, things are audited and report are given. There are 2 committees. After expense is done, 2 committees are there. If you are doing audit of state, central government or state government departments and ministries and departments, their report will be studied by PAC, Public Accounts Committee. Suji scam, coal scam, all of them were read by Public Accounts Committee. If you have seen news article, they used to write PAC, Public Accounts Committee. And next, reports of government companies and corporation, PSUs, is said by COPU, Committee on Public Sector Undertaking. So before expenditure is done, we have Estimates Committee. After expenditure is done, After expenditure is done, report on ministries and departments, we have PAC. Report on government companies and corporation, we have COPU, Committee on Public Sector Undertaking. Now, come to page number 66. See, this is the question 604.010. 601.010 asked in November 18 mock test paper. Listen, what is the question? The Comptroller and Auditor General of India plays a key role in functioning of financial committees of Parliament and state legislature. He has come to be recognized as friend, philosopher and guide of the committees. In the view of above, you are required to list down any four roles. They are saying CNG is a friend, philosopher of the committees. Comment on this. Asked in November 18 mock test paper. Listen. PAC committee and COPU committee, they both have around 22 members. So each committee has around 22 members. 15 comes from Lok Sabha and 7 comes from Rajya Sabha. And all the CAG reports are placed in Parliament. They will randomly select some reports. They will randomly select some reports in their committees. They will read that and they will call CNAG to read this report and explain it to us. So they help committees to understand how audit was conducted, what are the findings, what are the reports, what are the recommendations, every damn thing. So CAG first explains everything to the committee. Then on the basis of that explanation, committee asks question to the ministries. Why employment was not generated? Why benefit is not received? What happened to this particular payment? They ask tough questions to ministers and ask them to give answers. Now, after questions are asked, ministers will give answers. So committee will take into account whose mistake was that, how to rectify things. They will study the report, they will ask questions, they will understand the answers and make their report to Parliament, that which ministers are at fault, what they should do to improve it. Once they submit their report to Parliament, ministers has to act as per those reports, rectify things and submit one thing to Parliament, action taken report. Submit what? Action taken report. You said so and so things in the committee meetings. This is the action we are taking. Let's freeze, guys. Listen, we are studying what is the role of CNAG. What is the role of CNAG in various committees? So you explain these committees in short. These are the committees. There are 22 people. It helps, CAG helps in selection of the reports, reading the reports, understanding the reports, interpreting the reports, and what question would be asked to the ministers. Everything is held by CNAG. So first point is all about reports, reading, understanding and asking questions. Then ministers will reply. Ministers will give reply. Replies from the ministers are received and CNAG again checks whether information explanation is appropriate or not. After receiving reply, they will send their reports to Parliament. They will send their report, their final analysis to Parliament. Everyone can read it and then finally ministers have to do the work as per the report, prepare action taken report and submit it to the Parliament. How many steps are there? 4. Quickly once again. Number 1, Who will help in interpretation? CAG. And they will ask question to ministers. Then who will reply? Ministers will reply with all the detail, their point of view. They will analyze it and they will issue their report to whom? Parliament. And they will give instruction. These are the action you need to do. And step number 4, ministers will ministers will take the action and submit the action taken report to the Parliament. Further, they are saying in respect of those audit reports which could not be discussed in detail by committees. Listen, it is not possible that committees discuss all the report. There are hundreds of reports. Not possible to study all the reports. In respect of those audit reports which could not be discussed in detail by committees, written answers are obtained from the department ministries concerned. Reports which were not discussed, written answers are demanded. That these are the queries and give it to us in writing your answer. From the department ministry concerned and are sometimes incorporated in reports presented in parliament / legislature. For reports which are left out, take a written answer. Because of these actions of the committees, government doesn't take CAG report lightly. Because of this all thing, government doesn't take CAG report lightly because they know people will discuss and ask questions. People will discuss and ask questions either in meetings or in writing later on. Okay, enough of PSU audit. Okay, listen. Listen, it covers 3 types of audit. Page number 70. Okay, let's do one thing. Let's start some technical. Let's start with professional ethics little bit. After that, we'll come back to this chapter also. Peer review. P. Okay. Now listen. We can broadly divide. When we talk about P, there is one initial part, introduction. Then we have first schedule, second schedule, and last we have guidelines. So we can divide it in 4 parts. Listen. Now the initial part it talks about code of ethics. There is a booklet called Code of Ethics and there are 3 volumes. First volume talks about 5 fundamental principles and its implementation. We all know these 5 fundamental principles. If you want shortcut, CBI office explains fundamental principles. C for confidentiality. Again, one more CBI office, C raised to 2. C is again for competence. C is for confidentiality. Whatever information you got during the course of the assignment, keep it confidential. C again stands for competence. Attain skills and knowledge and maintain it. And maintain it when you are performing professional assignments. Professional competence and due care. Attain and maintain the competence and work carefully. B stand for behavior. That is professional behavior. Respect law and don't do anything which brings discredit to the institute. Don't do anything which brings discredit to the institute. And then I is for integrity, being honest, straightforward, and O is for objectivity, being unbiased. Objective words means two things. One is target, another is being unbiased. You should not bring personal liking, disliking, friendship, relation in between when you interpret things. You should remain objective. So, are the five fundamental principles: C for confidentiality, then competence and due care, behavior, professional behavior, I for integrity, and then objectivity. Now, listen, volume 1 talks about these five principles. Volume 2 talks about different clauses and its implementation. And volume 3 talks about case laws. Okay, so there's an overview of there are three things, three volumes of code of ethics. Now listen, in module there is a lot of theory with these five principles. Lot of theory with these five principles. I will cover in something maybe in FADU chart revision also. But then maybe you can go overview. So there is a discussion about competence and due care. There's a discussion about confidentiality. There's a discussion about professional behavior. Discussion about integrity. There's discussion about objectivity. Institute has never asked anything from there. It is in the module, but till date they have not asked anything. Okay, so there's a two interpretation. And never asked in the sense it was introduced. These things were taught in new course 2018-19, but after that they have never asked anything from that. One interpretation is it is not important, leave it. One interpretation is very important, do it. I think only few things are important from there, like volume 1 applicability. Volume 1 applicability. You can simply mark it. It will be there in FADU chart revision. We'll focus on questions. This overview of code of ethics. Then okay, that's very important. Threats. Page number 87. Threats and safeguards. What are threats to independence? There are 5 different types of threats and safeguards. That's important. And then I think this is also important. NOCLAR. NOCLAR is non-compliance of law and regulation. So what should chartered accountant do when he comes across NOCLAR? Non-compliance of law and regulation. NOCLAR, they have not explained in detail, just an overview. Just an overview. There is amendment in applicability of NOCLAR. You can make these changes. Listen, there are amendment in applicability of NOCLAR. You can make these changes. International Ethical Standard Board says NOCLAR is applicable to all the chartered accountants who are in job. It is page number 89, first column. Who are in job and all the chartered accountants who are in practice. But in India, they are not that strict. They say that NOCLAR is applicable to CAs in service who are SPA under listed. All the chartered accountants who are doing job in listed companies and who are SPA. SPA stands for Senior Professional Accountant. NOCLAR is applicable to only those chartered accountants who are doing job in listed companies plus they are SPA. SPA stand for Senior Professional Accountant. and it is applicable to all the CAs in practice who are doing audit of listed companies having net worth 250 crores or more. Okay. Only those chartered accountants who are doing job in listed companies and who are sitting at the senior position, only they have to follow no clerk. Only those chartered accountants who are doing audit of listed company and having net worth 250 crores or more, only they have to apply no clerk. So no clerk simply explains if you come across non-compliance, what to do. And broadly they say inform seniors, discuss with seniors, and go and communicate with higher authorities and so on. In general, they say this. It is applicable from 1st of October 2022. That's why it is now applicable. 1st of October 2022. For CA in service, there is section 260. For CA in practice, there is section 360. First, they talk about those who are in job and then in practice. So there is a small amendment in applicability. Okay. Now, some of them are very traditional questions. First question. So in intro part, I have marked few important things. Then next important. Can a chartered account practice provide portfolio management services? Can a chartered accountant in service provide portfolio management services? Can he provide broking services? Underwriting services? Okay. So at the bottom is very important. MCS, Management Consultancy Services. Under section 2, subsection 2, clause 4. CA Institute has power. CA Institute has power to issue list called Management Consultancy Services. What is implication of this list? So they have given list of services. It is simple list. Those who are in practice, apart from traditional work of accounts, audit, tax, costing, finance, they can provide management consultancy services also. And what is the second implication? Those who are doing these activities, they will be deemed to be in practice. So practice guys can do this, and those chartered accountants who are doing this will be deemed to be in practice. Very important two things. Now, what we have done in chart book, see this chart book, very good drafting is done. See page number 90. Again we have page number 90. See, many students, what they do, they simply go to the list once. Now whatever we remember, we remember. I have made a shortcut to remember what is covered in management consultancy services. So there is a list of management consult services. See how I have arranged it. There are some services which are required before incorporation. There is a list. Then there are services required after incorporation for fundraising. There is a list. After funds are raised, then you have to do corporate planning. There is a list. After planning, you need people to execute the plan. Then administrative work, managing staff, documents, records, exactly, administrative work. Then after staff and administration is there, next we need to start production. Production doesn't come here, but working capital and its cost is covered here in management consulting services. After production is done, we need to sell, so pricing. After sale is done, recovering money from people. After recovering money, making statements, profitability statements, cash flow statements, fund flow statements, that is part of MCS. Finally, once you earn money, investment decision making and different types of audit, management audit, operational audit, quality audit, energy audit, environment audit. And lastly, you need system insurance, and when companies closed, liquidation. See, it's a big list. So we have, it's in a sequence. You need few services prior to incorporation, then post incorporation funding, fundraising. After funds are raised, staffing, planning. After planning to execute plan, you need staffing, administration. After this thing is done, you need to start production. So production doesn't come, but working capital and cost management comes. After production, sales. So pricing, pricing of the products. After pricing, recovery. Pricing is there, sale is there, recovery. Then making profitability statements. After money is earned, where to invest? Where to invest? Then special types of audits, how to keep system secure, and liquidation. Now, if you see this list, you will see that three things are excluded. Portfolio management services, brokerage, and underwriting is excluded. That means if these three things are not in MCS, that means practicing CA cannot provide these services. And those CAs doing this thing without COP, they will not be deemed to be in practice. Three things are excluded here. So practicing CAs cannot do this, and vice versa. Those who are doing it will not come in deemed to be in practice. C question. Same thing. Portfolio management services cannot be given by practicing chartered accountant. He would be guilty of professional misconduct. Now, next important is section 27. You should mark section 7 also. Important. If time permits, we'll do that. 91, page number 91, section 7. Right now we are having question on section number 27. Come to page number 92. Okay. Listen guys, in introductory part, few things are important. First, we have seen question on MCS, Management Consultancy Services. Next question is on section 27. What is it about? What? Listen, section 27, what it says? CA in practice, CA firm can have any number of branches they want. They can have any number of branches they want. There's only one condition. Every branch should have a separate in charge. You can have any number of branches you want, absolutely fine. Only condition is that there should be a separate in charge. Now, this separate in charge may or may not be in practice. It may be in practice or may not be in practice. He can be either a partner or a full-time employee. So there should be in charge. Either you can make a partner having COP as in charge or employee not having COP as in charge. Then there is a condition. They should be actively associated. What do you mean by actively associated? Yes, day activities. So that is either how it can be proved. Either they should reside in the same city. Either it will be deemed they are actively associated if they reside in the same city in which the office is. So if they are from the same city, it will be assumed they have active association. If they attend office not less than 182 days. If they attend office for 182 days or more, it will be again deemed that they have active association. Or either he should reside in the same city for at least 182 days, or he should attend office for 182 days, or He should be able to prove in any other manner that I have regular Zoom calls, discussions, communications, exchange, reviews, I am actively involved. Any other manner is also allowed. So section 27 says have a separate in charge, maybe CA or maybe CA in practice, maybe partner or maybe employee, but active association. Now the interesting thing is there are two exemptions. First exemption is second office. If firm is having one office, they can open one more office and claim exemption, no separate in charge. But then there is a condition. That second office can be in the same premises, same building, same premises or same city or within 50 kilometers from the municipal limit of that same city. Either same premises or same city or within 50 kilometers from the municipal limit. Now keep in mind this 50 kilometer is not from the office, it is from the municipal limits. Okay. Next exemption, if any CA office is in hilly area, then in that case, if any CA office is in hilly area, then in that case, they can open a temporary office in plain area for period not exceeding 3 months. In hilly area, if it's winter, there's a lot of snow and there'll be problem. So they can come down and open a temporary office in the plain region. Before commencement of every winter, CA in practice should inform that I am going to open a temporary office from a particular date. Also inform ICI after offices. Inform when it is open, inform when it is closed. Such communication should be sent by registered post to ICI. They should be kept informed. Now listen, regular office need not be closed. Don't close regular office. Name board of the firm need not be displayed temporary office. Name of temporary office should not come in visiting cards. Don't put name board at temporary office and vice versa. Don't put address of temporary office in visiting cards. When temporary office is not functional, listen, for 3 months it is fine. For rest of the 9 months, don't put board there and don't give its reference on the visiting card. Both ways it is not allowed. Listen, second exemption is for hilly area. Where to open it? Plain. How many months? 3 months. Inform before opening. Inform after closing. And inform before winter starts. And then don't give in temporary office, don't put the name board. In visiting card, don't put the address of temporary office. When temporary office is not functional. When it is functional, you can put the board. When it is functional, you can put it in the visiting card also. When it is not functional, don't give cross-referencing both sides. Are you getting this point? Now let's see there's a controversy also. There was a question was asked in MTP RTP and it was on Madurai. It is simple. We know that this exemption is to get production from winter region. Yes, no? Yes, no. So in question they said that office is open on summers, April, May, June. I don't think April, May, June is winter anywhere in India. Madurai, is it winter? April, May, June? No. It is hot, humid, madness. Listen, they are saying, institute says that office is open for 3 months, April, May, June. Will they get exemption? Institute is saying yes. Institute says, I don't agree with I had a discussion, phone call discussion also with them. They says, you can open office in any 3 months. Only intimation should be done before winter starts. As it is illogical, what nonsense? It doesn't meet the intention of the law. Logic. What is this logic that intimation should be done before winter? Anyways, I will say that simply you explain that this is conceptually wrong they have done. Simply explain that it is for winter seasons and not for the other season. They have given the road. Both views. It means office can be open in winter season, but ICI in one of the answer assume that office can be open in any season. Only communication should be done before winter. We think view taken by BOS is not correct. But if question comes in exam, present both the views. If exactly this question comes. Let's freeze guys. We are focusing on few important things and section 27 is important. Let's see. First question 658. Listen guys. 658. First question. Office in Mumbai near Churchgate and branch office it in suburbs of Mumbai, which is approximately 80 km away from existing office. And in this branch, retired income tax officer is appointed. Quickly guys. Where is the main office situated? Churchgate. And where is the branch office? Suburbs. Suburbs, it is there. And how far it is? 80 kilometers from the office, not from municipal, it is from office. And who is heading it? Income tax officer, not a chartered accountant. See, the question is simple. If they are eligible for exemption, they can put anyone as in charge, no problem. But if they are not eligible, for exemption, then there should be separate, a chartered account should be in charge. Otherwise, there is a non-compliance of section 27. Let's see guys. Now, see, we know that exemption of second office is relevant here. For exemption of second office, we need distance from municipal limit. But that distance is not given. That distance is not given. Distance given is 80 km from the office. We have to assume they have said that 80 km from office. We said it's of no use. We want distance from municipal limit. We have to assume that this distance which they are saying is not from the office but from municipal limits. And if it is after 80 kilometers, that means no exemption. That means no exemption. That means you will need a chartered accountant as a in charge. You will need chartered accountant as in charge. So there is a non-compliance of section 27 here. Yes. Both the situations. See, they are talking about existing office, but distance from existing office of no use. You need existing from municipal limit. We have to assume that this distance which they have given is from municipal limits. See, if you assume that it is from existing office, still there will be ambiguity. Na? How much from municipal limit? We don't know. How much from municipal limit? We don't know. So whenever they give distance, you will assume that it is from municipal limit. That is the assumption you are supposed to take. So here they will not get the exemption. Separate CA was supposed to be the in charge. They are keeping income tax officer, non-compliance of SA, non-compliance section 27. आज अपना बैटरी डाउन है. Yesterday I slept for only 3-4 hours. See, if there is less sleep, there's an effect. And some students, they don't sleep before the exam. It is absolute nonsense if you don't sleep before the exam. You will become a zombie and everything is gone if you become a zombie. Now listen, next question, see what they say, suburbs of Chennai. They are not giving even the distance. They are not giving even the distance. They are simply writing suburbs. Listen, then we have written note here. Suburbs is not defined. It is simply mean outskirts. We don't know exact distance. We can give conditional answer. If it is beyond 50 kilometers, no exemption. If it is within 50 kilometers, exemption. And give the answer accordingly. Conditional answer should be there. Okay, listen, 660 question. See, they are taking a lot of questions on section 27. What they are saying, XY and company is a firm. Two partners, X and Y. One is in charge of head office, another in charge of branch at distance of 80 kilometers. Fine. They are separate in charge. Okay. You are not getting exemption, you have a separate in charge. They put name board of the firm in both premises and also respective residences. As per section 27, name of the firm should be there only in the head office, only at the head office and branch office. At home, you should not use name of the firm. At home, you should use personal name. It is not allowed to use name of the firm at residence. Correct? They are using it, guilty of, it is non-compliance of again section 27. Yes? CA. Designation can also be there. Now, again section 27. Listen guys, first we focus on management consultancy services and the next is section 27. Lot of questions are asked on section 27 itself. Hilly area, I was talking about Madurai. April, May, June. For 3 months, they have opened a branch. Institute has said absolutely fine. I think you should give both the views. As per one view, it is only for winter season, so it is not allowed. And another view, Institute has taken any 3 months. They have taken any 3 months. And if it is any 3 months, any 3 months is allowed. It is absolutely fine. Are you getting this point? Depending on interpretation, answer will change. You should explain both the views. Okay. Now, so that section 27 is important. Quickly, let's see this image recognition technique. We have already used it for Caro. Already used it for, yes, for Caro. Then we have used it for tax audit. Tax audit was first 10, then movies 555, then again 554. Okay. Now, listen. So we have seen this for Caro, we have seen this for tax audit. Now the last thing is for P. Listen. Schedule 1, how many parts are there? Schedule 1, there are 4 parts. Part 1 has 12 clauses. Part 2 has 2 clauses. Part 3 has 3 clauses and part 4 has 2 clauses. Very good. So let's see shortcut. So there's now here the last different flavor. So they are celebrities. First is Nargis, and then you can see Paresh Rawal, then Alia Bhatt. She doesn't look like Alia Bhatt. And then next Prabhudeva. Okay. Quickly, one heroine, one hero, one heroine, one hero. So first is Nargis. Who can do practice in the name of the firm? Who can sit in the firm and do practice on behalf of the firm? Correct? Nargis, who can practice in the name of the firm. Then after Nargis we have Paresh Rawal, paying share of the fees. To whom we can pay share of the fees. Then after Paresh Rawal, Alia Bhatt, from whom we can accept share of the fees. And then we have Prabhudeva, that is with whom we can go for partnership. Then different cars. So you can see one SUV, black SUV, that is Scorpio. Then we can see one black sedan, that is Audi. Again one SUV, that is Duster. Again one sedan, that is Camry. Quickly, one SUV, that is Scorpio. Securing work. How CA in practice can secure work? Through whom he can get the work, and the point is he cannot appoint agents. No. Soliciting is other. He can secure. He can secure. How he can secure work clauses for that? After that, then there is a sedan, that is Audi. Advertisement. He cannot go for. He cannot solicit. He cannot directly or indirectly solicit with the help of advertisements. Advertisements are banned. One more SUV then Duster. That is for designation. He cannot use any other designation. Designation and highlighting professional attainments. Designation and highlighting professional attainments. And then we have again sedan, that is communication. That is for communication to previous auditor. Let's freeze. Scorpio, securing work. Audi, advertisement. Duster, designation and professional attainments. And Camry for communication with the previous auditor. So we are through with 8 clauses. So if you get a question on securing work, what is the image? Scorpio. It is clause number 5. Partnership, Prabhudeva. Clause number 4. Accepting fees, Alia Bhatt. Array image. Clause number 3. And then communication with previous auditor, Camry. That is clause number 8. Now, so these are our celebrities. These are their vehicle, and they are going now. They are visiting different cities. You can see a temple, that is Ranchi. So you can go to Ranchi, you can see such temple. Then that is some fort is there, Firozabad. Then iconic hotel, Bombay. Then Shirdi. Quickly, you can see a temple, that is Ranchi. Then you can see a fort, that is Firozabad. Then you can see iconic hotel, that is Bombay. And then you can see idol, that is Shirdi. First is Ranchi. With requirement of Companies Act, whenever you are offered company audit, you see whether requirement of Companies Act are fulfilled. 139 and 140. Then after Ranchi we have Firozabad. Fees. Fees cannot be on percentage basis and contingent fees cannot be there. After Firozabad, Bombay, we cannot perform any other business or occupation. We cannot perform any other business and occupation. There are exceptions. Then Shirdi, signing. Who can sign on behalf of CFO? Only a partner who is CA in practice. All the reports and certificates, financial statement, everything can be signed. Everything can be signed by CA in practice. Only that partner is CA in practice. So 4 actor actresses, 4 cars, and then 4 cities. We are through with 12 clauses. Then first schedule part 2, 2 movies. Salman Bhai, Ekta, Tiger. And then we have, what is the hero? Aditya Roy Kapoor and Shraddha Kapoor. So Kapoor's, that is Ashiki 2. Ekta Tiger, part 2 is only for CAs in service. CAs in service. So Ekta Tiger, those who are in service, they cannot share their emoluments. The emoluments means salary, bonus, commission with others. Next is Ashiki. They cannot accept also. They cannot pay share of their emolument. They cannot accept money from people. They cannot accept part of the money from the professionals. Okay. So they cannot share their emoluments. They cannot accept money from others who are getting it from the company. Part 3. Now little pet puja. Fafda. So fafda with mirchi, it is little spicy. So next is rasgulla, and then next is tea. Fafda. Now listen, fafda, fellow chartered accountant. If any associate chartered accountant calls himself fellow chartered accountant, he will be guilty under clause 1. If you don't reply to people, don't reply to institute, don't reply to the council, committee, disciplinary boards, it will be misconduct. If you don't reply to them, it will be a misconduct. Rasgulla, not replying, and then T is for tender. Somehow you were allowed tender in clause number 6. You were allowed write up in clause number 7. And you are giving false information. Guilty under T. Quickly, Fafda is for fellow chartered accountant. Then Rasgulla is for not replying. And then finally T is for tender and write-ups. Finally, 2 clauses. So first one is, if you see, that is imprisonment, and next is shame on you, bringing disrepute. If any person is convicted, for imprisonment less than 6 months, clause 1. Bringing disrepute to the institute, clause 2. Let's freeze, guys. 4 actor actresses, then 4 cars, then 4 cities, then 2 movies, that is Ekta Tiger, emoluments, Ashiki 2, acceptance. Then Fafda is for fellow chartered accountant, Rasgulla is for replying, and then is for tender, and then imprisonment and disrepute to the institute. Okay, listen. To 660.100. Listen, it was asked in May 19 exams. And Then it was in May 22 mock. Very interesting. So a CA becomes a chartered accountant. He goes to family CA, father's friend. He goes to father's friend and says that I want to understand how to practice. I want to learn how to do practice. See, so he starts sitting in the office. He starts sitting in the office. He starts working. He is not paid even a single rupee. There is no sharing of profits. There is no salary. There is no salary. There is no sharing. Nothing. Nothing. No terms. Only is working. After some time, he leaves. After I think a year or 3 months, something, he leaves. And out of gratitude, he is paid 3 lakh rupees. You worked a lot with a lot of clients. You did a lot of consultancy. You prepared a lot of reports. So take this 3 lakh rupees lump sum payment. Is it fine? Is it fine? Yes, no. No sharing of profit is there. Is it okay? No sharing of profits. No sharing of profits is there. Is it fine? Yes, no. Answer is no. Clause number 1 is applicable. Only who can practice in behalf of firm? Only CA in practice. Only CA in practice can sit in the firm and work on its behalf, and that CA in practice should be associated either as a partner or as a employee. Now this person sitting in the firm, he 6 months he is sitting, there is no clarity whether he is having COP. That is one thing, but then it is clearly said he is not a partner, he is not a employee. The person who is sitting and giving final services to the client, he should be a responsible person. He should be holding COP and he should be firmly associated with the firm either as a partner or a employee. There things went wrong. So it is a misconduct under clause 1. You should write one standard line. CA in practice will be deemed to be guilty under clause 1 if under clause 1 of part 1 of schedule 1 of CA Act 1949. Now writing the whole clause as it is, you may try, but even if you write all the key points, that will be sufficient. So problem is that he is not associated, he is not having COP, and second problem is that he is not associated properly. He is paid 3 lakhs, it is absolutely fine. No problem with that. Even if sharing would have happened, no problem with that because he is CA. Then next, 662 November 22 mock. November 22 mock with whom we can share after Narvi Paresh paying share of the fees. To whom we can pay share of the fees? Can we pay to article? No. Article is not in the list. Don't worry. You will also become CA. You will have articles. Articles is not in the list. You cannot pay share of the fees to article. Employee also not in the list. You cannot pay share of the fees to employee in any name. It is not allowed. 60% of the audit fees is paid to non-chartered accountant. Again, it is not allowed. Can you pay to registered valuer? Can you pay to registered valuer? No. Again, he is not in the list. So you should know what is in the list. Who is in the list? Anyone? Listen. Okay, listen. We can pay share of the fees. We can pay share of the fees in the name of brokerage, commission, or anything. I have divided it in two parts. First, let's see the simplest part, partner related people. We can definitely share fees, profits, commission with partner. They are as such partners where we can definitely share with them. After partners, we can share also with the retired partner and also with the legal hire of the deceased partner if it is a pre-decided thing. If it was there in the partnership deed, if it is a pre-decided thing, that sharing is also considered valid. Partner, retired partner, legal hire of the deceased partner. So we can share with three type of people which are connected to partners. Next, we can share with three types of member related points. Number one, we can share with member of ICAI. We can share with member of ICAI. Then we can share with, listen, this now next list is given in regulation 53A and that is given here. Regulation 53A. Regulation 53A first says we can share fees with members of prescribed bodies. Members of prescribed bodies. They are giving list of Indian professional bodies. So along with CS, students do CS, they do CMA, they do LLB. Some people may go for actuary. And lastly, it's rarely people go for architecture. We can share fees with the members of CS Institute, members of CWA or CMA or Cost Institute, member of Bar Council of India, member of Indian Institute of Actuary, member of Indian Institute of Architect. Listen. Second, can we share fees with members of foreign professional bodies? Listen, we can share fees with members of those foreign professional bodies with whom we have MOU and MRA. MOU is Memorandum of Understanding. MRA is Mutual Recognition Agreement. Like we have it with Ireland, South Africa. So do we supposed to remember? No. Australia. Okay. So there are few institutes with whom we are having MOU. MOU and Singapore got very famous. MOU and MRA. We can definitely share fees with them. We can definitely share fees with them. Then see, if you are having membership or qualification of foreign professional institutes having MOU, MRA, we can share with them. And next is Indian qualifications. You can share fees with people having Indian qualification. And again, they repeat 5 things: CS, CMA, LLB, actuary, architect. So what is difference? They are yet to get membership. They have not yet to get membership because maybe they have not done articleship or not fulfilled certain trainings. We can share fees with even with qualified people. No need that they should be member only. And they add 2 more people: engineers and MBA. Okay, so if you see regulation 53A, number 1, separate list of Indian professional bodies. Number 3, separate list of Indian qualifications. And number 2 in between, foreign professional bodies and qualification with whom we have MOU and MRA. Are you getting this point? Yes, no.
Yes.
So after members of ICAI list regulation 53A, this is the list. So if you see the list, registered valuer is not there. Many students will go wrong here. Registered valuer, registered valuer. Registered valuer is not in the list. Okay. Now see, professional ethics is huge. It is unending thing. Okay. We have seen schedule 1, some clause 1, 2 we have seen. Let me just guide. Most crucials are clause 6 and clause 7. Majority of the cases are framed on clause 6 and clause 7. Let me give you a very simple thing. Listen to page number 95. Come to page number 95. See, page number 95. If you see last column, there it is written clarifications of clause 6. Clarifications of clause 6. Listen, please, you cannot go for interpretation. It is useless drafting. Clarifications are issued at different point of time by different people as per their whims and fancies. If clarification of clause 6 applicable, apply clause 6. Don't go by word to word interpretation, you will go mad. If something is covered in clarification of clause 7, apply clause 7. Why I am saying this? In clarifications of clause 6, you will see wordings. Don't highlight professional attainments. Then you will say, sir, professional attainments is clause 7. How come it is covered in clarification of clause 6? This is institute. You don't apply a lot of brain. It is issued as a clarification of clause 6. You will apply clause 6, give reference of the clarification, discuss the case and give conclusion. Nothing else. And a shortcut is given. Registrar bans violent movies and promotes public counseling. There is high probability that case is coming from one of these clarification. R is for can we respond to tenders? E is for can we go and make EMDs, earnest money deposits, security, E is for empanelment. Can we go and make empanelment? Everyone understand empanelment? Then G is for can we send greeting cards? So like these clarifications are there. Quickly, let's see this clarification. Can we send greeting cards? Can we send greeting cards and invitation cards and write chartered accountant designation CA form name? Okay, so what they say, you cannot put professional designation and qualification on greeting cards and invitation. First they say no. Then they say, listen, designation chartered accountant along with the name of the firm is allowed in greeting card or invitation only if it is sent to only if it is sent to closest are relatives, then friends, then clients. If it is sent to relatives, then friends, then clients. Yes, sending greeting cards with the designation firm name is allowed. If you send to these people, any kind of greeting card is fine. Any kind of greeting card is absolutely fine. If you are sending greeting card to these 3 people, birthday greeting card is fine. Festival greeting card is fine. New Year greeting card is fine. Any kind of greeting card, but send only to them. Next, invitations, limited invitations are there. So it's again in sequence. You will become CA, you will be thankful to God. You'll have some religious function, religious ceremony. Generally, in India, people will do something, good for the God if you become chartered accountant. Religious ceremony, invitations of religious ceremony can have name of the firm. No issues. Then you may go for marriage. Yes. What about? Correct. Doesn't want to go for marriage? Okay, why? It's okay, you should go. Okay. Problem is, I am waiting for it. Why are you saying may? Then after that, marriage. But then you cannot put your designation for marriage of family member. Suppose son daughter is getting married, you cannot put designation. Son daughter is getting married, you cannot put designation. Then sister brother sister, no, not allowed. Only your own marriage you can put. Yes, that will be asked in see one. Okay, I will give you one case. Dangerous. Then opening offices. Open office. Finally open your own office. Definitely. If on that you won't put firm name, where will you put firm name? Then change of the office. Yes. Again. Fine. Now listen, there was a case of Sonu and Monu. So they said that Sonu and Monu are two partners. And Sonu is having religious ceremony. So they printed invitation cards. They have written firm names, designation, and they have sent to relatives, then friends, then clients of Sonu and Monu. Is it allowed? Yes, no. We just discussed. Answer is so. Sonu and Monu are two partners. There's a religious ceremony at home of Sonu, and then they are sending invitation card to friends, relatives, and clients. What? So what? A religious ceremony can happen anywhere. It can happen in home. It can happen in a temple. Okay. Answer is professional misconduct. Why? Huh? Yes. So the point is, they have invited relatives, friends, and clients of both the partners. They are going wrong. Only Sonu's relatives, Sonu's friend, and Sonu's clients should be invited. So that was a googly, and this question is not yet asked in the exams. Okay, and this is a MTP RTP question. Listen, the point is, you have to go with this clarification. Don't apply extraordinary brain of interpretation. Sir, what you don't go, you are not going conceptually. I have tried everything. This is the simplest solution I have come up with. I tried to interpret, do a lot of things, everything is useless. Friends can be common, that is fine. But how come his relatives? How come his friends? Not good. Okay, listen, guys. Now, this is okay. Listen. So, one more clarification. Bans B's for books. Can CA CA firm's name can come on books. Can it come on articles? Can firm name, this was amended sometime back. It can come. Firm name can come on books. Firm name can come on articles. Absolutely fine. But don't highlight professional attainments. And someone will say, sir, why not apply clause 7? No. Clarification of clause 6. Apply only clause 6. No confusion. But if you are highlighting professional attainments, it will be gone. This box number is a separate point. B is also for books and articles, and box number. You know what box number? So in newspapers, when there was no mobile phones, it is PO box number, post office box number. If anyone want counting services, contact this PO box number. Such kind of advertisement is also not allowed. Can CS make educational video? Yes. Nowadays, TikTok influencer, Instagram into influencers, YouTubers. Can you make education video? Absolutely fine. Make, upload. Don't give reference to the name of the firm. Contact details or website address. Don't share, don't give name of the firm. It should not result in publicity of the firm. Make as many videos you want to make. It is absolutely fine. Don't give firm name. Yes? Listen, what happens in practice is a different thing. There are many ways of breaking it. I don't want to go into it. Like firm name is not allowed. Give a email ID with firm name. Contact address. But then they are not allowing even the should not contain contact details also. Website address, nothing. We should not be attracting clients. See, what happens in practical world is a different thing. Nowadays, everyone want to promote the firm name. So many times practicing chartered accountants, they make videos or make posters and they everywhere they write firm name. Fine. Now, so you know that, fine, one more. Movies. After the end of the movie, you will find firm name. Is it allowed? Answer allowed. Name of the member of firm can be included in credits. But it should be in same size and font, just like others. It should not be extraordinary bold and highlighted as compared to others. Listen guys, just follow the clarifications. On the same lines, there are clarifications of clause 7. Friend slaps Dr. Nene. Okay. Listen, come to page number 98. See, I am randomly selecting few things. Okay, now we have to communicate with previous auditor. What are the modes of communication allowed? You should always use a mode of communication where you have evidence that communication is communicate. You should have acknowledgement that communication has happened. So they have given the list. Best is delivery by hand, take the stamp. Next best is RPAD, registered post acknowledgement due. You will get a small postcard that it is delivered with signature. Next is acknowledgement of communication from retired auditor received from email address registered with ICI. So you can send through mail. But point is you should get a reply as an acknowledgement that communication is received. So you can use email also. That was recently introduced. You can use email also. Best is hand delivery, next best is RPID, next best is email, but you should have an acknowledgement also. Next, you can use Udin portal, but this service is not yet activated. Udin portal can be used. What if premises are locked? Deemed to be delivered. If address is as per CA Institute's website, it will be deemed to be delivered. What if no address found? If address is as per CA Institute website, again it will be deemed to be delivered. So you can get the question, what if premises are locked? You get the letter back. Deemed to be delivered, you will get question, no address found. If it is as per ICI website address of a CA firm, it is absolutely fine, deemed to be delivered. What if there is a no tax audit in the previous year? See, we have to communicate with the previous auditor. Last year there was no tax audit. We'll go to before that. Whoever was the auditor, we'll go and ask him whether you are having any objection. If tax audit was conducted 2-3 years back, we'll go 2-3 years back. What if the person dies? Retiring auditor? Nothing. You will not go to legal hire. If person dies, only get the proof. Okay, he has died. You don't need to make any kind of communication. Listen there. In P, everything is important. In P, except the intro part, everything is important. Quickly, come to page number 101. Again, image recognition technique. Do you remember first 4 celebrities, next 4 vehicle, next 4 cities, 2 movies, 3 food items, and then imprisonment and shame on. Then second schedule. So we have Chris Gale, then we have Rohit Sharma, then we have Flintoff, then Sachin, then Dhoni. Quickly, first we have Chris Gale, then Rohit Sharma, then Flintoff, then Sachin, then MSD. These are 5 clauses. Chris Gale is for confidentiality. Rohit Sharma is for report on financial statement. Review of report on financial statements. Flintoff is for future estimates. Can a chartered accountant sign future estimates? Can he give report? Yes. But then there are conditions. Sachin, substantial interest. Wherever there is substantial interest, we should not give opinion. MSD, material omission. If there is a material omission, inform. Otherwise, it will be a professional misconduct. Quickly, Chris Gale, confidentiality. Rohit Sharma, report on financial statement. Flintoff, future estimates. Then Sachin, substantial interest, and then MSD, material omission. They're playing 5 sports. First, you see a lot of motor car racing. Then you see golf. Then you see soccer. Then you see archery. Then you see basketball. So, motor car racing, material misstatements. If there is a material misstatement, and if chartered accountant is silent, he is not informing about it. Professional misconduct. Then after motor car racing, next is golf. If there is gross negligence, professional misconduct. Soccer, no sufficient appropriate evidence. You are not collecting sufficient appropriate evidence. Professional misconduct. Archery. If you are not following audit procedures, again professional misconduct. Basketball. If you are not putting client money If you're not putting client money in separate bank account, you should keep client money as safe as possible. Otherwise, professional misconduct. Let's read. Chris Gill, confidentiality. Rohit Sharma, report. Print of future. Sachin, substantial. MSD, material omission. Then motor car racing, material misstatement. Golf, cross negligence. Sagar, sufficient appropriate information. Archery, auditing procedures. And last thing, basketball, bank account. Second schedule part 2. So for time pass, they are watching Comedy Nights with Kapil. Then next, Candy Crush. Then more Facebook, Instagram, and everything on mobile. Comedy Nights with Kapil. If you contravene, any section, or any regulation or any guidelines. See, one student did this thing. Everywhere he applied clause 1. So if you contravene anything, then clause 1. Listen, if there are specific clauses, we don't need to apply this. If there are specific clauses or sections, don't apply this. Sir, I am writing extra clause. Marks will be deducted. Don't unnecessarily quote clause 1. If something is not covered in any other clauses, then you apply clause 1. So if anything is contravened, guilty under clause 1. Combinates with Kapil. Next is Candy Crush. Again confidentiality. But then that was confidentiality of CA in practice. This is confidentiality of CA in service. Then Facebook. False information. To whom? To the institute. Okay. So if you are not replying, it goes in Rasgulla. And if you give false information, it goes in Facebook. Schedule changes. So Rasgulla was first schedule, part 3, clause 2. And false information is second schedule, part 2, 1, 2, 3. Yes, no. Then, if there is money embezzlement, CA runs away with the money. Very bad. Professional misconduct. Finally, part 3, if imprisonment exceeds 6 months, then it is a misconduct under schedule 2. Quickly, can we sign forecasts? Can we sign forecasts? Can we give report on forecasts? Answer is yes. Can we write insolvency professional in the name? Can we write we are insolvency professionals? Yes. Can we write we are registered valuers? Yes. All the qualifications and designation other than accounting bodies. See, it is not coming from accounting body. We can write all the qualifications if it is coming from other than accounting body. We can write insolvency professional, no problem. We can write registered valuation, no problem. But if you want to use name of any qualification of other accounting bodies, we need permission. Listen, so IC has problem with other accounting bodies. Use others name only if we permit, because a lot of misuse happens. So person is earning package of 50 lakh rupees and he writes qualification. He is a CA. He is a CA and he is a CPA. So what CPA institute will do? They will conduct a seminar. Look, he is a CPA earning 50 lakhs in India. He is CPA, but along with CPA is CA also. So institute has problem with other accounting bodies. You cannot use their name till the time institute gives permission. Now, as I said, this is a 2.5 hour video. If you understand Hindi, it covers everything from start till end. Now, 16 marks, sure, around 16 marks. P, you should not lose even a single mark in professional ethics. It's a crime to lose even a single mark in professional ethics. Okay. Okay. Listen, let's discuss that forecasting quickly. So can we give report on future forecasts and projections? What is difference between forecast and projection? If futuristic information is derived on the base of realistic assumptions, reasonable assumptions, it is called forecast. If it is based on hypothetical assumption, what if we amalgamate, what if we do this, what if we do that, that will be projection. Can CA in practice sign projections and forecasts? Can he give report? Answer is yes. He can, but he will have to follow SAE 3400. He will have to follow SAE 3400, and as per that, you can definitely sign, but in report, you should never give guarantee, surety, or vouch accuracy. That means comment on accuracy. You cannot give guarantee, surety, this is going to happen. You are not God. This is going to happen. You cannot say that assumptions are accurate. No, you cannot vouch for the accuracy. You have to say only one thing. After doing all the checking, we have not come across any information which suggests that suggests that assumptions are having any problem. They are unreasonable. That's it. We cannot take any guarantee or surety. We simply have to comment on the ingredients, and that is assumptions. We simply have to comment. We did not get anything problematic when we saw assumptions. Okay. Now, guys, I just want to show you. Now, a lot of students have problem with guidelines. If you see page number 105, these charts they cover every small thing. Every small thing is covered. So there is a shortcut, new tab of clients. Council guidelines for new tab of clients. So there are if there is a breach of council guidelines, always say there is a breach of council guidelines, and you can also apply clause 1, second schedule, part 2, second schedule, part 2, clause 1, comedy nights with Kapil. You can talk about guidance note also. You can talk about the guidelines also, and you can talk about that clause 1 also. Okay. Because of lack of time, we may not be able to do a lot of things. What is important in network guidelines? You can mark deemed network. Deemed network is important in network guidelines, page number 108. Then forms of network, page number 109. Ethical compliance, page number 109. You want to take a break? Okay, so finally after the break we start peer review. Peer review, then we see quickly after peer review quality review. After peer review quality review, we see due diligence investigation, a little bit of forensic, and then we can go for anything you guys say. 700 series, little bit of 700 series. These 3 chapters at least see something. Now, peer review. So students are frightened with this chapter only because there are amendments. Okay. Listen, there are not any big amendments in the chapter, but definitely there are amendments. First question is, first question asked in May 21 mock, May 22 mock. Very simple. So in peer review, we know that a reviewer is sent who is supposed to review how CA firm is doing audit, what is the quality control system, and then comment on it. If it is appropriate, they will get a peer review certificate. If it is not appropriate, they will not get a peer review certificate. Now, reviewer comes and he selects. When reviewer comes, he has to select some assignments to check them. So for how many years he can do the selection? 1, 2, 3, 4, 5. 3 years. When reviewer comes and he selects the assignments he wants to check, it should be for 3 years. That is one thing. Next, can he select compilation assignment? That means compiling financial statements. Can he select management consultancy services? Can he select due diligence? Okay. So if you come to page number 79 of the chart book, FADU chart book, then second column will get scope of peer review. Very simple thing. Reviewer can come and select only assurance assignments. He can come and select only and only assurance assignment. Only assurance engagements, and that too of preceding 3 years. See, current year assignments may not be over. So current year assignments you cannot select of preceding 3 years. What do you mean by assurance assignments? Assurance assignment means audits, audit assignments, review assignments, and then certification. So if firm has done audit assignment, they can be selected. If there are review assignments, they can be selected. Certification works can be selected also. But these are the assignment which cannot be selected. They are excluded. CTO. CTO assignments will be excluded. C stand for consultancy. If CA firm has given law consultancy or AS consultancy, exclude them. Compiling financial statements or compiling things other than financial statement like fixed asset register, again excluded. CTO C square. T, tax advisory, preparing returns, representing in tax proceedings, even that cannot be covered. T is for testifying as an expert in front of court, giving his opinion, his advisory to the court. testifying, not, and then others, management consultancy services and due diligence. Even these assignments cannot be covered. So answer is simple, straightforward, that these assignments cannot be covered in peer review. Okay. Next is they talk about technical standards. See, when reviewer comes, he has to see whether audit system in the firm, system of quality control in the firm ensure work is done as per legal requirements, regulatory requirements, technical and professional standards. So what will come in these technical and professional standards? There is a small amendment in this. If you see page number 79, a complete list is given. What will come in technical, professional, ethical standards in the sequence of importance? Most important thing is law. Most important thing is law. So when he comes for peer review, he is going to see whether system ensure compliance with technical, ethical, professional standards, whether system ensure the complete compliance. So these standards are, this includes law applicable to that particular engagement, law, rules, regulation applicable to that engagement. Like for audit, Companies Act is applicable. For some audit, RBI regulations will be applicable, IRDA regulations will be applicable. That is their NDA GPP, that is notification, direction, announcements, guidelines, pronouncements, professional standards by regulatory bodies. Most important is law. So if for a particular assignment law is applicable, rules are applicable, that then regulatory authorities issues NDA GPP, notification, directions, announcements, guidelines, pronouncements, professional standards. Then smaller than that, framework. Before accounting standards, for accounting standard, first framework to accounting standard was issued. Framework. So framework to assurance engage, framework is a document which gives basic principles on which all the standards are framed. Basic principles and basic definitions are given in framework. Framework for assurance engagement, preface to standards on quality control, standards on auditing, standards on review. So framework and preface, most important is law. After that, the next most important thing is framework and preface on which everything is there. Next is accounting related standards, Ind AS as per 133, AS as per 133. Apart from that, if there is no companies, accounting standards issued by ICAI, AS by ICAI for small entities. Other documents, statements. Listen guys, before standards we had statements. Standards and statement word is same. Standard is a new word, statement is a old word. So if there is any old statement on accounting, guidance note, NDA GPP by council, notifications, documents, announcements, guidelines, pronouncements, standards by council. Then audit related standards, standards on quality control, engagement standards, statements, guidance, NDA GPP with respect to audit. Internal audit related standards. So these very simple. First is law and related things. After law, first is law, then frameworks and preface, then accounting related standards, then auditing related standards, and then finally internal audit related standards. So they ask this question that technical standards will include how many what things, and this is the new thing they have added: audit quality maturity model, AQMM. You also need to ensure compliance with AQM, audit quality maturity model. What is it? Again, it is a simple questionnaire where you have to do self-assessment. How good is your system of quality control for audit? You yourself has to specify and assess and give marks. How good is your planning? How good is your risk assessment? How good is your test of control? How good is your substantive procedures? How good is your uh, written representation? How good is your report planning, report framing? You have to yourself do self-assessment and you have to give marks. And depending on marks you are getting, you will get different level of maturity, how matured your firm is in doing audit. So audit quality maturity model. So that questionnaire will tell how matured is auditing of your firm. So we also need to check whether AQMM is properly filled. So apart from this loads of standard, out of which even if you remember 50-60% right, it is sufficient. Audit quality maturity model. Now, after that, if we talk about amendment, listen, come to page number 80. Their amendment in peer review process. Peer review process has 4 steps. Peer review process has 4 steps. Step number 1, selection. Step number 2, planning. Step number 3, execution. Step number 4, reporting. There is amendment in first 2 steps. Selection and planning. See, cut that thing and say, write amended. Planning, selection phase, amended. Then planning phase, amended. Execution phase is same, except that 1 or 2 things, small number of days have changed. Let's see. This file you can see, you can get it from the Audit Guru Telegram channel, it is there. Let's see what is the selection process. What is selection? Hal. Listen. Now, biggest change which is there in because of amendment. Now they are saying that CA firms cannot take assignment without peer review certificate. They won't be able to do audit only. They won't be able to do audit till the time they take peer review certificate. But there is a phased applicability till 1st April 2025. Now, CA firms will run and they will say that please give us peer review certificate because you won't be able to do audit only. Listen, earlier peer review certificate to some extent was a prestige. Okay, you are having peer review certificate. Now it has become necessity, mandatory, without which you won't be able to do audit only. So that is the big change which is there. But then applicability is not immediately, it is over a period of time. So because of that, things have changed. PU means practicing unit, that means CA firm. Now, because CA firm needs peer review certificate because of which they will not be able to conduct audit, they will apply for peer review. They will send peer review application, come questionnaire. While making application, they will give basic details of the CA firm. So many partners, so many clients, so much of fees. These are our principles for quality control. These are checklist. in form number 1. Okay, this change is also because earlier this thing was governed by statement on peer review. Now it is governed by guidelines on peer review. They have changed from statement to guidelines. That also means now that if a guideline is not followed, you will apply professional ethics, schedule 2, part 2, clause 1, contravention, combines with Kapil, if guidelines of peer review are not followed. So, practicing unit is supposed to send application along with questionnaire in form number 1. Please get our peer review done, give us peer review certificate. Then, see, we have discussed here who will send it. Whichever PU desires peer review. So whichever CA firm wants its peer review done, they will send the request in form number 1 along with questionnaire. Sometimes peer review can be initiated by the board. Peer review will be initiated by the board and secretary will request, dear CA firm, send form number 1. Majority of times CA firm themselves will send form number 1. Sometimes board will say that, okay, we want to conduct your peer review, send form number 1. Are you with this point? So process can be initiated by CA firm, PU, or it can be initiated by peer review board. In both the cases, form number 1 needs to be given. After getting basic information, name of 3 reviewers will be sent within 3 days. You got the basic information. Now within 3 days inform 3 reviewers from whom they will make the selection. Peer review board will get form number 1. They will send list of 3 reviewers within 3 days. Then practicing unit has to select one reviewer, intimate peer review board within 1 day. Number of days have reduced drastically. Form 1 goes, within 3 days, names goes. Within 1, selection will happen. Form goes, within 3 days, names will go. Within 1 day, selection will be done. After selection is done, peer review board will appoint an intimate reviewer within 2 days. Once selection of the reviewer is done, within 2 days, he will be appointed and intimated that your appointment is done for the review of so and so practicing unit. Reviewer is supposed to submit declaration of confidentiality. Declaration of confidentiality to CA firm. As soon as he is appointed, he will send declaration that I will maintain confidentiality. I will not give any of the information to anyone. Immediately, CA firm is supposed to send acknowledgement. Okay, that's really good. You are sending us declaration. And also send copy of form 1 within 2 days of appointment. As soon as reviewer is appointed, within 2 days, he should be given copy of form 1, which was sent to peer review board. Let's freeze first phase, that is called selection phase. In this phase, 2 parties are selected, whose review will be done and who will do the review. Quickly, how it will start? Form number 1, that is application come questionnaire, will go from practicing unit to peer review board, either on the request of PU or at the request of peer review board, instruction of peer review board. Form number 1 will go. After form number 1 is received, who will take action? Peer review board. They will send names of 3 reviewers within 3 days. Now they have to revert within 1 day. Who will be the reviewer? Within 1 day they'll have to review, clear who will be the reviewer. As soon as reviewer selected, they will appoint reviewer. They will appoint reviewer within 2 days. Once appointment is done, he will send declaration that I will preserve confidentiality. Preserve confidentiality, and then, well, don't worry, I will maintain confidential the whole issue. and then acknowledged, very good, I have received your declaration. Copy of form 1 within 2 days. Form number 1 should be given to reviewer. Now, planning process. See, reviewer got all the basic information in which form? 1. Okay, listen. Now, selection is done. We know who is going to be reviewer and who is going to be the CA firm. Both the things are done. Next is planning process. A reviewer will read form number 1 carefully, all the information, and intimate about the proposed visit. That I have read your form number 1, I have understood your firm details, I know how you guys work, and I am intimate about the proposed visit. In form number 5, within 2 working days, as soon as he received form number 1, within 2 working days, he is supposed to inform when he will come and go for proposed visit. Proposed visit means on-site visit. When he will go and see the premises. And after intimation, he should at least give 2 days for preparation. Within 2 days, he should respond, and after responding, he should give at least 2 days to make arrangements. Fine. If he wants any additional information, ask in form number 6. So basically, they have introduced forms now. Form number 6. And that additional information should be given in 1 day. Within 1 day. So intimate about the visit. If you want more information, take more information. That's the planning process. Plan and intimate about the review. Next is on-site review should happen for maximum 6 days. So earlier it was 7. Inform about the review and it should happen within 6 days. Maximum 6 days. Mutually cooperate with each other. Entire process should get over within 20 days. So that is a new thing. Earlier it was, first it was 90, then they reduced to 60, now they reduced to 20. Entire process should get over within 20 days from date of receipt of application or date of intimating PU. As soon as they receive application or their PU is intimated, that your peer review will be done. If it's a new unit, then it should be done within 7 days. So there is a concept of new unit. What is new unit? It's interesting and important. What is new unit? 2 kind of units will come in new units. If not more than 12 months have happened for start of office of practicing unit, it will be considered as new unit. If more than 12 months have happened, but no audit is done yet, then also it will be a new unit. See, date of establishment is less than 12 months, immediately pressing date of receipt of application. If you see past 12 months, it is newly established. It is definitely new unit, irrespective of whether they have performed or not performed audit assignment. Next, or practicing unit in existence for period exceeding 12 months but not giving any assurance services. It was there, but then it has not yet given any assurance services. Again, it will be considered as new unit. In case of new unit, there is nothing to check much. They are recently established. They are yet to do audits. Simply go and see background of the partners. How good are the partners? Are they knowledgeable? Are they experienced? And whether they have designed proper system for audit. Because it is a new unit, you are not going to get any assignment for selection. That is the difference. In new unit, you will not be able to get any assignment for selection So it should be over within 7 days. Because there is no actual files, there are only systems. See only background of the partner and systems. I think new unit can be targeted if they want. So this is change. What is change? Planning process has changed, and next selection has changed, and then planning process has changed. Now listen. Next step is execution phase. Execution phase. Now in execution, what will happen? On-site review. Maximum how many days? 6. In case of new unit, only 1 day. In case of new unit, it will be only 1 day. What will be done? First, we'll check general controls. What will be general controls? First, we'll check whether this is good system for staff recruitment. That is general controls. After recruitment, whether proper skills and knowledge are imparted, maintenance of professional skills and standards. Whether there is a proper recruitment system, after recruitment system, whether proper knowledge, skills and standard knowledge is given to these people, then when they are sent to audit, they should be independent. First proper recruitment, then proper training, then independence. When they are stuck in audit, they should be provided with outside consultation. And finally, non-audit office work, that means presenting, attendance, fees collection, all those things, even we are going to see those. First, we'll go and focus on general controls. First happens recruitment, then happen trainings, then happen sending on the assignment, independence, then during the assignment consultations, and then office administration. Next is, after seeing general controls, we have to do final selection of assurance services. Final sample. Where to go for? Final sample. That means if we want, we can increase sample size. If we want, we can decrease sample size. It will depend on how big is the firm. So size and nature of the firm. How big is the firm? Then number of partners and members. Number of location branches. We will, after getting the information, we will go for the final selection. So size and nature, partners, location, then how they work. How they work. Prevailing standards of quality control. Listen, if in different branches, there are different quality controls. So we need to have some audits of one quality control, some audit of other quality control also. So selection also depends on what kind of standards of quality control are followed. Below that, what kind of methodology. At some audit you apply CAT. At some audit you do manual. Both needs to get selected. Fees charged. High value clients, low value clients, everything gets selected. Listen guys, first, how big are they? Size, nature, partner, location. How they work. Are they having standards of quality control, methodology, and how much how much fees and GST how much fees they are earning. Depending on this, we may select final sample. It can be increased also, it can be decreased also. Then we go for the next thing, review of records. First we see overall general controls, how firm is being run. After that we go for review of records. When we go for review of records, first thing is compliance approach. Sir, what is this? First we see general controls, overall where things are appropriate, and then we go for specific documents. The sample which you suppose we have selected 30 assignments. We'll go and see document records of 30 assignment. See, if we see that system of quality control is really good, we will rely on that. See, in compliance approach, assess control procedure which are established to conduct the assignment as per technical, professional, ethical standard. See, in audit also we have two approach. Do heavy test of controls and little bit of substantive, or do less of test of control, more of substantive. In peer review also we need to select the approach. Either it will be check controls, assess control procedures, are they good enough, especially controls for whether controls are good for studying internal controls. That means whether they are having proper checklist to evaluate internal control system, proper checklist for substantive. It's in sequence. Proper checklist for internal controls, then substantive test, then presentation of financial statement, then preparing for audit report, maintenance of records, and so on. First check system. Otherwise, directly go for substantive approach. That means directly go and see records. See, either you see the system, focus more on system, less on records. That is called compliance approach. The second approach is focus more on the assignments records and less on the systems. That is execution. So in execution, there are two things. First, checking general controls, and then going for the next approach, compliance approach or substantive approach. Finally, report will be prepared. Depending on how well maintained is system of quality control, report will be prepared. Listen, if everything is all right, then if everything is all right, okay, what will the matters in the report? Same as we have discussed. Matters in the report, whether staff recruitment is good, after recruitment proper skills, whether they are independent, consultation, officer administration, same matters will be given in the report initially, and then if everything is all fine, then we will give directly final report. If things are not proper, we will go for preliminary report. If there is a non-compliance or deficiency, then reviewer will prepare preliminary report. If there is some problem, we will prepare preliminary report. And PU will be given how many days? 2 days. You reply within 2 days. Listen, after receiving the reply, listen, if everything is fine, directly final report. If there is a problem, then you prepare peer review. You make preliminary report. After getting reply, two things may happen. You are happy with the reply or not happy with the reply. If you are satisfied with the reply, you will give unmodified peer review, clean peer review with all the documents. This was our initial peer review report, your reply, and my final unmodified report. 3 documents will be attached. Or then second, if you are not happy, you will give modified report. This is our preliminary report, this is your reply, and we are not satisfied, we will give modified report. It will be form 9. Final report will be given in form 9. So in amendment, they have introduced forms. Form 9. If you are going to get only modified peer review, you are not going to get peer review certificate. You are not going to get peer review certificate. Then follow-on review. Follow-on review will be announced after 1 year. But if CA firm requests, I want peer review certificate early, then it may be announced within, but at least 6 months, not less than 6 months. After 6 months, peer review may be announced. Time limit is 20 days. There is a big change in selection and planning. Execution has remained same. Reporting has remained same. Only in reporting, number of days given, it has reduced to 2. Earlier 5 days were given, now only 2 days are given. Next big change is applicability. First change is in the process, little bit, not very big change, is in applicability. Let's understand. First of all, applicability is divided into 4 phases. Applicability from 1st April 22. So you can, if you go to chart book, chart, cut this, amended. Applicability is amended. In fact, there are 2 questions in IMP list. 2 questions in IMP list. They are outdated now. There are 2 questions in IMP list. They are outdated because of amendment. See, it is divided into 4 phases. It is divided into 4 phases. Applicability from 1st April 22, applicability from 1st April 23, then 1st April 24 and 1st April 25 in 4 phases. Let's see part, and there are 2 criteria. Now one is partner based criteria. What is that? Depending on number of partners, applicability will happen. For first phase, there is no criteria. Second phase, 5 or more partners, peer review certificate is mandatory. Third phase, 4 or more partners, mandatory. Fourth phase, 3 or more partners, mandatory. So phases are 22, 23, 24, 25. First phase criteria is there is no criteria, and then they go for 5 partners, then 3 partners, then 2 partners. Depending on number of partners, peer review certificate will become mandatory, and without peer review certificate, you cannot give assurance services. That's a big change. Earlier, it was only for listed companies. Now they are doing it for all. Without peer review certificate, conducting audit is not possible as per these phases. Then, next criteria, phase 1, if you are doing audit of client where debt or equity is listed in India or abroad. So if you are doing audit of listed entities, you will be in phase 1. From 1st April 22, peer review certificate is mandatory. It will be borne by CA firm. It will be borne by CA firm. CA firm pays fees of peer review. They are getting the certificate. Okay. But then it is not, in our course, it is not covered. So if you see those guidelines, there it is written about the fees. Next phase, all the unlisted public companies paid up capital 500 crore or more. Paid up capital 500 crore or more. In second phase, they are covering every on unlisted public company, only public, 500 crore or more. Or loan debenture deposit 500 crore or more. So it is same. Paid up capital, same limit, 500 crore or more. Debenture deposit, loan debenture deposit, same, 500 crore or more. And turnover, 1000 crore or more. These are huge turnovers. If you compare with Companies Act, talk about paid up capital of 10 crores. Sometimes 10 crores, sometimes 20 crores, 50 crores. And they are talking about 500 crores. These are highest limits. If you are doing audit of any entity, paid up capital 500 crores or more, loan debenture deposit 500 crores or more, turnover 1000 crore or more, again in phase 2, peer review will become mandatory. Apart from that, in phase 3, raise funds from public or bank or financial institution 500 crore during the period under review. If the entity has raised money exceeding 500 crore during the period under review, that is 3 years, or corporate trust considered public interest entity. Considered public. Some entities are declared public interest entities. If you have raised a lot of money through deposits, if you have raised a lot of money from the banks and financial institution more than 500 crore, Again, it is mandatory in phase 3. Quickly, phase 1, listed entities. Phase 2, 500, 500, 1000. Phase 3, 500 crore or public interest entity. Public interest entity. Finally, phase 4, audit of branch of PSU banks. Those who are doing audit of bank branches of PSU banks, they will come in phase 4. So guys, this is the change, and because of this change, two questions are of no use. The questions of applicability are of no use because they are drafted as per old applicability. You cannot apply the new applicability there. Okay, listen quickly. What is quality review? Just an overview of quality review. What is the difference between peer review and quality review? See here, there is difference. Page number 82. Peer review is controlled by peer review board, and quality review is controlled by quality review board. But peer review board is controlled by Council of ICI. Quality review board is controlled by central government. So basic control is different. That is first 2 points. Next, peer review is conducted so that advisory can be given for improvement. Advisory can be given for improvement. But then quality review is done. If quality review is done, if there are deficiencies and problems, disciplinary action will be taken. Peer review is for improvement. Quality review, if some problem is noticed, disciplinary action can be taken. And finally, peer review is governed by guidelines on peer review, and quality review is governed by CA Act and rule mates therein. Okay. Now, you should have one basic idea with the help of which you will be able to understand how quality review is different from peer review. Every year, quality review board issues a quality review report. Quality review report on overall audit sector. Every year they issue quality review report of the overall audit sector. So how they operate? They first select companies from various sectors. Some companies from telecom, some companies from manufacturing, some companies from service industry, some companies from finance. First, they select companies from different sectors. After selecting that, then they select, these are the CA firms whose quality review will happen. First, they select companies, then they select their CA firms, audit firms for quality review. Now, they don't go and check whole audit. Every year they have agenda. Like they will say, in this year I will check SQC1 these 2 points, SA200 this 1 point, SA210 no, SA220 no, 230 this point, 240 this point. They make limited list of items on which they are going to focus. Those items are checked for all the audits. For all audit we will check, suppose number 1, proper planning was there. All audit we will check 230, this proper documentation was there. And then they find out where there are deficiencies and problems. Are you getting this point? Yes, no. First, who are selected? Companies. Then who are selected? CA firms. Then which areas need to be reviewed, and then review is done. And then finally you get quality review report of individual assignment and CA firm, and then you get overall quality review report. So first of all, for individual firms, individual assignment, you will get the quality review report, and then for the whole firm, you will get quality review report. So functioning of quality review report is little different from peer review. It is little different from peer review. Now listen, in Hindi I have recorded amendments, English I will also record. 45 minutes amendments are there. And major change is in peer review. There are small changes in NBFC. They have introduced new classification. There is small change in NBFC, and there is small change in even professional ethics. There is a small amendment, and that is something unique altogether. They have given amendment of something which is not in the course, which is not in the module. Now, because they have given amendment in RTP, so we have to go and read, okay, what was the original then? Let's study that also. I have said so much quickly. Two files are there for amendment. One is handwritten notes and one is, okay. Let's see. Very simple. Earlier, this was not in course itself. It was not in module itself. Directly it came in amendment only. What is it? And there are very less chances this will be asked. I spoke to Board of Studies, those who CCFL, only one of the amendment is relevant, no clerk. Rest, okay, I understood. But then it's a very small one. Disclosure of fees. See, I said that there is a book called Code of Ethics. And in that Code of Ethics, there is volume 1, which talks about 5 fundamental principles. And there they are talking about this disclosure of fees to ICAI. For public interest entities, listen, disclosure of fees to ICAI, they are divided in two parts. For public interest entities and for non-public interest entities. What is it? If for 2 consecutive years, gross annual fees from audit client and related entities exceed 20% of total fees of the firm. So what they are saying, they see a firm doing audit of public interest entities. Public interest entities means large number of people are dependent on them. And they are declared that these are, you don't need to identify, they are declared already that these are public interest entities. Listen, if CA firm is doing audit of public interest entity and for continuously 2 consecutive years and fees received from these entities, from this client and related entities is exceeding 20% of the fees, that shows CA firm is getting dependent on them. If CA firm is getting dependent on public interest entities, it should be informed to ICAI. In case of non-public entities, same. If for 2 consecutive years, gross annual fees from the audit client and related entities is 40% of the total fees, you are getting dependent on non-public entities. Okay, for public entities, 20%. Non-public it is 40%. Public entities are sensitive, so percentage on lower side. Other than public is not very sensitive, so percentage on higher side. If you are getting excessively dependent on some clients, it should be reported to ICAI. Then, if total fees of the firm is not exceeding 20 lakhs, means If firm is very small, fees is not exceeding 20 lakhs, these disclosures are not applicable. Disclosure is not applicable. Above disclosure not applicable in case of government companies. If you are doing audit of government companies smaller than that PSUs or appointed by government. If you are doing audit of government companies, no one will doubt you. Don't make any disclosures. Government companies, PSUs, appointment government, or nationalized banks or public financial institution, we will not doubt you. Such disclosures are again not required. So if it's a small firm, don't disclose. If you're doing audit of these government entities, again we are not having any doubt, don't disclose. Yes.
So that's essential. Using for all the banks.
No. Audit fees. Only audit fees. Yeah. All the clients. Now, okay. Quickly, I will give some shortcuts about due diligence. What is due diligence? Okay, in forensic, listen, in forensic audit, stop using the word forensic audit. You have to use the word forensic accounting. So instead, in amendment, don't use the word forensic audit, use forensic accounting. Forensic accounting is a broader word and it is in line with international terminology. See page number 73. What do you mean by due diligence? Yes.
So they are.
So there is a doubt. So there is a due diligence. If any company is planning to purchase another company, in principle decision is done, we will buy. Roughly price is also decided. Rough price is also decided. But before executing this deal, purchasing company will appoint a CA firm that you go and do due diligence. Once check carefully all important aspects. Whether there is any problem in this deal, go and check that. That is called as due diligence. How many types of due diligence are there? 7. Listen quickly. So we have a shortcut: location 1, location 2, location 3. A very simple situation. Client comes running to us in our office and says that I am planning to buy a company. I am planning to buy a company, you do due diligence for us. So sitting in the office, we immediately log into MCA portal and we get all the details. What is the SIN number, company identification number? Is company active? Then their PAN card number, their GST number, what is the status? So that is called legal due diligence. As soon as client comes to us, we sit in our office and see we see uh, legal, legal status and tax numbers, whether everything is active, how many defaults are there, and so on. That is called legal due diligence. After receiving proposal for acquisition, CA checks legal things, legal compliance. Fine. Next, location number 2. Let's visit the factory. So he sees factories and machines in the factories. That is called commercial and operational due diligence. Whether machines will be able to work for next 5 to 10 years. Whether they will be able to do production for next 5 to 10 years properly, or there is a serious issue with the machines. That is operational commercial due diligence. Then next, they see people there, personal due diligence. Whether adequate number of staff is there, whether adequate staff is there, whether it is well trained, that is personal due diligence. Next, looking at group of people standing there, environmental due diligence. What is that? There is not flexibility and adaptiveness to acquire an entity. Will they work with us? Will they accept change of ownership? Will they accept change of ownership? Will they work with us? That is environmental due diligence. Next, location number 3, factory office. Location number 3, factory office. So, now this notice is not there. In his hand, there is a notice. Tax notice. From there, we will understand tax due diligence. Whether he is paying all the taxes, whether taxes are due since long, are there any big cases going on? That is tax due diligence. Then he is having ledger, financial due diligence. We'll study about financial due diligence. Then he is having PC, information technology due diligence. Quickly. That person comes to office that we perform, we see legal thing, that is legal due diligence. Then we see factory, commercial, operational due diligence. We see people, personal due diligence. We talk to them, get the feel, that is environment due diligence. That means are they willing to work with us? Then we go to factory office. We see notice, that is tax due diligence. We see ledger, that is financial due diligence. We see PC, that is information technology due diligence. You may get question, what are different types of due diligence? There are 7 types of due diligence and we have to write in one line. We have given in chart. We are giving chart one line. You will get 5 marks for different types of due diligence. Now, financial due diligence. Listen. What things we see, I'm just focusing on the shortcut part. You go and meet managing director, talk about 2 things, history and future. Listen, they are saying in financial due diligence, it's very important that we see history. Why? Looking at history, we'll understand their ups and downs, which products saved them and which products were not good for them. What were the survival points, how they survived. So we'll see whether those things are still with them. Looking at history is very important. We'll be able to understand their good products, their bad products, how they survived everything, and whether those positive things are still with them. But then next thing is future projection. How is next 5 to 10 years? How is next 5 to 10 years? Whether growth is expected in the products, whether good profits are expected, even we need to see that. Then next is we went to CFO. What are the accounting policies? Are they very aggressive in accounting policy? Are they booking revenue on aggressive basis? Are they deferring expenditures a lot? Go and see what is their accounting policy, whether there is recent change in accounting policy and because of that there are profits. See, when we go to MD, we speak about 2 things. Number 1, history and future. When we go to CFO, we talk about accounting policies. Then, after applying accounting policies, we get financial statements, review financial statements. What is GP ratio? What is net profit ratio? What is current asset ratio? What is financial health? What is financial performance? After from financial statement, we prepare cash flows. How good are the cash flows? Whether they will generate enough cash for future. If there will be shortage somewhere, how this shortage will be financed. Look at the cash flow, and then again for meet legal head, statutory compliances. Have they done all statutory compliances? Whether any big penalty or fine is pending? See, we are seeing financial aspect of different things. Sir, legal due diligence was there also, here also. It is conceptual discussion. Again, don't apply practical mind. And last we meet HR head again for human resource. What is the salary level? When was the salary hike given? Whether any salary hike is pending for many years, whether any gratuity pension issue is pending for many years, otherwise it will happen. We buy and we get all the obligations. Let's freeze once again. Go to MD and talk about history and future. Go to CFO, talk about accounting policy. After applying policy, you get financial statements. Review that. From financial statement, you prepare cash flows. Then you go and meet legal head, statutory compliances. Then you go and meet HR head. These are two very popular questions. What to do in different types of due diligence, and second, what to do in financial due diligence. Okay. Come to chapter. Let me take few important questions for 700 series also. Come to chapter number 6. Chapter number 6, SS 701, question 112.150. Asked in November 20 on RTP. November 20 on RTP was a master stroke. Lot of new questions came from there. Okay. Everyone is aware what do you mean by key audit matter? Yes, no. What is it? So all the matters which are discussed with TCWG are key audit matter. Okay. Listen. In 701, there are 4 steps. How to identify key audit matter? How to identify key audit matter? There are 4 steps. Step number 1. Make list of matters which are communicated to TCWG. Key audit matter will always come from the matters which were communicated to TCWG. Step number 2. Identify matters which generally need significant auditor attention. Which generally need significant auditor attention. There are 3 matters which generally need significant auditor attention. See, if you see chart book, page number 48. Page number 48. These are 4 steps. Step number 1, make list of the matters which are communicated to TCWG. Then step number 2, identify matters which generally need significant auditor attention. Three types of matter generally need significant auditor attention. Number one, high risk of material misstatement or significant risk items. They generally need significant auditor attention. Second, areas where management has made significant judgments. If management has made big judgments, whether to write off goodwill, whether to go for impairment, whether to write off goodwill, whether to write off goodwill, whether to go for impairment, whether they have applied significant management judgment, again to check that lot of attention is required. And third, when significant events or transaction take place, that is amalgamation, merger, demerger, split, and so on. So generally, step number 2, identify the matters which generally need significant auditor attention. And third, now, out of these matters, identify those matters which are of most significance. That means, suppose 50 items are communicated. Out of this, we have identified 10 matters which generally need significant auditor attention, only 10. Out of that, there are only 3. 60-70% of time, energy, resources is on these 3 items. Items which are of most significance, only those 3 items will be called key audit matter. And step number 4 or point number 4, it should belong to current year. Only current year things can become key audit matter. Okay, now question is interesting. Question is very interesting. Question is, during the year, implementation of ERP is taking place. So automation is happening. So we have to decide whether implementation of ERP will become a key audit matter. Point is, this implementation of ERP is there. ERP is a very big software. It is a purchase management, production management, employee management, salary management, tax management, every damn thing comes here. Listen, but this matter is not disclosed in financial statements. There is no reference of this matters in financial statement. Can it become a key audit matter? See, what answer you have to write. First you need to explain. Key audit matters are those matters which in auditor's judgment are matter of most significance. They need to explain. It's a 4-step process to identify key audit matter. Then listen here. Such matter are often linked to matter disclosed in financial statements. So whenever we talk about items of most significance, generally in this you will find income, expense, asset, liabilities, notes to accounts on which auditor has worked hard. Generally, this key audit matter will be appearing in financial statements. Such matters are often linked to matters disclosed in financial statements and are intended to reflect areas of audit of financial statement that may be particular interest to intended users. They are saying generally they are in financial statements. A lot of hard work is done and users are interested in them. But when they explain, it is not mandatory. It is not mandatory that that particular item should appear in financial statement all the time. Generally it is like that, but it is not mandatory. That means they are saying there is no disclosure for ERP notes to accounts. but you have worked really hard in checking whether ERP implementation is proper, whether migration from the old system to new system is proper. Even though there is no reference in financial statement, if you have worked hard on it, it will be disclosed as key audit matter. Are you getting this point? So they are saying yes, generally they are disclosed in financial statement and we give reference. This is a key audit matter. If you want to read more about it, read note number 48, read note number 22, read note number 19. We give reference also. But it is not necessary that it should be always disclosed in financial statements. This is a very important case. So conclusion is ERP implementation. Conclusion is ERP implementation will be treated as key audit matter even if it is not disclosed in financial statements. See this 112.350. Again asked in November 22 mock test paper. Listen. What they're saying, we are doing audit of a listed company. And when we are doing audit of consolidated financial statement, one of the subsidiary is not consolidated. One of the subsidiaries not consolidated. That means little bit of fixed asset is wrong, little bit of investment is wrong, little bit of current asset is misstated, little bit of current liability is misstated, little bit of income, little bit of expenses. Everything little bit is misstated. It is having pervasive effect. So we are planning to give which opinion? Adverse opinion. We are planning to give adverse opinion. Comment whether XYZ and company need to report this as a key audit matter in 701. Listen now. Listen. Now, see, it may happen. So, key audit matter is going to win in two situations and they are going to lose in two situations. Listen. Suppose auditor has worked really hard on going concern. There is a material uncertainty over going concern. And auditor has worked really hard on it. Now the point is material uncertainty of going concern is getting eligible for MUGC. There is a MUGC section, material uncertainty over going concern, and there is one more section, that is, now this is eligible for MUGC, this is also eligible for key audit matter. Who will win? Material uncertainty over going concern, because it is specially for material uncertainty. Next, if suppose there is some modification, and auditor has worked really hard on it. Now this is again getting eligible. You all know modification is explained in basis of modification section, where we will explain this all thing. Basis paragraph or key audit matter? Basis paragraph. Is this point clear? Are you getting this point? Listen, key audit matter will lose battle with MUGC and modification. Key audit matter will win in two situations. If a matter is key audit matter as well as it is eligible for EMP, who will win? Key audit matter. If matter is eligible for OMP as well as key audit matter, who will win? Key audit matter. Let's freeze, guys. In two situations, key audit matter will lose. It will lose with material uncertainty over going concern and basis of modification paragraph. It will win in two situations, that is EMP and OMP. Now here question is that adverse opinion is there. Where will you explain this? In basis paragraph or key audit matter? Basis paragraph. Now listen carefully. First explain meaning of key audit matter as per SA 701. Okay. Then explain don't misuse key audit matter. What means? So there is a small theory. Don't use it for modification. Don't use it for going concern. Don't use it for information which is missing in financial statements. Don't misuse it. Only what should come there? Items of most significance. That's it. First explain what do you mean by key audit matter. Then explain don't misuse it. Then explain, listen, once key audit matter gets applicable, it is mandatory to disclose it. Means what, sir? Suppose, now you must be aware, key audit matter is applicable to listed companies. Now, during the course of audit, there is no key audit matter. We will have to write key audit matter section and write there is no key audit matter. Or sometime there is a key audit matter, but we are not disclosing it because it is going to damage company, it is not in interest and so on. You have to write there is a key audit matter, but we are not disclosing it. Okay. Now, listen. Then you write that there is one subsidiary which is not consolidated. It is a matter of modification. An auditor has worked really hard on it. It is eligible for both, but it will be explained in basis of adverse opinion. We will put key audit matter section and we will write there is only one key audit matter which is explained in basis of adverse opinion. Apart from that, there is no other key audit matter. Means, sir, main matter will be explained in basis and we will only give reference. We will only give a reference in key audit matter. Are you getting this point? See, these are the wordings. Except for the matter described in basis for adverse opinion section, we have determined that there is no other key audit matter to communicate in our report. That means there was only one key audit matter and that is explained in basis of adverse. Apart from that, there is no other key audit matter. This is also very important case. All these cases are coming from RTP and MTP. So they are extremely important. One more question. May 22 RTP. Where should we place key audit matter? Okay. Listen. Fine. Listen. If there is no going concern matter, it will be below basis of opinion. Then second, if there is a going concern thing, it will be below material uncertainty over going concern. Third, what if there is a EMP? What if there is a EMP? Listen carefully. Key audit matter can go above EMP or below EMP depending on which is relatively more important. For example, people gave EMP for COVID-19 effect and that was placed before key audit matter. So anything can go. Either key audit matter will win in placement or EMP will win in placement. Any one thing can win in placement. Are you getting this point? And other matter paragraph will be always below key audit matter. Listen, so we are discussing this with different paragraphs. Four things. It will be below basis. If it is a going concern, it will be below going concern. When it comes to EMP, it can be above or below depending on relative importance. If it is with OMP, OMP will be always below key audit matter. Okay, we are through with 701 was critical amongst all new cases were there. Now final thing, whatever we have studied, please go back home and recollect it. If you want, you can watch these videos again with speed, quickly, or any part of it. Now, and then the FADU chart revision video also. First get command over this. Now guys, if time permits, see everyone's situation is different. Someone is going for only one group, someone is going for both groups. Someone is already through with all the subject, only audit is the problem. Someone is good at expressing audit, someone is not good at expressing audit. Depending on your own assessment, I think once you do this much, you can increase number of questions from the question bank. Do remember, do this one thing and as time permits, keep adding things. Okay. Repetition will be there for sure. As I said, 50% questions are 100% repetition only. 100%. 100% from question bank. And some of the questions are weird in the sense they were asked way back old and they're huge 1-2 pages. You can ignore them. They were repeated a lot of time, but then if they are huge and you are finding difficult, leave them, it's okay. I think in the current scenario, 3 to 4 marks question are more relevant. 3 to 4 mark questions will be more relevant. Very big questions may not be targeted. Something, and if A4 size 1.5 page is covered, it will not be targeted. You got any specific doubt or query? Yes, this PDF, amendment PDF is in Telegram and English amendments that will be uploaded soon. That will be again half an hour, 45 minutes amendment will be there.
Visibility of auditor.
That was changed. No. In last attempt only it was changed. Eligibility of peer reviewer. Eligibility of peer reviewer was changed in the last attempt only. Now it is delinked with level 1, level 2, level 3. It's not nothing like that. It is delinked. Okay. Corporate governance amendments are important because it generally happens that amendment of previous attempt are targeted in the current attempt and corporate governance was amended previous year. Okay, anything else guys? Last day, try to cover things which you have already covered. Don't enter into new things. In fact, last month first cover things we have seen. Avoid going to new things. And even if you are going, add them in limited amount. Okay, little bit of this, little bit of this, little bit of this. Directly don't jump into something new altogether. It is not advisable. Correct? Sequence of essays. Honestly speaking, now we have made list. We have made list of see, if you go to Audit Guru channel, you go to file section, you will find CA final ABC analysis. If you see, we have identified 9 essays which contribute 65% of the marks in past 5-6 attempts. So maybe you can focus on these 9 essays more, and then 10 essays which contribute 35%, and remaining 18 essays, they have not contributed much. So there is a detailed analysis essay wise, which essay was targeted in which particular exam. So last 5 attempt analysis is given. If you want to decide that, you can use it. We give on Telegram a complete flow that after coming from SFM paper, what you should study that night. We give links also. This is the link of the video from which you can revise. So in fact, this time we'll have to make it for 2 days. There is a holiday. There is a holiday in between, but I think mistake which students will do is no time pass. They will start reading line by line. Sir, what understanding on the last day? I am understanding so much. That is the biggest mistake you will be doing. Biggest mistake you will be doing. Don't go and read line by line. Last day, 70% of the portion should be overview. And hardly 20 to 30% you will have to read line by line. Only those students will be able to do overview which have very strong markings. Very strong markings. In next to questions it is written, these are the 5 points I am supposed to highlight. These are the important words I am supposed to, moment I see that word, I recall the complete thing. Students with very strong marking on the notes, they will be able to revise very fast. And I have even provided this class marking PDF. So whatever PDF I am using in class, even that PDF is now available. You can simply download and use it, maybe for markings or writing whatever was written. Correct. Okay guys, so I came to Hyderabad after a long time. It was nice time with all of you. 3 days we have spent around 27 hours. 27 hours of teaching, and lot of things are covered. I hope these 3 days gives lot of insight, lot of approach base for doing the audit. Now it is your responsibility to build on it. Now responsibility is to build on it, to keep revising, and if you need any help, simply put a WhatsApp on my number. Many times I will not reply. So it's a very simple thing. You need to keep following up. Don't feel bad about it. So I'm in one class or the another. But then when someone, sir, reminder 1, reminder 2, oh yes, yes, yes. So I will reply. All the best. Last message very simple. Stay cool, calm, happy. That's very important. Then only you will be able to make full use of your studies. Rest everything will flow. All the best guys.